Alright guys, so today we are going to start with a fresh chapter, a new chapter. The name of chapter as such is basically audit under fiscal laws. Audit under the laws, fiscal laws. Okay, and basically in this particular chapter we had two types of audit to understand. First was the income tax audit, okay, the tax audit under section 44 AB, and second was GST audit. But now since GST audit has been done away with, we only are left with one topic in this chapter, that is about tax audit. Okay, so in this chapter, if you can see, the heading of the chapter itself I gave only income tax audit. Okay, if you compare it with ICI material as such, we have the chapter's name is audit under fiscal laws. Okay, but now we only have to cover one type of audit here, which is basically the tax audit. Okay, income tax audit. Now what are the things that we have to cover in this particular chapter? We are going to learn about the tax audit that most of you must have been doing in your offices. So tax audit under section 44 AB. Okay, then some audit cases wherein deductions have been claimed under section 35D and E of the Income Tax Act, and also some cases wherein we are going to learn about the audit of public trust. So three things in total we are going to learn when I talk about income tax audit. Okay, now before we start with this, okay, I just wish to tell you as to why this concept of tax audit is there. Okay, so let us understand that all of you know this. Let's say there is an SSC, and let's say he has income from PGBP. Out of the 5 heads, let's say he has some income from PGBP. Okay, now what happens is this SSC is going to file his income tax return. He is going to file his income tax return. Okay, and this is going to go to the, let's say, the assessing officer. Okay, now what happens is this SSC, he has to submit what the AO now requires in order to see whether all the compliances with respect to PGBP has been done or not. Okay, this assessing officer will basically ask for some more details. Okay, so along with this income tax return, he might have to submit some additional information. The SSC might have to submit some additional information. Okay, what is the additional information? Basically, the additional information is in the form of form 3CD. This is known as, guys, statement of particulars. We'll discuss about it in detail after some time. Statement of particulars. Okay, so the SSC is required to submit particulars, statement of particulars in the format, basically form 3CD, and it has got somewhere around, let's say, 44 clauses. So the SSC is now required to, the SSC who has income from PGBP, he is now required to give additional information. Okay, additional information. What is the format? Format is form 3CB, which is called as statement of particulars, right? We have 44 clauses, somewhere around 44 clauses. Okay, so this additional information is now also given to the assessing officer. Okay, now you think from the perspective of assessing officer. This assessing officer, there are so many number of SSCs in India who have income from profits and gains of PGBP, right, from this particular head. Now this assessing officer, if he sits down and check all the statement of particulars given by each of the SSCs, it will be nearly impossible, right? There are so many number of SSCs, and the assessing officer checking each of the statement of particulars in detail, it will be a very hectic task for him. Okay, and so in order to come up with a solution for this, what has happened is the income tax department, they thought of a solution. Okay, they thought that, okay, let's do one thing. Whatever particulars the SSC has to submit, let us basically come up with this thing, that this particulars now they have to be audited. I mean, they have to be audited. And who is going to audit? A chartered accountant. So now they have to be audited. The statement of particulars which is made by the SSC, okay, it has to be actually filled by the SSC. Now this will need to be audited. Okay, so the concept of tax audit came into existence. Okay, and in tax audit, the chartered accountant is basically submits his report whether the statement, whatever statement of particulars, whatever thing the SSC has mentioned in the statement of particulars, he has to report whether the same is true and correct. He has to report whether the same is true and correct. Okay, so in this way the workload of assessing officer would be less, right? And of course, if I talk in very practical terms, whether whatever particulars is mentioned in form 3CD, it is all with respect to the income tax provisions of income tax, right? And a chartered accountant would be in a better position, of course, to assess whether the provisions have been complied with or not. Hence, if he gives a report, it will be more, reliable, I should say, of course, than as compared to an assessing officer. Though assessing officer might also be, knowledgeable, but generally CAs will be having more knowledge about the provisions of the Income Tax Act as compared to assessing officer, because assessing officer, practically, if I tell you guys, they might be from any background. Most of them are from science background. They might be some, they might have cleared certain exams, they might be IRS. So generally CAs will be in a better position, right? So this is why the tax audit thing is done. Okay, and now again, if I put it, guys, in very simple terms, you all know this, that generally we have got 5 sources of 5 heads of income. Okay, and if you see, if I write about the 5 sources, these are the very basic things. I am yet to start with the chapter, and what we will be doing here in this chapter is, of course, I personally feel that this chapter, because we are going to learn a lot of provisions about income tax also, I feel this chapter should have been a part of income tax syllabus. If a student, the difficulty which the student faces in this particular chapter of audit is that he or she is not able to link it with the provisions of income tax. Some students will be of like, sir, we have not yet covered income tax. Okay, and some, let's say, even if they have done income tax, they will not be able to recall all the provisions of income tax. So what I'll do here is, in order to make things very simple and easy for you, of course it is going to take a bit longer, but we are going to cover the relevant provisions also of income tax. Of course, not in that much of detail as you do in income tax, but yes, we are going to cover the required, all the sections of the income tax which is required here in brief. We are going to cover that up in brief, so that you have a good understanding of the entire tax audit chapter. It is going to take a bit of time, but then again, it is for your benefit, guys. Okay, I don't want you to just go through all the clauses and remember it without understanding. So we'll have a very in-depth understanding of each of the clauses here, so that practically also when you are doing tax audits, you do it in a very fashion. Okay, so if I tell you, guys, I was saying, if I talk about the basics only, there are 5 heads of income. Okay, so generally the salary head. Okay, what are the sections? If you are able to recall, salary is from section number 15 to 17. Okay, so generally these, let me just write it in this way. Yes, so salary income, you all know this, it is for employees. Okay, then after salary we have house property, the rental income and all for landlords. So we have section 22 to 27. Okay, then we have PGBP. Okay, the sections are basically 28 to 44D. Okay, and after PGBP we have capital gains. We have capital gains. The sections are from 45 to 55A, and finally we have the other sources, which is basically from 56 to 59. Okay, now why did I mention the sections? Because all of you know this, basically the gross total income will be calculated from each of these heads, and then the gross total income is arrived at. All of you know this. Okay, now please, if you're able to focus, guys, we are going to cover tax audit, which is as per section 44AB of the Income Tax Act, 44AB section. And if you see, guys, the sections that I have written, 44AB will fall under this. 44AB will fall under this head. Okay, so the requirement to get the tax audit done is also mentioned under the head of PGBP. Okay, so that is why if I told you here, if an SSE has a PGBP income, okay, we are going to learn about the applicability, but I am just giving you a broad idea, broad overview. If a SSE has got income from PGBP, then only the requirement of tax audit will arise. Okay, if let's say I am a salaried person, and even if my salary is let's say 5 crores, I won't have to get my financials tax audited. I won't have to come up with get tax audit done. Okay, if I only have rental incomes, I will not have to get tax audit done. So what I'm trying to tell you is the section 44AB, it falls under the head of PGBP. So when we do the applicability part also, you are going to understand this, that tax audit is applicable for those SSEs which have got PGBP income. Other sources and all, if I only have other sources income, other sources is something which all will have. Now my question, one just simple question I wish to ask, can a person have multiple sources of income? I mean, can he have income from all the 5 heads together? What do you think? Can he be under salary also? Yes. So if let's say I am doing a job, I have my job from Monday to Friday. Okay, I am into a full-time job from Monday to Friday. So they give me salary. On weekends, let's say I teach. Okay, and I earn a good amount from it. So it can be a, let's say my PGBP. It can be taxed under this. Let's say I have also been I have a property also wherein I'm earning income, I'm earning rental, so I will be taxed under HP also, right? If I had sold something, I've been investing in shares, and also I might have capital gains. And other sources we all have. Generally, if I have a savings bank account, let's say I get interest income also, that will come under which head? Other sources. So a person can have incomes from all the 5 heads, guys. Okay, but a tax audit needs to be done for which SSEs who have got their income from the head PGBP. Is this clear? Number 1 point. Is this clear, guys?
Yes.
Yes. Okay. Now, in today's lecture, guys, the focus in today's lecture will be to teach you the basics as to the applicability of section 44AB. We are going to learn as to when the tax audit is applicable. Okay, then we are going to learn about who can be the tax auditors. We are going to learn about the tax auditors part, and then the different forms under tax audit we are going to cover. Okay, so let us now start. What is the thing that we have to first understand? Okay, we are covering this topic first. This is the topic that we are covering, tax audit under section 44AB. So let us understand. Number 1 thing that we have to understand is applicability. Okay, so let us start with the applicability, and this is really very important. Questions are asked from this part, and if you understand the basics, guys, then only perhaps you will be able to understand each of the clauses that we cover under the form 3CD. Okay, so how many of you, both of you have done tax audits? How many of you have done? Suthir, Prachi? Yes, all of you have done. Great. Okay, so then it is going to be easy for me, because to teach the relevant sections of income tax act, I mean, it's somewhat really dreadful for me. But yes, of course, things will be very clear to you after we are done with this entire chapter, and once you now do tax audit, you will have a total different perspective of doing it. Okay, this is something, tax audit in your initial assignments, I mean the first 1 or 2 assignments that you must have done, it would have been really very difficult perhaps. Okay, but then as and when we become familiar with the provisions and all, it becomes very easy, right? So let us now focus, let us discuss about the applicability of tax audit. Number 1, it says every person carrying on business shall, if his total sales, turnover or receipts, as the case may be in business, exceed or exceeds 1 crore rupees in the previous year. So all of you know this, that if I talk about business, okay, let me just write it in this way, applicability. So if a person is doing business, okay, and out of the business he has a turnover which exceeds, let's say 1 crore rupees, then tax audit needs to be done for this kind of SSE, for this kind of business. Okay, so number 1 criteria is very simple. If a person is into business and the turnover of which exceeds 1 crore rupees when in the previous year, okay, then tax audit needs to be done. Okay, so this is the number 1 criteria, very simple. So this was with respect to business. Second, carrying on profession. So if a person is in profession, it says his gross receipts in profession exceed 50 lakh rupees in any previous year. So TO is turnover, gross receipts must exceed how much? 50 lakh rupees, 50 lakhs. Okay, and please be very careful, it is the word which is written here is exceeds. Okay, so if I am into a profession and I am earning 50 lakhs, tax audit will not be applicable to me. It says exceed. The word in both the cases is exceed or exceeds. Be very careful about it. So two criteria we have covered, which is relatively very simple, and you all know this. Okay, so any business, let's say, who has a turnover of more than 1 crore rupees, that means it is a big business. It is a big business. Okay, so then tax audit needs to be done. If anyone is a professional, okay, and the professional receipts, the receipts, basically the gross receipts, the professional receipts in any previous financial year, in any previous year, it exceeds 50 lakh rupees, then tax audit shall be applicable. Okay, so these 2 points are relatively, guys, very, very simple. Okay, but then I wish to just ask you guys, what is the difference? What is the difference between business and profession? Can anyone tell me this? What is the difference between business and profession? Yes, guys. Business can be, can be producing something, selling a commodity, etc. Right? But when I talk about profession, guys, profession, if I put it in very simple terms, okay, profession, if I put it in very simple terms, it can be basically, you are occupied, it is an occupation, but this is totally based on intellectual skills. Okay, so we call it as profession. Okay, I'm going with very basic things. Okay, so what is meant by profession? It, of course, occupation. Let's say I am a teacher now. I am a teacher. Okay, so I am a teacher because I have got some intellectual skills. I mean, I qualified as a chartered accountant and then I am teaching you. So this would come under, let's say, profession. Okay, let's say there is a doctor and he runs his clinic. Okay, and patients come to him, he charges his fee. So it's his occupation. So this is a profession because it is totally based on what? His intellectual skills. I can say it is based on his degree. It is based on his skills. Okay, so we call it as profession. Okay, why am I stressing on this? Okay, if let's say if I talk about let's say doctor and he has a clinic. Okay, let me just give it an example in this way. So let me put it in this way. Let's say we talk about a doctor. Okay, now if the doctor runs a clinic wherein he the patients come and he basically prescribes medicines and all based on the symptoms. So this would amount to what? Profession. But let's say just outside the clinic, the doctor also has a medical shop. Now, will this be a part of profession or business, guys? This is a part of business. Alright, so I hope you understand the difference between a business and profession. Okay, now there is also one more word. If you remember, we generally come up with this word also, vocation. Apart from profession, we have a word called vocation. Can anyone answer me? What do you mean by vocation? Yes. Not really part-time, but let's say, see, doctors, CAs and all, we have to study a lot and then only we become this professional, right? So, when I talk about profession, it has to be based on some intellectual skills. You must have done some study for it, etc. But let's say, let's talk about a driver who is driving a car. Okay, so let's say he has his own car and he runs it under Ola and Uber. Okay, now he has his own car and he is driving the car himself. So this will amount to a kind of service. It is not something related to selling of commodities, etc. So this won't come under business. But let's say he is driving his own car. This is also a kind of service which is rendering. But this will not be called as profession because as such he did not have to undertake any academic classes or intellectual knowledge about it. Okay, driving he just has to learn it. So this will be a part of, let's say, vocation. Okay, so the difference between profession and vocation basically is the fact that in profession we have to there has to be some intellectual skills. Okay, you have to become a professional, I mean by giving certain exams and upgrading your knowledge. So this is just a difference. Okay, so we have covered 2 points, guys. One is regarding applicability, one is with respect to business, that let's say business, the turnover. In case of business, we have to check upon the turnover, and in case of the professionals, we have to check the professional receipt, whether the gross receipts exceed 50 lakhs. Okay, now we have got under the applicability part, we have got 3 more points, guys. Okay, first 2 were relatively very simple. We have got 3 more points. Okay, these 3 points are very interesting points, and these 3 are based on presumptive taxation. These 3 are based on presumptive taxation. Okay, so what do you mean by presumptive taxation? Let me just tell you. Okay, now what happens is the Income Tax Act also, you know, wants to simplify things. They want to simplify things. So they are of the view, see, it is not possible for every businessman to keep proper books of accounts and then get the financials, or let's say audited, or get tax audited done. It might not be possible for them. Okay, the business is there, but the institute, rather the income tax department, they also wants to simplify things. So they are of the view that the persons who are, let's say, for some business, they say that, okay, if your turnover is this much, let's say, I'm just giving you one example. If you are earning 10 lakhs, let's say, okay, or let's say if you are not earning, rather if your turnover is, let's say, 1.5 crores, okay, but let's say you have not prepared books and all, we are going to accept it, but you just declare 8% of profits, or let's say of the turnover 1.5 crores. So we don't want any books and all. If you declare 8% as profits and pay taxes accordingly, no need to get your financials audited. We don't need to keep books of accounts, let's say. They may say like this. Okay, so what has happened is, in points number C, D, and E, it is on presumptive taxation. So what are the points that we have to cover? Let us understand. Okay, so we are still doing the applicability portion. Every person. So I'm reading this point first. Okay, carrying on a business. So again, this is with respect to business. Every person carrying on a business shall, if the provisions of subsection 4 of section 44 AD are applicable, and which is not chargeable to income tax in any previous year, get his accounts of such previous year audited by an accountant before the specified date, and furnish by date the report of such audit in prescribed form. So the primary thing is, which you have to remember, guys, this is, now I am just going to write it in short, and then we are going to cover up the relevant provision of section 44 AD. So section 44 AD, the next applicability of tax audit is basically with respect to section 44 AD. Okay, now what is section 44 AD? First, let's read this, and then I'm going to summarize it. So what I have done, just to understand the applicability portion in detail, what I have done is, in the next page, if you can see, I have mentioned the sections, guys, and the provisions in brief. Okay, it is not as such there in our, in detail in our ICI material also, but yes, for your understanding it is required, so I have given it to you, and you are going to learn it in a much better manner when you do your tax classes also. But let us, for the time being, understand it. Okay, so what is 44 AD all about? Okay, this is a presumptive taxation scheme. Presumptive taxation means that the government is going to presume that if you have this much of turnover, this percentage of your turnover will be your net profits. This is an option which has been given to the business people. Okay, so section 44 AD, it is a presumptive taxation scheme of section 44 AD, can be exercised only if, when can this be exercised? If the turnover or gross receipts from the business. So number one thing, please understand, 44 AD, okay, it is for business, it is not for profession, it is for whom? For business. Okay, and it says if the total turnover or gross receipts from the business do not exceed rupees 2 crores. So it should not exceed rupees 2 crores. Number one criteria. Okay, so if somebody wants to opt for presumptive taxation under 44 AD, the number one criteria is he should be into business, number one, and his turnover should not exceed rupees 2 crores. Okay, now I've been saying you presumptive basis. So how will the government tax, basically, at what rate will the government charge us tax, at what percentage, how will the government treat it as profit, and then accordingly will charge tax. Okay, so the point here is, in case of a person adopting the provisions of section 44 AD, income is computed. How will the income be computed? Income is computed on presumptive basis at the rate of 6% of the turnover. If you are declaring a turnover of, let's say, 1.5 crores, so then on presumptive basis you can take the profits, you can take your income to be directly 6% of what? The turnover. 6% only when all your payments, let's say the payments you have accepted digitally, you have accepted the payments digitally, your turnover, let's say if it is 1.5 crores, all the money has come to you digitally, I mean you did not do any transaction in cash, then the presumptive taxation rate will be 6% of turnover for payments accepted digitally, or 8% of the turnover if payments are accepted in, let's say, cash mode. Okay, so for that amount of money which is received in through banking channels, basically 6% will be the presumptive rate of your income, and for cash transactions 8%. Okay, but if you wish to disclose more than 8%, 6%, of course the income tax department will be more than happy. So a person may voluntarily disclose his income at more than 8% or 6%. Okay, now please understand this now. Okay, this is a facility, or rather I would say, to make things easier for the assessors. This is a facility which has been given by the income tax department, right? That if you are into business, your turnover does not exceed 2 crores, you can declare your income, okay, on the presumptive basis at the rate of 6% or let's say 8%. Okay, now for whom is this applicable? For whom is this applicable? Please remember, first you have to understand it is for business. Okay, it is applicable to individuals. It is applicable to only, this facility is only for either individuals, let's say, or HUFs, resident HUF and resident partnership firm, and it is also for partnership firms. But LLP is not included. Please be very careful. Body corporates, I mean LLP is not included except LLP. So when I talk about partnership firms, LLP is not included. Okay, so it is designed to give relief to small taxpayers, being resident individual, being individual HUF or resident partnership firm. Okay, now the point here is, guys, let me just discuss a very important point. We were we were discussing the concept of applicability of tax audit, but all of a sudden I took you to section 44 AD. Now the main thing that you have to remember here is, if somebody is basically if I say opts for section 44 AD, okay, but then he is, I have told you that he can voluntarily disclose income which is more than 8% or 6% of the turnover. But let's say if you are into a particular business, let's say you are into a grocery store and all, you have a turnover of 1.5 crores, okay, and for grocery stores and all, it might not be possible also for them to keep, let's say, proper books of accounts and all. So then the government says, okay, if you are not able to maintain, do one thing, whatever your turnover is, at least each business people will have an idea about his turnover. So whatever turnover you have, on the basis of that you pay the tax either at the rate of 6% or 8%. Okay, if the amount that you have received is mostly through banking channels, then 6%, or cash, the amount which you have received in cash, at the rate 8%, right? But then this particular businessman is of the view, no, I don't have income of 8%. Even though my turnover, let's say it is 1.5 crores, I have not maintained books, but I feel my income is even lesser than 8%. Then what does the government say? That if you feel that your income is less than 8%, okay, if you don't want to give taxes on the basis of 8% of income, I mean on 8% of your turnover, then you will have to maintain books of accounts and you have to get your accounts audited under section 44 AB. So the point which you have to remember here is, if an assessee, you can declare an income at lower rate, that is less than 8%. However, if you do so, if you are declaring an income which is lower than, the specified rate, and if you do so and your income exceeds the basic exemption limit, let's say if my income, I am an individual, I am a proprietor, my income is exceeding 2,50,000, the basic exemption limit, okay, then you will have to you are now required to maintain the books of accounts. You shall have to maintain the books of accounts also under section 44AA, and get your accounts audited under section 44AB. So why, see, the purpose of giving you an idea of 44AD was to basically make you understand that this is the provision, these are the rates, and if somebody wishes to tell that no, my income is even less than 8%, then he will have to maintain the books of accounts and get hits. You can go with it, you can declare your income to be lesser than 8%, but then in that case, what is going to happen, please remember, you shall have to maintain books of accounts also, and also get them audited under section 44AB, right? This is the point. So I made it very clear by writing this statement here, guys, okay? So again, coming back to the applicability part, it says carrying on business. So it is for business, shall, if the provisions of subsection 4 of section 44AD are applicable. Now subsection 4 of section 44AD is nothing but if you are declaring your income below 8%, or let's say 6%, whatever the case may be. If you are declaring your income, if you say that your income is less than 6% or 8%, that means subsection 4 of 44AD is applicable. And along with that, of course, your income should be more than, overall income should be more than the basic exemption limit as per Income Tax Act, which at present is how much? 2,50,000, right? Am I right? What is the basic exemption limit, guys? Yes, guys, please tell me this. प्राची ऑफिस पे काम कर रही हो ना, क्या बेसिक एग्जेम्पशन लिमिट है? $250,000 है, 5 lakhs. How much is it, guys? Okay, yeah, please don't consider it 5 lakhs, because most of us, when we give consultancy, we think no, till 5 lakhs you won't be at all taxed. Okay, it is not the case. 2,50,000 is the basic exemption limit. Of course, there is no tax, let's say, till 5 lakhs, because a rebate is given. Okay, but the basic exemption limit is 2,50,000. Okay, so yes, so all right. So again, if you declare your income to be less than, let's say, 6% or 8%, and your income and and your overall income exceeds the maximum amount which is not chargeable to income tax, okay, then you have to get your accounts audited. So this is a bit complicated written here. In simple manner, I just stated it here, that if you declare a lower rate of income, and if your income exceeds the basic exemption limit, then you will be required to maintain books of accounts and get your accounts audited under section 44AP. Is this clear to everyone? Yes, but a few more points, guys, with respect to section 44AD. What is it? That okay, it is applicable to individual HUF partnership firms. So section 44AD provision, a company cannot adopt for, let's say, go for section 44A. Okay, so it is applicable to individual resident HUFs or, let's say, partnership firm. And also there are few more exceptions. It says business of, except the following, these people, the ones who are into these business that we are just going to cover, they also cannot adopt basically the provisions of section 44AD. Okay, so who are the people? Businesses of, the ones who are into business of plying, hiring or leasing of goods carriages. So they are not allowed to basically adopt the provisions of section 44AD. Why? Because we have a separate provision for them under section 44AE. We are going to cover that up. Okay, so we are going to cover 44AE also. Okay, so so if someone is into business of plying, hiring or leasing of goods carriages, the transporters and all, then you cannot go for section 44AD. Second, a person who is carrying on an agency business, who is into agency work. Third, a person who is earning income in the nature of commission or brokerage, who is earning income in the nature of commission or brokerage. Now, please understand the logic as to why section 44AD is not, meant for people who have an agency business or who are running, let's say, who is an insurance agent and who earns commission. Now, please understand, if I am an insurance agent, I sell policies, okay, I sell policies and the income that I receive is in the form of commission. Okay, so when I sell a policy and the commission that I receive, so that commission primarily is my entire income. Okay, as such, against that commission income that I have received, I'll not have to spend much amount. I mean, okay, I might have an office, I might have some staff. So whatever commission I receive, there will be relatively fewer expenses against those commissions, right? So for commission income, this concept is not applicable. Okay, but then if let's talk about a grocery store, a person who is into grocery store, let's say his turnover is 1.5 crores, but that doesn't mean he has earned 1.5 crores. His margin might only be what? Let's say 10%. If his turnover is 1.5 crores, he must have earned, let's say, only 15%, 15 lakhs out of it. But this is not the case of a person who earns commission. If I sell insurance policy and I earn certain commission, I won't have to deduct much expenses against it. Okay, that income is primarily my income. Okay, I won't have to undergo a lot of expenses against that particular income. Are you able to understand? This is my income. This is not as such a turnover basically, right? So that is why agency business, commission or brokerage business is not the ones who are engaged into these business, they are not allowed to adopt provisions of section 44 AD. Okay, and also a person whose total turnover of gross receipts for the year exceed 2 crore rupees. Okay, so this I have already told you. So this is basically, this presumptive scheme of taxation is for small businesses, I mean, whose turnover do not exceed rupees 2 crores. Okay, so is this clear, guys? I have dealt the provision also in detail, relatively in detail, but yes, of course, you are going to learn more about it in taxation. Is this clear? Yes. Okay, so in short, if I go again with the applicability part, if I write it now, in short, with respect to section 44 AD, it is applicable for whom? Individual, HUF and partnership firms, but it does not excluding LLP. Okay, what are the conditions, guys? Number one condition is basically what? Turnover should be how much? Turnover should not exceed. Turnover should not exceed 2 crores. This is the first criteria.
2 crores in previous year, right?
Yes. 2 crore rupees. Okay, it says in any previous year. Okay, in previous year. And next, you have to declare income. You have to declare income at the rate of what percentage, guys? If you declare, turnover does not exceed 2 crores, and then let's say you declare income. Now we are going to discuss about basically when you have to get your financials, I mean when you have to get audit done. Okay, so if you are under section 44 AD and of course your turnover is not greater than 2 crores, but you declare income, you are declaring income which is less than, let's say, either 8% or 6% of turnover, then you have to get your get audited, I mean under section 44 AB. So if you are declaring income which is less than 8% or 6%, and there is one more condition, guys, plus your income exceeds the maximum amount which is not chargeable to income tax plus. So this simply means what? Your income is greater than, how should I write it? Let me just read the simple line here which I wrote. Income exceeds the basic exemption limit. My income exceeds the basic exemption limit. So if these two criteria are fulfilled, I mean if these two criteria are there, the audit will be done. Okay. Now, and some more points just for your understanding in brief, because once when you are revising, okay, when you are doing again tax audit, studying it for the first time, let's say, I won't suggest you to go through the provisions of 44 AD in detail. Okay, you will be doing it anyways in income tax. So what I am trying to do is I am going to write it for you in very summarized manner. So section 44 AD I have already written that it is applicable for whom? It is applicable for individual HUF partnership. Turnover should not exceed 2 crores, and in case you declare your income which is less than 8% or 6% of the turnover, plus your income, your overall income, it doesn't it exceeds the basic exemption limit, then you have to get your financials audited. You have to get your financials audited, let's say under section 44 AB. Okay, now section 44 AB is not applicable in 3 cases. I discussed with you guys. Section 43 is not applicable for the, let's say, in short, if I write somebody who's into business of section 44 A, I mean the ones who are into plying of let's say trucks and also the ones who are into business of plying, hiring and leasing of goods carriage. Okay, so let me just write It is not applicable for the ones who are into business of goods carriage. Okay, and then it is also not applicable to the ones whose income is from commission or brokerage or let's say agency. It is any means not applicable. Okay, so this is what I have written it in very short for your understanding. Okay, and one more thing, section 44 AD is only with respect to what, guys? Business. If somebody is into business. Is this clear now? This should make things very clear. Samajh aa gaya?
Yes.
Yes. Okay. All right. So we are still under the applicability portion. Now, let me just cover now clause D here. Okay, of applicability. So we are done with 44 AD. Now let's understand a person, every person covered under section 44 ADA. Now we have another section. Every person covered under section 44 ADA, and he has claimed such income to be lower than the profits and gains so deemed to be the profits and gains of his profession, and his income exceeds the maximum amount which is not chargeable to income tax in any previous years. Okay, so what is 44 ADA? Now, if you read this, probably you will not understand anything. Okay, but let us now cover 44 ADA first. Let us understand 44 ADA, and then we are going to come back to applicability. Okay, so what is 44 ADA? See, I told you this, guys. 44 AD. Let me just tell you again. This is for business. Okay, and in very simple terms, guys, this is for profession, and that to specified profession. Okay, so 44 AD. Again, this is also presumptive taxation scheme. The presumptive taxation scheme under section 44 ADA is designed to give relief, a benefit, a facility. It is a facility given by the Income Tax Act. So it is designed to give relief to person resident in India whose gross total receipts do not exceed rupees 50 lakhs and is engaged in specified profession. So it is for specified profession, guys. Please be very clear. 44 AD is with respect to business. 44 ADA is for professionals. Okay, for professionals. So what are the conditions? You must be into profession, and your gross total receipt should not exceed rupees 50 lakh. It should not exceed rupees 50 lakh. And you are engaged in what? Specified profession. There are 7 professions mentioned here. The list of 7 specified professions basically are, if you are into legal, medical, engineering or architectural, this is considered as one. Engineering or architectural, accountancy also, chartered accountants, let's say, technical consultancy, interior decoration, or any other profession as specified by CBDT. So there are 7 specified professions, last one being a residual point. So if you can see, if you are into legal, medical, engineering or architectural, accountancy, technical consultancy, interior decoration, or let's say any other profession as notified by CBDT, then you may adopt for presumptive taxation scheme under section 44 ADA. But then again, your gross receipt do not exceed rupees 50 lakhs. Okay, now what happens here again? See what happens. Let's say if I am a doctor, I might generally, the patients come and they pay me the fees, I keep the fees and all. It might not be possible for me, let's say, to maintain books of accounts, but of course I'll have an idea as to this has been my received. Okay, receipts. Generally I on an average I see 30 patients a day, let's say, and I charge 500 rupees. So let's say each day my receipts is, let's say, 15,000. So ultimately I'll have an idea of my gross receipts. Okay, so even if I'm not maintaining books of accounts, it's okay. So what has this act has given relaxation to these professionals. Okay, what is the relaxation? Let's say you are how will you have to compute your now income? So it says, in case of a person adopting the provisions of section 44 ADA, income will not be computed in normal manner. Income will now not be computed in normal manner. What is the normal manner? Let's say these are your gross receipts, these are the expenses here, and whatever comes as a balancing figure is your income. No, this is not how your income will be calculated. Rather, because we are adopting, let's say, presumptive taxation, but it will be computed now at the rate 50%. Straight away, how much? 50% of the gross receipts. Okay, please be very careful, guys. For business people, the percentage is way less, because let's talk again about grocery store. If they are doing a turnover of 1 crore 50 lakhs, 50% cannot be their profits. Okay, they do it on, let's say, 10, 12, 15% maximum. But when I talk about profession, in case of profession, whatever you earn is mostly the income. But still the government, as per this act, you can basically say that 50% is your expense, and then on remaining 50% it will be considered as income and give your tax. Okay, so this point says, in case a person is adopting the provisions of section 44 ADA, income will not be computed in the normal manner. I mean, normal manner is this: gross receipts minus all the expenses. Rather, it will be computed at flat 50% of the gross receipts. Then you don't have to consider, be careful about the expenses and all. Even no need to maintain books properly, right? So this is your turnover. Declare 50% as the income. Government will be very happy. The department will be very happy. Okay, but again, if you are a very good citizen of India and you feel, no, my profits is more than 50%, declare it. They will be more than happy. Okay, they want such kind of SSs, right? So however, such person can declare income higher than 50%. Good enough. But then if you feel that no, if my gross receipts is this much, okay, but then my income is not 50%, it is much lesser. So much of expenditure. I have my office in the prime location. I only end up paying so much of rent. I have got so many number of employees. I have to pay them salary. I have qualified employees with me. So if you feel that 50% of income is not justifiable for you, so you may declare a lower percentage of income. Okay, but then if you declare a lower percentage of income than 50% of the turnover, what is, you have to maintain books and then get your financials audited, right? So however, if you declare profit less than 50%, and your income exceeds the basic exemption limit. So if you are declaring, professional receipts, if you are declaring income less than 50% of the receipts, plus your income is greater than basic limits of exemption, then you will have to get your financials audited under section 44 AB. Okay, so then you will be required to maintain the books of accounts also as per 44 AA. We are going to cover 44 AA later in one of the clauses, and you have to get your accounts audited also. So is this clear, guys? Very similar to 44 AD, but AD is primarily for business and ADA is for profession. Is this clear? Yes. So in short, if I write, let me see if we have space here. Okay, so better you write it above this point if you are taking a note, but let me just write it here for your understanding. So let's talk about section 44 ADA now. Okay, so for first thing is, for 44 ADA is for whom? Again, it is for individual, HUF and firms. Okay, and again excluding LLP. Number one thing. Okay, 44 AD. Now 44 ADA is for specified profession. I'm just writing the word profession here. Some specified professions. You don't have to learn the section, guys. Who are the specified professions? No. Okay. So these I just made you walk through the section so that you have an understanding, okay, about the applicability. So 44 ADA. Now, what are the criteria? Number one, it is for individual HUF partnership except LLP. Okay, already discussed. Now, your gross receipts. It is for specific. Let me write it here in this manner. Specified professionals, and the gross receipt should be how much? Should not exceed, rather. Okay, should not exceed how much? 50 lakhs. This is criteria number one. We are now learning the applicability of tax audit. Okay, so yes, so you must be in a specified, you must be a specified profession, and your gross receipt should not exceed 50 lakhs. But apart from this, what is the second criteria? And you are declaring your income less than 50% of gross receipts, plus at the same time your income overall, let's say, it exceeds basic exemption limit. Okay, so if you are declaring your income to be less than 50% of gross receipts, and then income, of course, it is more than the basic exemption limit, then you will have to get your financials audited. So is this clear, guys? If income is less than basic limit, the purpose will be defeated. I won't even have to file the return, so the question of tax audit doesn't arise. Okay, so this is a very basic thing, that my income should be greater than basic exemption limit. Okay, so is this clear, guys? Section 44 ADA.
Sir, how will it be taxed?
Sorry?
How will it be taxed? Tax rate?
Now, okay, if you are now declaring lesser than 50%.
No. If you are declaring 50%,
Yeah.
then what will be the tax rate?
No, the profits will be the flat 50% is your profits, and you have to pay the tax. As per the entity, of course. If you are individual, if you are proprietor, you will get the basic slab rates. Yeah. So normal manner, the tax will be calculated in the normal manner.
Yeah.
Okay. Yeah. All right. So yes, applicability. We are done with the 4 clauses. We are done with the 2 basic things, and under the presumptive tax part, I have just covered 2 parts now. Now the second, again, C clause. It is again very simple. We are not going to get into the depth of the sections here, but yes, for your understanding, it says every person covered under section 44A, the ones who are into plying. Let's say, and leasing of goods carriage, etc. So hiring, leasing. So covered under section, if you are a person covered under section 44AE or section 44BB or section 44BBB, okay, and he has claimed his income to be lower than the profits or gains so deemed to be the profits and gains of his business. So there are limits specified under section 44AE, BB and BBB. And if you declare your income lower than the profits or gains so deemed to be the profits and gains, then you will have to get your financials audited. Okay, so what are the sections? Let us go through it. So the next point is basically we are going to cover up 3 sections here. Okay, one is section 44AE, okay, 44BB and 44BBB. You don't have to go into the details of these sections, guys, and trust me, whatever I am teaching you in the chapter of tax audit, if you do this much, that is going to be more than enough. But for your basic understanding, let us go through it. 44AE. What is 44AE? I told you. Now the ones who are into 44AE, that this is basically for the persons who are engaged in the business of plying, hiring or leasing of goods carriage, and who do not own more than 10 goods carriage vehicles at any time during the relevant year. So again, see, the purpose is basically for the government is very clear. Now this is just to clear the hardships of small people, small businessmen. I mean, if somebody has a turnover of 2 crores, they might, be small businessman, but then somebody who's having 5 crores, 10 crores, 100 crores of business, of course they are big business people. They can keep accountants, they can maintain their proper books of accounts also, right? So here also it says that if I am into transport business and I have less than, it says I do not own more than 10 goods vehicles, then I can opt for section 44AE. So okay. So sir, how will my income be calculated here? Just for an idea, okay, it says the provision of section 44.3, it is again applicable to every person. Yeah, this is a point that you need to understand. 44AE is applicable to every person. Okay, every person means individual, HUF, firms, LLPs and even companies included here. Okay, contrary to what we covered under section 44 AD and ADA. AD and ADA is only applicable for individual, HUFs and firms excluding LLP, but here 44AE it is applicable to companies also. Okay, now what should be the deemed income? What should be the deemed income? This is a presumptive basis. Okay, so what should be the deemed income? So let's say if a person has, in simple way, if I say, if let's say a person has got 9 trucks, number one thing. So can he avail for, number one thing, can he avail for 44AE? The answer is yes. The answer is yes. Okay. Now let's talk about there are 2 types of trucks basically. Okay, so for heavy goods vehicle, and then other vehicles other than heavy goods vehicle. Okay, so how many are there? Let's say heavy goods vehicle, and let's say others. Okay, so basically heavy goods vehicles are those vehicles wherein the capacity, truck has a capacity of load. So if it is 12,000 kgs, okay, so then it will be considered as, let's say, heavy goods vehicle. Okay, and if I have a smaller truck, then it will come under others. Okay, so what is covered in heavy good vehicle? How will the income be computed? So it will be computed at the rate of rupees 1,000 per ton. Rupees 1,000 per ton of gross vehicle weight for every month. Rupees 1,000 per month of gross vehicle weight every month. Okay, so what does this mean? Let's say out of 9 trucks, I have got 5 heavy trucks and 4 trucks which are other than heavy trucks. So how will the income of this 5 heavy goods vehicle be calculated? Let's say my capacity is 13,000 kgs, I mean 13 tons. Okay, so how will the income be computed? Now it says 1,000 per ton. So my amount will be how much? 1,000 into how many tons each of my vehicle is basically plying, guys? 13. Let's say it is 13,000 tons capacity. Okay, so it will be 13,000 kg, sorry, that means 13 tons. Okay, so 1,000 is the amount into 13 tons, okay, of gross vehicles. And how many vehicles do I have? 5. Okay, and if I want to compute it annually, so this will be multiplied by how much? 12 months. So this is how you can calculate the income. Income will be computed for heavy goods in this manner. Okay, but for other trucks, it says income will be computed at the rate of 7,500 per month. This is not dependent on the capacity of the truck, but rather a flat rate of how much? 7,500 into, let's say, how many trucks do I have? 4. 7,500 for every month. Okay, and of course if I multiply it by 12, so this is how the income will be computed. Are you able to understand this, guys? So if you opt for this method, guys, what is going to happen? Please understand, my income is now calculated under this method, that this is the amount of profit. Okay, I'll not be allowed to calculate the income under normal procedure, wherein this is my receipts and after this is my turnover or receipts and then I deduct all the expenses. No, if you are following this, no deduction in expenses. This is a flat rate basically. This is a presumptive basis. Okay, so let us read the point again here. So for heavy goods vehicles, okay, again just for your understanding, guys, okay, I'm not teaching income tax here. Okay, so but for heavy goods vehicle, it should be what? Rupees 1,000 per ton of gross vehicle weight for every month or part of the month. And for other vehicles other than heavy goods vehicle, it could be 7,500 per month. Okay, if the actual income is higher than presumptive rate, then such higher income can also be declared. So again, if you want to declare more than this, if you are a very good citizen of India, you want to declare more, most welcome. Okay, income tax will be more than happy. But now the point here is, okay, again the same point, you can declare an income at a lower rate. If you wish to declare, you can declare it at a lower rate. But if you do so and your income exceeds the basic exemption limit, then you will be required to maintain the books of accounts also and get your accounts audited under section 44AB. Do you understand this point, guys? So this is again a kind of presumptive basis of taxation, but it is specifically for whom? The ones who are engaged into the business of plying, hiring and leasing of goods carriages. The condition here is that you should not own more than 10 carriage vehicles at any time during the relevant year. Is this clear now? Yes. Okay, so basic thing. Okay, so if you are, again, see, if you have adopted for section 44AE, but then you feel that your income is lesser than this, but it exceeds the overall basic exemption limit, then again you have to get your financials audited. Okay, and similarly, guys, on the similar basis, we are not going to go through the limits and all. Section 44B, it is for computing profits and gains in connection with business of exploration of mineral oil, etc., and it is for non-resident mineral oil exporter. It is for non-resident mineral oil exporter. So we are not going into the depth of this section. Just remember, 44BB is with respect to mineral oil explorers and who are non-resident. Okay, and 44BBB is again a special provision for computing profits and gains of foreign companies who are engaged in the business of construction, civil construction or turnkey power projects. It is for foreign companies. So not very important, but yes, you have to understand that, when I am discussing the applicability of tax audit, under clause C basically, okay, we have 3 sections: 44AE, BB and BBB. AE for transporters, BB basically it is for whom? The mineral oil exporters, mineral oil explorers, basically non-resident people, and 44BBB is foreign companies doing civil construction or turnkey projects. Okay, so this is all about the applicability part. Is this clear to everyone? Yes. Okay, all right. Now, so 5 points are there. Okay, now we have an amendment also here, that we covered this aspect, guys, that if you are into a business, okay, and your turnover exceeds 1 crore rupees in any previous year, then you have to get your financials audited. Okay, but we have a point here. It says, with effect from assessment year 22-23, the threshold limit for a person carrying on business has been increased from rupees 1 crore to 10 crores. Okay, not in all cases. 1 crore is the basic limit for getting your financials audited, tax audit done. But then if in case where cash receipts and payments made during the year does not exceed 5% of the total receipts of payment, as the case may be. So if let's say 95% or more of the business transactions, this is a simple word, if 95% or more of the business transactions are done through banking channels, then the limit of tax audit will be increased from 1 crore to how much? 10 crores. Else it is still 1 crore, guys. Okay, earlier this limit was from 1 crore to 5 crores, but now from assessment year 22-23 it has been increased to 10 crores. Do you get this point? What I am trying to tell you is, if you are into business, 95% of your transactions are done through banking channels, be it with respect to the receiving of payment, or let's say you want to do some expenses, you do it through banking channels. 95% of all your transactions are done through banking channels. Then the turnover limit of 1 crore will now become how much? 10 crores. Is this clear? Yes. Okay, so this is a amendment here. Okay. All right. Now again, few more points, guys. See, I discussed the word turnover with you. Okay, that in case of business, the turnover should exceed, let's say 1 crore. It should exceed 1 crore. Now, what will be the things that are included in turnover? Let us discuss this aspect first, and then we are going to understand few more concepts practically. Okay. But then again, before I go into this part, okay, just one simple thing I wish to ask you. Okay, let's discuss. Okay, before I go with the turnover concept, let us discuss few things. Okay, yeah, we have some examples. Okay, applicability, some examples. These examples are from your study material also, but let's go through it for your better understanding. It says DB Private Limited has total turnover of rupees 10.25 crores for financial year 21-22. So it is a private limited, and they are into maybe business, and they have a turnover of 10.25 crores. So do you think they need to get their financial statements audited under section 44AB? Yes. Why? It's very simple. It exceeds rupees 1 crore, right? Okay. Second, ABC and company, let's say it is a partnership firm. They are engaged in trading of electronic goods. Okay, and they are expecting a turnover of 165 lakhs. That means 1.65 crores for financial year 21-22. Okay, so now tell me, okay, can they go for 44AD? Is 44AD allowed for companies? For companies. 44AD, no. But this is a partnership firm. Yeah, this is a partnership firm. So they can opt for 44AD. So if they opt for 44AD, and let's say, I don't know the portion of the turnover that they have received in cash. Let's say most of them are in cash. Let's say, so how much percentage of the turnover should I deem as their profits? How much percentage of profits? 8%, right? So let's understand. Section 44AD would be applicable to partnership firm. You all know this. ABC and company can declare the minimum profit 8% of turnover, as its turnover during the year is not expected to exceed 2 crores. Okay. And if the firm do not offer presumptive income scheme under section 44AD, it has to get books of accounts audited, because it is going above 1 crores. It is going above 1 crores, right? So, because it is going above 1 crores, but it is less than 2 crores, so you may go for presumptive scheme. But then again, please understand that if you go for presumptive scheme of taxation, you have to declare profits at the rate of 8% turnover. If you want to declare lesser amount, then of course you have to get your financials audited under section 44AB. Okay. Or let's say if you don't want to offer presumptive scheme, okay, if they don't want to offer presumptive income scheme, then again, under which clause will it fall, guys? Still the turnover is more than 1 crore. So will the tax audit be required? Yes, right? Okay. Now, again, one more question. Mr. Anand Khattar, a commission agent. See the name, it's very clear here. He is a commission agent. Okay. He is expecting commission receipts of 137 lakhs. 1 crore 37 lakhs during the financial year 21-22. So the first thing is, can he go for provisions of section 44AD? No, so he cannot get the benefit of section 44AD. So his turnover, because now in respect of commission income is expected to increase 1 crore, he would need to get his accounts audited under section 44AD. Of course, he cannot claim the benefit of 44AD. Okay. All right. Next, again we have a point. Mr. Vishal Raka, owning an agency of Samsung Mobile for the city of Pune. They own an agency. Okay. okay, I did not update this. This should have been what, as per the current, if I go, I updated all the remaining questions here. 21, 22. Okay, so he is an agent, okay, of Samsung Mobile. So for agents, what do you think, guys? He has a turnover of 87 lakhs. Now tell me. So of course 44 AD is not applicable, okay, and even if it is not applicable, let's say his income is less than what, 1, his turnover is less than 1 crore. So what do you think? Since his income, commission income does not exceed 1 crore, therefore he does not need to get his books of accounts audited under section 44 AB. Is this clear? Yes, okay. Now a very simple question, let me just ask you, okay, though it has not been asked in the exam and all, but it might come into your mind, guys, okay. I told you that a person can have multiple sources of income, okay. Now let's take a case, okay. Let's say there is an individual, okay, Mr. X. His income from let's say, you know, he is carrying business also and he is into profession also, okay. He is into business as well as profession. Now I told you, like for let's take the example of doctor. When he checks his patients, he is professional. He is a profession. The income will be a part of profession. But let's say he is selling medicines also, it will be considered as what, business, right? So let's say this Mr. X has business as well as profession, okay, and his turnover from business, let's say it comes to rupees 80 lakhs, okay, and his gross receipts from the profession, it comes to rupees 25 lakhs, okay. Now I want to ask you all, should Mr. X get his accounts audited? What do you think? Yes. The total is how much? Turnover is 80 lakhs. Gross receipts of from professional work is 25 lakhs. So in a way, total comes to how much? Total receipts, if I consider turnover and gross receipts, it comes to 1.05 lakhs. Okay. So yes, what do you think? Should he get tax audit done? No, answer is no. Yes. So don't get confused that that his overall because turnover and receipts combined together, it is increasing 1 crore, so he will have to get its financials audited. No, the institute has clearly mentioned in the guidance note that for the applicability of tax audit, your income from business should be above 1 crore. Your income from the profession should exceed 50 lakhs. This is clearly mentioned in the guidance note. So in this case, Mr. X will not be required to get his financials tax audited under section 44 AB. Is this clear?
Yes, sir.
Yes, okay. So this was, guys, with respect to the applicability part, but yes, again we have to learn a lot about the basics also. So apart other than this, now because we have been covering the word turnover, okay, let us understand now what turnover means. Very simple topic. So let's understand the inclusions and exclusions in turnover. Okay, so I told you that this is the amount, let's say turnover exceeds 1 crore, or let's say in case of 44 AD also, the turnover should not exceed 2 crores. So but what is to be included or excluded from the word turnover? Okay, so let us understand. Now if there is any discount allowed in sales invoice, discount allowed, okay, so if you have allowed discount, this has to be deducted from turnover. Okay, but then if I talk in practical terms, guys, generally how is the accounting done? Now if an item of 100 rupees is sold, okay, and 10% discount is given, so 90 rupees we are getting, right? So the sales entry will be made for 100 or 90 rupees. Generally, practically what is done, it will be 90 rupees only, right? But then this is just for the from the perspective of solving questions, from the student's perspective, right? They might give you a question wherein they write total turnover 100 and then they say sales discount separately it is given of, let's say, rupees 10, then you will have to deduct it. Okay, but practically when you are doing tax audits, generally how is the entries, how will the client be making the entries? He is going to record sales to the tune of rupees 90 only. Do you agree with me on this? Yes. So this is only, you have to discount, you have to deduct sales discount allowed in the sales invoice only for the purpose of solving the questions. If it is mentioned in the question that this is a turnover and it is mentioned separately that this is a discount allowed, so then you have to deduct. As in practical life, we don't do it, right? Okay, because it is already done. Now, if cash discount is given other than that allowed in cash memo or sales invoice, it is not deducted. Cash discount is generally given for prompt payments and also not deducted. Turnover discount deducted from turnover, you can deduct it. If you are giving some rebate, then deducted. If the rebate is in nature of commission on sales, okay, commission on sales. If the rebate is on the, if you are giving commission on sales, it is not deducted. It is a separate expense, right? You don't have to deduct it from the turnover. Okay. If it is a case of sales return, guys, of course you are going to deduct it from the turnover, and sales return may pertain to current financial year. It can be for earlier years also, current year plus any previous years. Okay, so sales return can be for current year, previous years, whatever you can deduct from the turnover. Then sale proceeds that you get from selling fixed assets, investments, and the shares and securities that is being held as investments. Okay, then this is not a part of your turnover, right? Investments, share and securities, if it is held as investment, it might be a case of capital gain. We are not going to include it in our turnover, so the question of deducting it doesn't arise. It is not a part of turnover. Okay, but let's say you are holding some shares and securities as a part of, it is your stock and trade, you are into business of dealing in shares and securities, then it is included in your turnover. Okay, so very simple, guys, very simple thing. But why did I cover this? Because we have a question on this. Okay, a very simple question, and it is there in the study material also. So let us understand this. Okay, so it says a company, Concession Limited is a company who is into a business of manufacturing of threads. Okay, the company is expected to record turnover of 1.13 crores during the financial year 21-22 before adjusting the following. So adjustments has not been done. This is what they are saying. So this is the turnover. This is the turnover that they are expecting, or let's say recorded turnover. Okay, 1.13 crores. So discount allowed in sales, should this be deducted? What do you think? Yes. So I'm just putting a minus here. Okay, cash discount otherwise than allowed, this will not be deducted. Trade discount, guys, should it be deducted from turnover? Yes. Okay, trade discount, so it was there, right? Yeah, cash discount shouldn't be given. Trade discount, of course, it is going to be deducted. Okay, commission on sales, it is a separate expense, guys. You cannot deduct it from your turnover. Okay, it will not be deducted. Sales return, how about sales return? And it pertains to 16-17. So I told you any previous year, so this will be deducted. Okay, and sale of investment not included above. Sale of investments, so it is not even a part of, turnover. Okay, so what will be the turnover now? So 1.13 crores, what do we have to ascertain? Basically, what is the question all about? You are required to ascertain the effective turnover to be considered for the prescribed limit of tax audit. So we have to check the applicability of tax audit. That's it. Okay, so again, so how should we proceed? So the recorded, let's say this is a turnover 1.13 crores. These three things will be deducted. 8.20 lakhs, 2.90 lakhs with respect to trade discount, sales return. So effective turnover of this is this now. So do you think because it is greater than 1 crore, should they get tax audit done? The answer is yes. So the expected effective turnover of concession limit is over and above the prescribed limit for tax under section 44AB of Income Tax Act. Hence, they would be liable for tax audit. Clear, guys? Yes. Very simple point. Okay. Now, having understood the applicability, having understood the meaning of the word turnover, now let us understand a very basic thing. Okay. So what if the client doesn't get tax audit done? Okay, you know this. If you work in the office, you must be very familiar with this thing. Okay, and generally we always tell, it is a tendency of all the clients to come very late. During generally they come towards the close of the towards almost near end of the due date, basically. Okay, towards the close or when the dates, the time left is very less, they generally come then. And then of course sometimes we also have to call them up and say that you have to get your tax audited done, or else this much will be the penalty. Okay, this is how we generally talk, right? So what is the penalty for not getting tax audit done? A very basic point. Now it says 271B. if any person is required to comply with the section of 44AB fails to get his accounts audited in respect of any years or years as required under section 44AB, the assessing officer may impose a penalty. So it is not a compulsory penalty, but yeah, AO may impose a penalty. What will be the quantum of penalty? The penalty shall be lower of the following amounts: 0.5% of the total sales or turnover or gross receipts as the case may be in the business, or gross receipts in profession in such a year. So 0.5% either of your sales, turnover or gross receipts, or rupees 1.5 lakh. So lower of this, lower of the two will be the quantum of the penalty. Okay. But then again, according to section 273B, guys, no penalty shall be imposed if reasonable cause for such failure is proved. So if there was COVID or some other case, etc., if you prove it, the assessing officer may not impose such penalty if reasonable cause is basically proved. Okay, so this is a very simple point again. So penalty for not getting the tax audit done. Okay, so 0.5%, lower of 0.5%, or let's say 1,50,000. Okay, now the next topic. Okay, see, a few more fundamental things we have to do. We are now going to learn about who can be the tax auditor, okay, and then once we are done with this, guys, once we are done with the concept of who can be the tax auditor, we are going to start with basically the tax audit report, which is the most interesting part and the bulkiest part of the entire chapter. We are going to learn about the different forms of tax audit report and the statement of particulars also, form 3CD, wherein we have to understand each of the clauses. So it is going to take time. So this is primarily the most time consuming, and I could also say the important part of the entire chapter. Okay, but let's start with the auditor first. Who can be the tax auditor? Okay, so in very simple terms, guys, if I say who can be tax auditor, now tax auditors can only be chartered accountants who are in practice. I mean that they have to have what? A COP with them. So chartered accountants in practice can be the tax auditors, right? So let us understand the word meaning here. The term accountant. So as per the act, it says the term accountant, you have to get your financial statements audited by an accountant. So what is the meaning of the word accountant? The term accountant has been defined under in subclause 1 of explanation to section 44AB as under. So I'm just reading it out. Okay, you don't have to go through this in detailed manner, but rather you will feel that all this eligibility criteria and the disqualifications that we are going to cover, it is mostly same as that you are going to cover in the company audit portion, or you must have covered in CA intermediate level, right? But then there are certain differences. Let us be quick rather. Okay, so it says accountant shall have the same meaning as explanation given below. What is the explanation? Accountant means chartered accountants as defined in clause B of subsection 1 of subsection 2 of the Chartered Accountants Act, who holds a valid certificate of practice. Nothing more to understand, I have mentioned here. Chartered accountant who holds a valid certificate of practice, he has to be the tax auditor. Okay, but then again, we have to understand some points here. Okay, some disqualification. Now, if the SSC is a company, if my SSC is a company, in case of company, okay, in case an SSC being a company, the person who is not eligible for appointment as auditor of the said company in accordance with subsection 141 subsection 3 of the Companies Act. So 141(3) is basically with respect to the disqualifications of auditor. There are 9 disqualifications. It cannot be a body corporate. He should not be officer or employee of the company. He should not be the partner or under employment or of the officer or employee of the company. All these points. Okay, 141 subsection 3. So there are 9 disqualifications there. Okay, so if the SSC is a company and the CA firm is disqualified to be the auditor of that company, to be the statutory auditors of that company, then they cannot become the tax auditors also. Okay, so the point here is, in case of SSC being a company, the person who is not eligible for appointment, I mean if you attract the disqualifications as per Companies Act, then you cannot become the tax auditor also. Is this clear? Yes. Okay, now in other cases, the SSC himself, or in case of the SSC being a firm, the SSC himself. Now, when can an SSC be, it says the SSC himself, or in case of the SSC being a firm or association of persons or HUF, any partner of the firm or member of the association or the family. So in other cases, basically other than companies, in other cases basically other than companies, okay, who cannot be the auditors, the SSC himself cannot be the auditor, or let's say if they are a firm or association of persons or HUF, any partner of the firm or member or the association of family, they cannot become the auditors. Okay, so we are primarily doing what? So we are understanding the disqualifications, guys. If it is a company, all the disqualifications as per Companies Act. If it is a so if I write in short, HUF, basically if members cannot be the auditors, of course independence will not be there. Again in AOP, members cannot be the auditors. These are the disqualifications. Okay, if let's say it is a partnership firm, the partners cannot be the auditors. Okay, now you must have seen this, guys. A very simple example, let me take you. In the CA firms that you are working for, do they get their financials audited? I'm just asking you this. Your CA firm wherein you are the article, have you ever seen whether the financials, whether do they get their financials audited? What do you think? Okay, can a chartered accountant opt for 44 ADA? ADA is for whom? Professions, right? Yeah, so let's say, so a CA firm, if they don't want to declare income of less than 50%, if they want to declare income lesser than 50%, they have to maintain books, and of course when they maintain books, they have to get it audited. Now I am a chartered accountant, this is my firm, can I do the audit myself? No, I'll have to get it done through some other auditor, right? So what I'm trying to tell you is, partnership firm, okay, of course the partners cannot, even if they are CAs, they cannot do the audit. Okay, for company, what was the points? Same as what? Same as 141 subsection 3, the disqualification. So for HUF, members cannot do, AOP members cannot do. For partnership firm, the partners cannot do. Okay, now if it is a trust, who cannot be the auditors? Okay, so in case of trust, please remember the author of the trust. Author basically is the let's say founder kind of person who contributes initially for the creation of the trust. So if he is an author of the trust, or let's say any person who has made substantial contribution, if any person has made substantial contribution. Now what do you mean by substantial contribution? It simply means contribution up to the end of previous year greater than 50,000 rupees. Okay, so if I have made contribution in a trust, I cannot do the audit of trust. So substantial contribution. Okay, and third point, whether any such author or founder or person is HUF, a family member. So if HUF, if this author is HUF, let's say if this author is an HUF, it might so happen that a trust has been formed and the major money, for incorporating the trust has been given by HUF. So if the author is an HUF, then all the members of the firm. Okay, so let me write it in this way, in the point of author only. If HUF, if author is an HUF, then all members. Okay, it has become a bit clumsy, but please understand. Okay, what did I say? See, in case of trust, who cannot be the auditors? The author cannot become auditor. Okay, but if the author himself is what? An HUF, then all the members become disqualified. If somebody has got substantial interest, then he becomes disqualified. Okay, and then any trustee or trust or manager by whatever name called of the institution. So the trustee or managers also cannot become the auditors. Now there is a difference between trustee and managers. Trustee are the persons or managers are the ones who manage the trust, but the ones who founded the trust is called the author. Okay, so the author himself, or if the author is a HUF, the members of HUF will be disqualified. If anyone has given substantial contribution, then he shall be disqualified. And if in case of trust, he is a trustee or manager, then he is going to be disqualified. Is this clear?
Yes.
Yes. Okay. Now, all right. Again, in case of any person other than persons referred to in sub clauses 1 and 2. So in here, okay, we are doing the case of other than companies. We are studying the case of auditors for SSCs who are other than companies. Okay, so in case of any person who are not covered in these two points that we have just covered, the person who is competent to verify the return under section 139 in accordance with the provisions of section 140. So a person who has to verify the return, who is competent to verify the return under section 139. So you all know this, guys. Once when a return is uploaded, do we need to verify the return? How is the verification done? How is the verification done?
Through OTP.
through OTP, if it is linked with Aadhaar and all. In some cases, let's say my Aadhaar was made very late, because in Northeast the provision of the Aadhaar, there were some issues, so we used to go for DSC. Can returns be verified through the help of digital signatures also? Yes. So for other SECs, people who are authorized, to file return, or let's say to verify return under section 139. In case of company, who verifies the return? Yes, कंपनी का रिटर्न लगाया है, कंपनी का DSC होता है क्या? नहीं, कंपनी का नहीं. So representative will be there, right? Directors. All right. So in case of other SSCs, we are not discussing about companies. In case of other SSCs, people who are authorized to verify return under section 139. Okay. Now these are the basic things. These are the basic things. Okay. So but again, what did I tell you? For companies, it is same as 141 subsection 3. HUF members of the HUF cannot be the auditors. AOP, the members cannot be the auditors. For partnership firm, the partners cannot be the auditors. For trust, the author cannot be the auditor. And if the author is HUF, the members cannot be auditor. If somebody has given substantial contribution, then he cannot be the auditor. If somebody is a trustee or manager, cannot be the auditor. In case of other SECs, people who are authorized basically to verify the returns under 139, again, who are competent basically to verify the returns under section 139, they cannot be the auditors. Okay. Now again, some very basic points. Any relative of any persons referred to in sub clauses 1, 2 and 3. So you know the definition of relatives as per Companies Act. Any relatives of the points 1, 2 and 3 that we have just covered. Okay. Is there any lag between what I am saying and or the video is fine?
Fine, sir.
It's fine. Okay. All right. Okay. Then again, we have few more points, guys, with respect to these. I mean, other than companies, and mostly the points will be that of company. Okay. So let's understand. An officer or employee of the SEC. Of course, if you are an officer or employee of the SEC, you cannot be the auditor of the SEC. Which SEC are we discussing, guys? Other than companies. So few more disqualifications. You cannot be officer or employee of the SEC. The next 3-4 points that we are covering now, this is all as per Companies Act, similar to Companies Act. Okay. An individual who is a partner or is in employment of an officer or employee of the SEC. So you have to ensure independence while you are doing tax audit, right? So if I am employed by the SEC, I cannot be the tax auditors. Okay. Or let's say if I am into some business. I mean, I am, let's say, an individual who is partner or who is in employment of an officer or employee of the SEC. I cannot be the auditor. Okay. An individual who or his relative or partner. So either me, my partner or my relative, if they are holding any security or interest in the SSC, if I am indebted to the SSC, or if I am given guarantee or security in connection with the indebtedness of any third party. So if you compare, guys, this is nothing, of course we are doing it for SSCs other than companies, but if you compare, this is nothing but 141 subsection 3 clause D. This is clause B, this is clause, not this two, this is clause B, this is clause C. So 141 subsection 3D, this is again subclause 141 3D1, 3D2 and 3D3. Very important sections of Companies Act disqualification. And of course, we have certain limits also. So for this, is holding any security or interest in the SSC. For this, we have provided that the relative, exemption has been given to relative. Relative may hold any security or interest in the SSC of face value not exceeding 100,000 rupees. Okay. So it says for SSCs other than companies, a CA cannot be the officer of employee, partner, employee of the officer, or he cannot basically, hold any security interest or in the SSC. Okay, but for the relatives, there has been an exemption that the relatives may hold security or interest in the SSC of face value. Face value, please remember, it is face value, similar to the Companies Act. Okay, not exceeding 100,000, provided that the relatives may be indebted. So with respect to indebtedness, relatives may be indebted to an SSC for an amount not exceeding 100,000 rupees, and again, if we have given a guarantee or security in connection with third party, then relative may again give guarantee or provide any security with indebtedness of any third party to the assessee for an amount not exceeding 100,000 rupees. Okay, so this is similar to what we have covered. Not very important, guys, but yes, because it is in a part of syllabus, let us go through it. You never know, MCQs. All right. Okay, and then again, a person who has got business relationship with the assessee. So if I am a chartered accountant, but let's say I have got business relationship with the assessee, then I cannot be the auditor. And a person who has been convicted by a court of an offence involving fraud and a period of 10 years has not elapsed from the date of such conviction. So these points are same, very same, though the limits are a bit different. The limits here are a bit different, but these points are same, guys, that you are going to cover under section 141 subsection 3 of the Companies Act. Okay, so this is, guys, with respect to tax auditors. So in short, please remember, it has to be chartered accountant holding COP. Is this clear, everyone? Yes. Now, generally, guys, if I talk in very practical terms, what happens? Okay, let's say these are the financial statements, okay, which has been prepared by whom? This is a client, let's say X Limited. This is a client. They are company. They must have maintained their books of accounts. Okay, it is compulsory for them. So they have, let's say, maintained their books of accounts, and this is the financial statement. Let's say there is an auditor, CP and company. Okay, he is doing the statutory audit of this company. Statutory audit. Okay, now when he is doing the statutory audit of the company, he is going to go through the books. He is going to check upon the internal controls, everything, right? And he is going to check whether the financials have been made as per FRF, it is giving true and fair view or not. So my question to all of you is, can CP and company now be the tax auditors of this company? Yes. What do you think? This is a very basic thing. आप लोग प्राची, आपके ऑफिस में कंपनी क्लाइंट्स नहीं है क्या ज्यादा? ऐसा होता है तो अरे see, think from the perspective of X Limited. Okay, very practically let us understand. Okay, they must have been paying fees to CP and company for doing the statutory audits. Yes, and CP and company during the course of the statutory audits, they must have gained information, so much of information about the accounts, of course, the entire financials, internal controls, etc. So in a way, if they only do the tax audit, don't you think that half of the things are already done? I mean, they have already checked the books of accounts and all, internal controls, etc., everything. So X Limited also will relatively have to pay them less fees. But if they hire altogether a separate chartered accountant, let's say PC and company, and they have asked them to do tax audit. Now, for PC and company, they have to do things again which CP and company was already done in statutory audit. Okay, they will again have to go through the books of accounts, understand a bit of internal controls, etc. So probably the fees here charged by PC and company will be higher. So practically what I am trying to tell you is, why did I take up this explanation? The purpose was to make you understand that from the perspective of client also, it is simpler for them only then when there is only one auditor who is doing the statutory audit also and tax audit also. And for the auditor also, it is very convenient. So practically, this is the situation, that statutory auditor in most cases is the tax auditor. But of course, it is upon the client, they can have different auditors also. So my point of discussion, final conclusion is that the statutory auditors can be the tax auditors. There is no harm in it. Is it clear, everyone? Yes. Okay. But now we have few more points here with respect to the tax auditor. It says a chartered accountant firm, or let's say it's a chartered accountant or firm of chartered accountants who is appointed as a tax consultant of the SSE. So let's say there is another CA firm now, A, B and company. They are only advising X Limited. They are giving tax consultancy. Now, can they become the tax auditors? What do you think? They are giving tax advice, so they can become tax auditors, yes or no? Yes, okay, all right. Okay, one more question. X Limited, let's say they have internal audit function. I mean, they have a separate function of internal audit in their organization, and it is headed by CAX. Can CAX become the tax auditors? What do you think? Now CAX, is he under employment, yes or no? Is he an officer of the company? Is he an under employment of the company X Limited? Even though he is a chartered accountant, he is heading the internal audit function of the organization. Now do you think will he be independent while doing tax audit? No, so he cannot be the tax auditors, right? So we have a point here to understand. See, it says tax consultant of the SSC can conduct tax audit, not a problem. Okay, so in simple words, if I write, if I am a tax consultant, okay, I can be the tax auditor. There is no problem in it. Okay, but an internal auditor of the SSC cannot conduct tax audit if he is an employee of the SSC. Okay, so if I am an internal audit, and I am employee, so I cannot be the tax auditor. Okay, but again, see, now internal auditors can be of two types. Did I not tell you in the chapter that either they can be employed by the organization or they can take the services of an external CA firm? Okay, so here let's say X Limited can either have internal audit function or they can ask AB and company, a firm of CA chartered accountants, to be their internal auditors. Yes or no? Now relatively, if I compare the two cases, out of let's say part 1 and part 2, in which part, do you think independence will be more? What do you think, in part 1 or part 2? Part 2, they will be more independent, right? And they will conduct the audit more independently, right? But then, so if I think, I feel that they can be the tax auditors. But then again, council, ICI, guidance note, it clearly says, please understand, let's understand this. The council of ICI has decided that an internal auditor of an SSC, whether working with the organization, whether they are under employment of the company or independently practicing accountant or firm of, cannot be appointed as tax auditor. So please remember, even if they take the services of AB and company, they cannot become tax auditor. Because ultimately, please understand, tax audit is a statutory audit. The department will expect highest levels of independence from the chartered accountants. Okay, so if you are associated with this company, in the capacity of internal auditor, you must have been very familiar with the management. You almost go to the client's place on monthly basis, regularly 10-15 days in a month. So again, so that is why the council basically has put a restriction. There is no restriction from the Income Tax Act, but the council has put a restriction that if you are the internal auditor of a company, whether in the capacity of as employee or as a individual independent firm of chartered accountant, but you cannot be the tax auditors. Is this clear?
Yes, sir.
Yes, okay. Alright, now coming to the most interesting part of the chapter. Okay, we are now going to start with what you have been doing in the offices. We are going to learn about the tax audit reports. Okay, so we have basically got two forms of reports, two formats of reports. These are the tax audit reports, and form 3CD is, as such, we call it as statement of particulars. Okay, so again, let me be very clear on this. A lot of you might have this question in the mind. Okay, this statement of particulars, it contains a list of clauses. Okay, now practically, what actually is the case? Let me tell you. X Limited, let's say this is our client. Okay, they have to prepare form 3CD, needs to be prepared by the client. Form 3CD needs to be prepared by the client, and then whatever information they give in form 3CD, it has to be audited. It has to be verified by a tax auditor. And once he verifies that what the contents of form 3CD, he gives an opinion whether the contents of form 3CD are true and correct. Please remember, please check on the word here. We mentioned whether the contents of 3CD are true and correct. Okay, but I am very sure, Prachi, आपको भी ऐसा लग रहा होगा कि what is sir saying? In most cases in your firms, you are the ones who are preparing that 3CD report. Yes or no?
Yes.
Right, yes, but it is not our work. It is not our work. Say if I talk in practical terms, in most cases, in case of smaller firms, it is the chartered accountant who prepares the financial statement as per Schedule 3 and then he only audits. Yes or no? Client hardly knows anything, right? But of course, if you are the auditor, you cannot prepare the financials. This is prohibited under section 144. But it is not that everything goes as per the law. So this is something, of course, this is a work of the client to furnish Form 3CD, and we just check the details whether whatever they have furnished it is true and correct or not. Okay. So Form 3CD is basically statement of particulars. Statement of particulars to be filled by the client. This is what you have to remember. But these two, Form 3CA and 3CB, are basically reports which is furnished by the chartered accountant in practice, by the tax auditor. So what is the difference between the two? We can give, in different scenarios we have to give different reports. So it can be either Form 3CA or it can be Form 3CB. So now let us understand, when will a tax auditor issue Form 3CA or let's say Form 3CB. Okay, so there are two tax audit reports format. Form 3CA. This form is to be used in case of person who carries on business or profession and who is required by or under any law to get his accounts audited. So if we have a client, okay, and they have to get their financials audited under any other law also, any other law, then the auditor is going to issue which report under tax audit in the format 3CA, Form 3CA. Okay, now for example, in case of a company, do companies need to get statutory audit done under section 139? Yes, appointment of auditors is done, audit is done, right? So because in case of companies, audit is already done as per Companies Act 2013, let's say, as per the Companies Act. So in case of companies, okay, let's say X Limited is my client and I am the tax auditor. So which form will I be now using to give the tax audit report? This will be Form 3CA. Why? Because they have already gotten their financial statements audited as per the Companies Act. Do you all understand this? Yes. Now let's talk about partnership firm or an individual. Is an individual or partnership firm required to get their financials audited under any other law except for income tax? Do you think so? Does Partnership Act specify anything about audit? The answer is no. No. So the partnership firms, they don't have to get their financials audited at all. They only have to get it audited under Income Tax Act, right? So in that case, which form are we going to use when we issue our report? Which format? It will be basically Form 3CB. It will be Form 3CB. Is this clear? Yes, okay. Now, other than companies, let's take the example of cooperative societies. Now, cooperative societies also, they have to get the financials audited. So, in case of if I am doing the tax audit of a cooperative society, which form will I be issuing? It will be Form 3CA. Fine, everyone? Yes, okay. Now, a very important point to understand here is, it says, in case of a person, we are discussing Form 3CB now. In case of a person who carries on business or profession but who is not required by or under any law to get its accounts audited, let's say it can be individual, it can be firm, partnership firm, etc. Okay, the audit report has to be given in Form 3CB. So if they are not required to get their financials audited under any other law, we shall have to give Form 3CB. Or there is one more requirement, or when the accounting year of the SSC is different from the financial year. When the accounting year of the SSC is different from the financial year. Very important point. Okay. Now let's say there is a company, okay, and it has got a subsidiary in India. There's a company which is headquartered somewhere in Europe and they have got a subsidiary in India. Okay. Now this subsidiary company in India may follow any other accounting year. I mean, they have to take the permission of ROC. Let's say they are following January to December. It is a company. Okay. Let's say Y Limited. It is a company, but they are following which financial year? I mean, let's say they are following the calendar year. They may take the permission of ROC and they may do it. Okay. Even though it is a company, they will have their financial statements audited as per Companies Act, yes or no? They will have their but the financial year will be what? January to December. They will have their financial statements audited as per Companies Act. But in this case, income tax only understands what? April to March. Income tax only understands April to March. So then, if this is the case, even though they are a company, they are getting their accounts audited under Companies Act, but because the calendar year, I mean the financial year accounting year is different, again in this case, the auditor, when the tax auditor in case of Y Limited, he will have to rearrange the financials as per this and because of this, they have to issue which form, which audit report, in audit report under Form 3CB. Okay, so please be very careful. When the accounting year of the SS is different from the financial year, then you will have to use Form 3CB even if it is a company. Is it clear to everyone? समझ आ गया?
Yes, sir.
Yes, even if it is a company, don't get confused. Just by seeing the word company, you will tick Form 3CA. No, if they are following a different financial year, I mean, which is when they are following an accounting year which is different from our financial year is April to March, right? So then in this case, again the auditor will have to give Form 3CB. Okay, is this clear? Right. Okay. Now, what is Form 3CD about? Again, the first thing which I always tell is it is not prepared by the auditor, it is prepared by the management, the client. Okay. So it is statement of particulars wherein we are going to learn about 44 clauses, though each clause has got many parts, so around about 50 clauses now. Okay. So the statement of particulars given in Form 3CD as annexure to the audit report. So whatever format of report we are giving, be it in Form 3C or 3CB, we have to annex a report, a statement of particulars, which is Form 3CD. Okay, and it contains 44 clauses. The tax auditor has to report whether the particulars are true and correct. The tax auditor has to report whether the particulars are true and correct. Is this clear?
Yes.
Yes. Now, a very basic thing, guys. Perhaps I don't know whether you have seen it in your office or not, or whether you have been, told by your principal or not. See, there are two forms. When I talk about tax audit report, TAR, tax audit report, either the auditor is going to give Form 3CA or it can be Form 3CB. Okay. Now please understand, in Form 3CA, what are the cases wherein Form 3CA is given? Cases where financials have already been audited. Okay. Now please understand, if the financials has already been audited, okay, so the tax auditor, he just needs to see basically whether the particulars in Form 3CD which the management has prepared is true and correct or not. So please be very careful, guys, on what I am saying. Please be very attentive. So when I am giving the tax audit report as per Form 3CA, okay, I only state whether the particulars given as per 3CD is true and correct. I only give this opinion that whether the particulars as per 3CD is true and correct. Why? Because the financials has already been audited under some other act. It has been audited by some other auditor. So I, as a tax auditor, will only resort to this opinion that the Form 3CD has been prepared by the management. It is giving true and correct view. But on the other hand, Form 3CB are those cases wherein the client has not been audited under any other law, right? So in this case, guys, please understand, we have to report on two things: that whether their financials, let's say the profit and loss account, balance sheet, whether it is giving true and fair view or not. And at the same time, we also have to report whether the statement of particulars in the Form 3CD, is it giving true and correct view or not. Okay, so if you see in your office next time when you do an audit, the format of 3CA is small, okay, and 3CB will be a bit elongated, I mean longer than if you compare with Form 3CA. Why? Because in this case, in Form 3CB, the auditor issues two opinions. Okay, one is on the financial statement and the second one is on Form 3CD. Okay, for your better understanding, in order to make you understand things, okay, what I have done is I have just given a format here. Okay, format of tax audit report. This is 3CA. So this is the size. Okay, it ends up here. Okay, these are the 3 points that we have to mention. We are going to go through it, but again, when I take you to the format 3CB, see, so many number of points. The size of the audit report is relatively bigger here. Okay, so let us go through the points, what it says. I am going through Form 3CA for your understanding. Okay, so Form 3CA, audit under Section 44 AB of the Income Tax Act in case where the accounts of business or profession of a person have been audited under any other law. So how do we report? I or we? If I am an individual chartered accountant, I'll use I. If we are a firm of chartered accountants, we'll use we. So we report that the statutory audit of measures, the name and address of, and with permanent account number of the SSC is going to come, was conducted by us, the name of the firm will come in pursuance of the provisions of section 44AB of the Income Tax Act. Okay, this should have been in the next paragraph. And we annex here to, please understand, we annex here to a copy of, now please understand, it says our or their audit report dated along with a copy of each. So if, please understand, this is a X Limited. Okay, the statutory audit was done by us. I am CP and company, and tax audit is also done by us. Okay, so if statutory audit is done by us, what language are we going to use? We annex here to a copy of our report, audit report dated this. This is which report they are referring to? Report of company's audit, report under company's audit. But let's say I told you, it might so happen that it has been done by totally some other firm, A, B and company. It has been done by some other firm. Then also we are going to annex their audit report and their financials and the financials in our audit report, in our tax audit report. So please understand, in our tax audit report, we are now going to annex the audit reports of as given by AB and company along with the financials. Okay, so please understand this. It says, and we annex here to a copy of our or let's say it can be their audit report dated along with a copy of each. So audit report will be there. I'm just highlighting it again. Audit report will be there along with a copy of profit and loss or income and expenditure account, balance sheet, as well as the statement of cash flow. Okay, in case of company. So there will be balance sheet, cash flow, etc. Okay, do you get this point, guys? So there will be, I have to annex audit report, PL, balance sheet and cash flow. Whether it has been audited by me or some other auditor. Some other auditor's report also I'll annex to my tax audit report. Do you understand this or not?
So whether we consider that.
Sorry?
Whether we consider their opinion, whether it is disqualified.
See, we are not giving an opinion at all in this case. No, we are not giving opinion in case of financial statements at all in this case. See, we have just mentioned that it has been audited. We are attaching their audit report and we are attaching the financials also. Whatever opinion they have given, we have just attached it. What opinion in tax audit are we giving upon is only the particulars of Form 3CD. So read this point. The statement of particulars to be furnished under section 44AB is annexed herewith in Form 3CD. So we annex Form 3CD also now. Okay. Now this is the most important point that you have to remember. In my opinion or our opinion, and to the best of our knowledge and according to the information of books of accounts, including other relevant documents and explanation given to us, the particulars given in the said Form 3CD are true and correct. So we are only issuing one opinion. The other opinion on the financial statements have already been issued either by us or some other auditor. So in tax audit report, we are only going to issue one opinion with respect to Form 3CA. Is this clear now, Sudhir?
Sir, but is in certain matters whether they are qualified few things.
Yeah, of course, we can consider the same while evaluating the accuracy of Form 3CD. We can also give a qualified opinion if the same persists. Yes, of course. Okay. Alright, so are you able to understand this, guys? So in this case, in case of Form 3CA, we are only expressing the tax auditors is only giving one opinion, which is basically whether the particulars of Form 3CD are true and correct or not. And then of course audit report ends. You all know this. Firm name, chartered accountants, FRN number will be there, the signing partner, his membership number, date, place, etc. All this you all know, right? Is this clear, guys? Form 3CA. Okay. Let's go through Form 3CB also. Okay. So same points we have examined, the balance sheet, PL, etc. Permanent account number. Now please understand the point number 2 is different. Okay. We certify that the balance sheet and profit and loss, income and expenditure are in agreement with the books of accounts maintained at the head office. So the financials are in agreement with books of accounts. They are certifying this, and we report the following observations, comments, discrepancies, inconsistencies, if any. Okay, what is the point? Let's see. We have obtained all information and explanation which, to the best of our knowledge and belief, were necessary for the purpose of audit. Second, in our opinion, proper books of accounts have been kept by the head office. Third, to our best information and knowledge, and according to the explanation given to us, the said accounts read with notes, if any, give true and fair view. Okay, and true and fair view as to what? The statement of affairs of the SSC, that means the balance sheet, and profit and loss account of the SSC. So please understand, we are doing an extra audit here. In case of 3CB, we are checking the financials also, because it has not been audited under any other audit. So we are going to give two opinions here. One is with respect to true and fair view, and then if you see, the 2 points are same, that they have annexed form 3CD here, and secondly, that to the best of their knowledge and explanation given to us, the particulars of form 3CD are true and correct. So we are again going to issue two opinions here. Is this clear to everyone? Right? Great. Okay. So I have taught you the formats of audit report, right? But again, this audit report, now if I tell you guys, okay, so let's say this is our tax audit report. This is my tax audit report. Now let's say this is form 3CA. Okay, now what all things should I be attaching with this form 3CA? Now again, audit report as per Companies Act, yes or no? And along with this audit report, of course, the financial statements, the notes to accounts, cash flow will be attached, and also of course, because I am doing tax audit, 3CD will also be there. So this is how bulky the tax audit report ultimately becomes, overall tax audit report. Do you get this point? Yes? Okay. But if I am giving 3CB now, my tax audit report will be there. Okay. Of course, these two things, the financials will be there. Financials will be there and 3CD will be there. But on this financials, I am giving opinion in this tax audit report itself. Do you get the difference point, guys? Is it now super clear? Yes. Great. Okay. All right. So this is form 3CB, and coming to form 3CD, guys. 3CD is with respect to what? The clauses of the statement of particulars. Okay, so we are going to start with the clauses. We have to understand each and every clauses. Some clauses are going to be very simple, like first 8 clauses, which is part A of 3CD form. It is not even going to take 2 minutes, first 8 clauses. Then few clauses wherein I have to explain you the provisions of income tax. Then we might take certain time, but yes, I'll try to do the best justifiable thing for you, which is going to be very relevant for your exams from auditing perspective. We'll cover all the questions that has been asked, and I'm going to cover all the clauses. But of course, I know that, okay, in which particular clause I need to devote what amount of time. Okay, so as per the relativity importance, I'll be devoting the time. Okay, so we'll be covering the clauses in the next session. All right, so now that you understand the contents of form 3CA and form 3CB, let us now understand form 3CD. Again, let me tell you, 3CA and 3CB are basically the formats of tax audit report, but the statement of particulars, the clauses that Income Tax Act wants to know about, it is given in form 3CD, the statement of particulars. As an auditor, we are going to verify whether the particulars given by the SSC in form 3CD is true and correct or not. Okay, so what are the particulars? So I've been telling you guys that there are 44 clauses as such, but yes, there are some clauses, I mean parts, etc. So there are ultimately more than 44 clauses, but yeah, in a way there are 44 clauses that we have to cover. Okay, so form 3CD, statement of particulars, okay, to be furnished under section 44AB of the Income Tax Act 1961. Now under this format, guys, we have got two parts. This particular statement we are going to cover in two parts. One is part A, which is very simple, which is more about the entity, that more about the SSC, rather the correct word should be SSC here. Part A is more about the SSC, okay, the basic information about SSC, and then we are going to cover part B also, which is basically again more details about the business, about the various provisions of PGBP, etc. Okay, so we are going to cover the statement of particulars in two parts. Let us start with part A, very simple part. Okay, very simple clauses under part A. We have to cover 8 clauses under part A. Okay, what are the 8 clauses? Number 1, name clause. Okay, number one is name clause. Now clause number one, name clause, as such, let me tell you, I have written this name clause. It is there in ICA material also, but it is just for your understanding. Okay, if you go through the tax audit report as such, you must have made a lot of reports in the office also, then we don't have to include the headings there, of course, right? This is just for your understanding that, okay, clause number one is basically with respect to the name of the SSE. Okay, so it says under this clause, the name of the SSE whose accounts are being audited under section 44 AB should be given. Very, very simple. So we just have to state the name of the SSE whose accounts are being under whose accounts are being audited under section 44 AB. Okay, so what is the thing that you have to understand here? Okay, so if it is an existing SSE, okay, name under which the return is furnished in earlier years should be given. This name, the name that I am talking about, this name, of course, it should be same under which the PAN is obtained. Okay, so when I say name clause, it should be as per the PAN. Of course, the PAN number, the name appearing in your PAN card, and the name that you give it here, it should be same. Okay, but yes, please understand, in case of a proprietorship firm, if it is a proprietorship firm, what happens in case of a proprietorship firm, guys? Whose PAN number is used in case of proprietorship firm? Proprietor, right? So in case of proprietorship firm, you can give name and style in which business is carried. Okay, but ultimately in the PAN card, whose name will be there? What do you think? In the PAN card, whose name is generally there? Proprietors, right? So please remember, in case of proprietorship firm, you give the name and style under which the business is conducted, and at the same time you have to also mention the name of the proprietor. Okay, in case of it is a firm, if it is a partnership firm, you all know that partnership firms have their own PAN, and the name of the firm itself appears in the PAN card, so no need to give the name of the partners here. The name of the partnership firm will suffice. In case of company also, the name of the company will suffice. Only remember that if it is, I'm just writing a specific case, if it is a proprietorship firm, if it is a proprietorship firm, then what is going to happen? You have to give name and style in which the business is carried. So name of firm also will come along with, please, it is better if you mention the name of proprietor also. Fine. In case of firm, name of the firm. In case of company, name of the company. But the concept is, whatever name, that we are going to use here, name of the SSE, how should it be? The name should be same under which PAN is obtained. Same as per PAN. Is this clear? First clause over. Okay, very simple. Now, second clause, which is with respect to address clause. Now, the point here to understand is basically the address to be mentioned under clause 2 should be same as has been communicated by the SSE to the income tax department for assessment purpose as on the date of signing the audit report. So your address should be the same which you have communicated, that has been communicated by the SSE to the income tax department. So under clause 2, you have to mention the address of the SSE, and it basically has to be the one which has been communicated by the SSE to the income tax department. Okay, now I just wish to ask you something, guys. Okay, let's say you are doing the audit. Okay, this is a very simple clause as such. As an auditor also, we don't pay much attention to this, but what should be your checklist? How should you proceed with this clause as an auditor? What do you think? So we have to ask from the from the SSE basically the address communicated by him to the income tax department. How will we get to know? So we are going to ask the SSE as to what address you have communicated to the income tax department. Okay, now in case the SSE is an HUF, let's say, okay, in case the SSE is an HUF, then we have to mention the address at which HUF is assessed and not the address of the Karta. Please remember this. If it is an HUF, we have to mention the address of the HUF and not that of the Karta. Okay, and let's say if we are doing the tax audit of a particular branch of a company, okay, if we are doing the tax audit of a particular branch of a company, then we have to mention the address of the branch or the unit. If you are doing the address of a unit or a branch, mention the address of the branch or unit. So these are very common, I mean, very practical checklist basically, which I have just discussed. Not very important, but these are very basics. Okay, so address clause is done. Clause number 1 was name, second is address, third is permanent account number. Nothing much to explain here, guys. The permanent account number PAN allotted to the SSA should be indicated. So whatever PAN has been allotted to the SSA, it should be indicated. Please remember, under clause number 1, it was only with respect to name clause. I told you that the name should be as per the PAN which has been obtained. Okay, but here clause number 3, we have to write the PAN number. Okay, now how are we, what audit procedure are we going to apply for this? Of course, we are going to obtain from the SSA its permanent account number and ensure that the same is correct. Second, check the same from the PAN card allotted to the SSA. You check the, you'll obtain the PAN number, you'll see the PAN card, you'll verify it. Okay, and as a general practice, we also keep a copy of the PAN card in our audit file. Okay, so auditor should keep a copy of the PAN card in his permanent file relating to the audit. So of course, we maintain audit files, right, in the office. So one file, generally it is permanent file, wherein permanent file means the details doesn't change. So we are going to keep a copy of the PAN card of the client. So these are basic things, guys. Okay, the institute is also not going to test you on these things, but of course I am assuming that you follow these audit procedures, or let's say practices, when you have actually done the tax audit. Okay, so 3 clauses done. I told you that initial clauses are not going to take much of time. Now details as to indirect tax registration, clause number 4 is with respect to the details with basically indirect tax registration. If the client has, we have to mention the same. So whether the SSA is liable to pay indirect taxes, like let's say excise duty, it can be service tax, sales tax, goods and service tax, custom duty, etc. So if yes, please furnish the registration number or GST number or any other identification number allocated for the same. So if the client, if our SSE is registered under the indirect taxation, the various indirect taxes, we have to give the numbers. Let's say it can be a GST number, it can be basically number with respect to service tax, excise, etc. So we have to mention the same. Now how are you going to check this aspect? Now of course, when you scrutinize the books, you will get to know whether whether the SSE is liable to pay in indirect taxes like excise duty, service tax, VAT, GST. So we are going to obtain from a copy of the registration certificate. We are going to obtain from the client a copy of the registration certificate under each of these authorities, and we have to basically report the same in form 3 CD. That's it. Okay, so we generally obtain the certificates of registration from the client, and then accordingly we check whether all the details are mentioned here, right? So very simple details as to indirect tax registration. If you just want to remember, you can mark excise duty, service tax, sales tax, GST, custom duty, etc. So furnish the registration number. That's it. Okay, the client should have furnished the registration number. We are going to verify the same. Okay, now next is clause 5 is basically the status of the SSE. Status of the SSE simply means whether it is an individual, or it is an HUF, or it is a firm, or is it a company. Okay, please don't get confused that by status I am saying resident or non-resident. No, status simply means the kind of person, right? So this refers to the different classes of SSE. So when I say status of the SSE, please remember it simply means the classes, the different classes of SSEs that we can have. It can be an individual, it can be HUF, company, firm, it can be AOP, BOI, whether incorporated or not, etc. Okay, I have given a note also. It should not be confused with residential status of the SSE. Okay, if it is a proprietorship concern, again proprietorship concern would always have the status as individual. So that is why I told you guys, in case of proprietorship concern, when I talk about the name of the SSE, okay, generally the name of the proprietor should come, but yes, you can mention the name and the style under which he is doing the business. Okay, so we have covered the 5 clauses, very simple. Okay, 6 and 7, again nothing much to explain. Okay, 6 is with respect to previous year, 7th is the assessment year. Okay, so previous year shall be quoted as per Income Tax Act, that is, let's say 1/4/21, 31, 3/22, and not to be confused with the accounting year. Okay, please be very careful. Some SSCs might have a different accounting year. Some companies, they can take permission and have follow a different accounting year, but when I talk about previous year, it has to be as per Income Tax Act, which is from April to March. Okay, so I've just given an example also for assessment year 22-23. The previous year will of course be what? Okay, I think for assessment year 22-23, what should be the previous year? I think you need to make a correction here. Yes. Okay, so nothing much to explain here. Then we have assessment year on the same grounds, guys. The assessment year relevant to the previous year for which accounts are being audited should be mentioned. Okay, then clause 8. Now coming to clause 8, I told you, see, in the basics part, in the part A of the 3CD form, it is all about the basic information of the entity. Now clause 8 is really very interesting. Okay, so we have to mention here 44 AB applicability, under which section of, or let's say under which clause of section 44 AB is the tax audit applicable. The tax audit which we are doing now, under which clause of section 44 AB is it applicable? So if you remember, guys, under the applicability, okay, let me just take you back. Under the applicability, we covered 5 clauses. Under the applicability of tax audit, we covered 5 clauses. Okay, what are the 5 clauses? If you can see, A is 44 AB A. A is with respect to the business turnover greater than exceeding 1 crore. B is with respect to profession. Clause number C is with respect to these 3 sections, 44 AE, BB, 44 triple B. Then we have 44 ADA, which is with respect to professionals, and clause E is with respect to 44 AD. Again, so C, D and E are basically of the presumptive taxation schemes, right? So we in our tax audit report, we have to mention under which clause is the tax audit applicable. Very simple. So mention the relevant clause of section 44 AB under which the tax audit has been conducted. So it can be 44 ABA. It can be, if we are doing it for a professional, it will be B. Presumptive taxations, if we are if the tax audit is done, if the client is following presumptive taxation scheme, but they wish, let's say they are following 44 AD, but they want to declare an income, they want to show an income which is less than 8%, so then they have to get tax audit done. So we are going to use 44 AB subclause, let's say clause number E, okay, which is for 44 AD business. All right, so for this is basically the applicability of 44 AB. Now we have got a new clause, guys. New clause number 8A also. Okay, so this is basically taxation under any of the concessional rates of taxation which has been given as an option to the companies. Okay, if you remember, I'm not very sure whether you are done with these provisions or not, but yes, the sections that we are just going to cover, I'm not going to go into the details of the section, but yes, let me just tell you, these are concessional rate of taxations, basically, which is an option given to the companies. Okay, so companies will be now taxed. Let's say earlier the rate of taxation for companies, for the firms, was 30%, right? But then under the scheme the rates have been reduced. All domestic companies will be, let's say, can have an option to be taxed at the rate of 22%. The companies who are into manufacturing, they have different rates of taxation. So in this particular clause, as a tax auditor, I need to see whether the company, whether the SEC, if it is a company, SSC, if it is a company, whether it has opted for concessional rate of taxation. Okay, so taxation under any of the sections 115 BA, BAA, BAB, BAC and BAD. Okay, so this new clause inserted in part A of form 3CD requires the SSC to state whether the SSC has opted for taxation under any of these sections. Okay, this is basically concessional rate of taxes, concessional tax rate. Okay, now it may be noted that all above sections 115 BA, BAA and BB are applicable to the company SSC only. So this particular clause 8A, okay, with respect to concessional rate of taxation, it is only applicable for SSCs who are company. Okay, so if my SSC is not a company, I don't need to furnish any details. Okay, so the answer can be simply, the reply to the above clause can either be a yes or no. If of course the if it is not a company, we'll write not applicable. Okay, so it says taxation under any of the sections, it is applicable for companies only. Clause number 8 is applicable for companies. Okay, and you are going to learn, of course, more about these sections when you cover the direct tax part. But for the timing, I've just given you an idea that 115 BA, BAA, BEE are for different classes of companies. There are different conditions which needs to be met, and then the company may offer the lower, I mean the concessional rate of taxation. Okay, so this is a new clause inserted. Please remember, it is only applicable to company SSEs. Okay, so with this, guys, see how quickly we are already done with part A of the form 3CD. Again, what are the various clauses? Please understand. Now, a very basic question might strike into your mind as to, sir, whether do we need to remember the clause numbers? So my simple answer is yes. I mean, of course, there are 44 clauses, but you might have done, of course, the tax audit in your offices. It won't be very difficult. But yes, see, when we are going to discuss few questions with respect to clauses, I'll of course discuss the answers as given by ICI, okay, like we did in professional ethics and all. So there you will clearly see that in each of the answers ICI has mentioned the clause number also. So it is very much, apparent that they expect you to write clause number in exams. Okay, so we have to learn it. Okay, how are we going to learn it? That is something which we are going to understand later on. But for the timing, let us understand the clauses. Okay, then we'll think about how we should learn it or not. Okay, so at this moment we have done part A of form 3CD. Okay, and again, clause 1 was name clause, very basic: name, second address, PAN number, details of see, permanent account number is what? Ultimately, permanent account number is your direct tax registration number. Okay, tax registration number. So please remember it in this way: name and address, you just put them together. Then PAN and details, other registration details, GST, etc., customs, etc. Okay, then these 3 points together. Again, status of the SSE, whether it is a company, individual, firm, AOP, BOI, then previous year assessment year. Then clause 8, we have got two parts now, two clauses, basically 8 and 8A. 8 is basically the last part, so you have to just mention the clause of section 44AB under which the tax audit is done, and clause 8A, it is only with respect to companies if the SSE is a company and whether they have opted for the concessional rate of taxation. So the answer to this clause is either going to be yes or no. It is only for companies. Okay, so I hope it is clear. Any doubts, guys? Very simple points we have covered. Any doubts? Okay, now one thing that I would like to tell you here, when you cover the sections, guys, okay, now what happens is you will have to check two aspects here. Okay, I'm not going into the details of this section, but you'll have to check two aspects. Number one, whether the company has opted for tax regime under these sections. I mean, whether the company has opted for concessional rate of taxation. Okay, number one. And secondly, if the answer is yes, okay, if let's say if the company has opted for concessional rates of taxation scheme, if they have opted for tax regime under section 115 BA, BAA, okay, then you have to see if the answer to this is yes, whether copy of form 10 IBICID filed online has been obtained from the SSE. So they need to file certain forms also. It can be, I'll just write it, okay, here for your understanding, because we generally do it, okay, when we actually are going to audit. So we are going to check this aspect, whether these forms have been either whatever is applicable, whether it has been filed by the filed online and has been obtained from the SSE. Okay, so you need to obtain these forms from the SSE, right? So again, just remember for the timing that clause 8A is with respect to concessional rates of taxation. Whether if the SSE is a company, we just need to see whether the company, whether our SSE has opted for this scheme or not. Okay, so answer is going to be yes or no. This is basically the audit procedure which I have discussed. All right, now coming to the next part, guys, now let us start with the detailed part of form 3CD. Okay, so we have many different clauses here to cover. Okay, number one, I mean clause number 9, or let's say first clause under part B, clause number 9 is basically with respect to partnership, or if there is a change in partnership. Again, I'm telling you, these numbers are not as per the act, guys. I mean, these names, numbers are of course as per the act. These names, this is just for your understanding, so that you are able to, these are like keywords, guys, so that you are able to remember the clause. Okay, so clause 9 is with respect to partnership, and if there is any change in partnership. Okay, so let us understand. It says if firm, it is for firm or association of persons. For firm or association of persons, indicate names of partners. If it is a firm, please indicate the names of partners. Okay, and their profit sharing ratio. So you have to indicate, if it is a firm, you have to indicate the name of partners. If it is an AOP, you have to mention the name of the members. Okay, and if it is a firm, again you have to mention basically the names, the profit sharing ratios. Okay, and this is the basic details about the firm. Now, if there is any change in partner or members, so if in the previous year, let's say, there is any change in the partnership, if there is, let's say, if the partners are same, if there is any change in the profit sharing ratio since the last date of preceding year, the particulars of such change. Okay, so you need to give particulars of changes as well. Okay, so what is it that we have to mention here? Okay, so this clause, number one thing, it is applicable for whom, guys? Either a firm or let's say an AOP, right? So if it is a firm, what all details you have to give, guys? You have to give name of partners. Okay, plus at the same time it says and their profit sharing ratio. So I'm just writing PSR. So if it is a firm, in this clause, what do we have to mention? We have to mention the name of the partner plus the profit sharing ratio. Okay, if it is an AOP, what do you have to mention? Again, very simple, name of member and the profit sharing ratio. This is the two, these are the two things that we have to mention. Okay, this is as per 9A. Okay, this is as per 9A. But what is there in 9B? If there is any change in the partners or members or in their profit sharing ratio since the last day of the preceding year, the particulars of such change. So if there is any change in these, basically details of change, so you also have to mention details of change in previous year. That's it. This is all about clause number 9. Do you get this point? So 9A, this is basically 9A, and this is, okay, it is, please understand, this is clause 9 has got two parts. It is not 9 capital A. If you are able to see, there was a, when a new clause is inserted in between, it will be in capital letters, 8A, capital A. But these are not in capitals, okay, these are sub clauses basically. Okay, so 9A is with respect to the details that needs to be furnished. Name of the partner, profit sharing ratio, or if it is an AOP, name of the member or profit sharing ratio. And 9B is with respect to, let's say, changes. Is it clear, guys? Okay, now what should be your audit procedure? I mean, how will you check this aspect? Okay, so you need to see first thing. Okay, you are going to ensure whether the SSC is a partnership firm or an LLP. Okay, you are going to obtain a schedule, a list from the SSC indicating the name of the partners or members and their profit sharing ratios. Of course, you are going to obtain it from the SSC. Okay, you might also check. You might have to check the partnership deed. Partnership deed will clearly state the name of the partners, the profit sharing ratio, right? So in order to verify this, I'm just telling you the audit procedures. We have not mentioned the audit procedures as such in detail here, okay? Because these are very generic. These are very simple procedures. But I'm just trying to, be very practical and make you understand that this is what we do. Okay, so we might look in for, let's say, the copy of partnership deed or LLP agreement and find out the name of partners, their profit sharing ratios. Okay, and also we can keep a copy of the deed in our working file. Okay, then again, we can how can we ensure if there was any change? Okay, so we can check the deed as on the last day of the preceding year. Okay, and on the first day also, of course, we can compare if there is any change. They'll say that there is no change, the deed is same. That simply means that there is no change in the partnership. Okay, so so this is how we proceed with clause number 9. So it's very simple and it's almost done also. Okay, so these are the two things to be understood in clause number 9. Now next is clause number 10, nature of business and changes. Nature of business. Okay, so clause number 10 basically is about nature of business. Okay, and when I talk about clause number 10, it simply means that we are going to mention the nature of business or profession our client is engaged into, whether it is a trading concern or whether it is a manufacturing concern or is it a professional. So we have to mention the nature of business or profession, and if there are any changes during the year, we have to mention the particulars of such change. So what are the points? Let us understand. Nature of business or profession, number one thing. Okay, and if an SSC can have more than one business, right? So if more than one business or profession is carried out during the previous year, nature of every business or profession needs to be mentioned. Okay, so first is basically nature or profession, nature of business or profession. Okay, and secondly, we also have to mention if there is any change in the nature of business or profession, the particulars of such change. So very simply, if I put, guys, okay, you have to basically mention, let's say, nature of, if I say, it can be nature of business or let's say profession. Okay, and then we also have to mention the changes therein. Okay, so changes during the year. If there is any change during the year, you have to mention. If there are changes in the nature of business or profession, the particulars of such change. So if there are any changes, then you have to mention particulars of change. Okay, so 2 points I have covered here under clause 10. Number one was that you have to mention the nature of business and profession. Okay, how do you mention? I will tell you practically. So you have to mention the nature of business or profession, and if the client has got multiple businesses, guys, you have to mention the nature of business or profession for each of them. Okay. Secondly, you also have to consider whether there was any change during the year, okay, with respect to previous year. Then what you are going to do, if the answer to this is yes, then you are going to provide the particulars of the change. Okay, now what happens, please understand. Now when I talk about the changes during the year, okay, so let's say if the client was into trading business, now they have entered into manufacturing. So this is a change. So I'll have to give particulars about the same. I'll obtain a WR, written representation from the management that okay, you were earlier into trading, now you are a manufacturing concern, and the particulars of this change has to be mentioned in the tax audit report in this particulars of change column. Okay, but if there is just some let's say internal reconstruction in the company, there is some reorganization, let's say there is some temporary closure of a unit or so, then it won't be considered as a change. Okay, so then we don't need to mention about the change in particulars. Okay, so what I'm trying to tell you is through the example that let's say if there is a change in business, if earlier they were only into trading and now they are into manufacturing also, then perhaps you have to mention the change. Okay, but if it is very minute, I mean if only there is reorganization of business, there is only let's say some reconstruction in the business, then you don't have to consider it as a change, and hence if you don't consider it as a change, the particulars thereof need not be mentioned, right? So this is point with respect to nature of business and changes as well. Okay, now practically, guys, how do we fill this column? I want an answer from both of you, from you guys. Okay, you told me that you have done tax audit, so how do you fill this aspect, nature of business? Please tell me, guys. Yes, how do you fill this aspect, guys? Prachi, batao.
There's a drop down.
Okay, so there's a drop down. Okay, then.
And then you have to write the name of the trade name you have to write, and then if you select other
okay
miscellaneous, you give descriptions.
All right, so we have to mention the sector, or let's say whether we can also mention the subsector, and of course as Prachi has said, we have to, if you remember, we have to mention a code also. We mentioned a code 0A0, let's say A0601. If it is a professional, we are going to mention this code. So this mentioning of the code, it is as per basically the income tax list. If you select it from the drop down, it is a trading concern, a code comes. Okay, so you have to mention the code also. Okay, now for example, if I tell you the code for professionals, professional chartered accountants. It is I think it is A0601, something like this. Okay, so similarly, if you can select trading, concern, manufacturing, there will be different codes. Okay, so this is how you basically choose the nature of business or profession. Prachi, you are absolutely correct here. Okay, and again I told you guys, if there is any change, so again if there is a change in the nature of business, then only you are going to report under this aspect. Okay, if it is merely a reorganization, reconstruction, if something is very temporary closure, let's say, then you don't have to consider it as a change. Okay, so done. Clause number 10 is also done. Is this clear, everyone? Okay, all right. Next is basically we are going to now cover clause number 11, books of accounts under section 44AA. Books of accounts under section 44AA. Now, please be very careful, guys. We do tax audit under section 44AB. Okay, but now we are covering we are going to learn about the books of accounts as required to be kept under section 44AA. Okay, now before I go through the clause, let us first understand what section 44A is all about. Okay, so again we are going to discuss this section in brief here, section 44AA. Okay, now 44AA, if I go in if I talk in very simple terms, guys. Okay, 44AA is basically with respect to maintenance of accounts. Maintenance of accounts. Be very careful when you are listening to this section. Okay, 44AA is with respect to maintenance of accounts. Okay, and we are going to cover this section in two parts. Okay, number one is let's say I will take two cases, case 1 and case 2. Okay, so under case 1, basically we are going to cover persons who are involved in, let's say, specified profession, persons carrying on specified profession. It is only for profession. Okay, so persons carrying on specified profession. And the second case that we are going to cover is basically for all other SSCs, who are not covered in case number 1, other SSCs. Okay, now what is 44AA? Okay, it says persons carrying on specified profession. Okay, now let me just tell you first that who are going to be the ones covered in specified profession. Okay, so if I write specified profession, it is basically, again let me just tell you few words. Okay, it will be persons from belonging to the legal background, medical background. Okay, if you remember, we covered something similar earlier also. It can be the ones who are involved in engineering, let's say, background, architectural. Architectural. Okay, then we have persons from accounting, we have interior decorators who are into profession of interior decoration. Okay, then we have some filmmakers also, guys, film artist, and or let's say some authorized representatives of these professions. So these are some specified professions. Again, you don't have to learn it. Okay, now please be very careful. Okay, I am just covering these two cases here. Okay, now as per 44AA, if you are a person belonging to any of these specified professions, okay, number 1, and your gross receipts, okay, your gross receipts exceed rupees 1,50,000. Your gross receipts exceed rupees 1,50,000 in all immediate preceding years. Let's say if my gross receipts have been greater than 1,50,000 in all immediate preceding years, or let's say if I have newly set up my profession, then if it is likely that my receipts is going to exceed 1,50,000 in this year, then I need to maintain, please be very careful now, then I need to maintain specified I need to maintain specified books of accounts. Or let's say some books of accounts has been prescribed, I need to maintain it. Okay, again let me repeat, 44AA, first case that we are covering, it is with respect to some specified professions. Okay, who can be the professionals? I have given a brief idea. It can be person from legal background, medical, engineering, consultancy, accounting, architectural, interior decorators, etc. Okay, now what is the second case? That the gross receipts of these professionals is greater than 1,50,000. If let's say they are into this profession, you know, they are already doing it, so their gross receipts is basically greater than 1,50,000 in all the three immediate preceding years. Or let's say if I have newly set up my profession, and I feel there is a likeliness that my gross receipts would exceed 1,50,000 in this particular year, then I'll have to maintain specified books of accounts. Okay, then I'll have to maintain specified books of accounts. What are the specified books of accounts, guys? What can be the specified books of accounts? So the specified books of accounts basically are, I'll just write it for you. It will be a cash book. Okay, it will be a journal. I need to maintain cash book, journal. Then it will be a ledger will be there. Or let's say I also need to keep photocopies of bills or receipts issued by me which are more than rupees 25. So whatever bill I have issued, I need to maintain photocopies of bills or receipts issued by the SSE which is more than rupees 25. And let's say if I have incurred any expenditure, if I have made any payment, if I have incurred any expenditures, then I need to keep original bills of expenditure which are, let's say, more than rupees 50. Okay, so I need to basically, let me just write it down here for you. I need to keep photocopy of bills or receipts. These are bills or receipts which are actually issued. Okay, amount is, let's say, greater than issued amount is greater than rupees 25, only rupees 25. Okay, and if I have done certain expenditure, original bills of expenditure, I have to maintain this. Okay, if amount is how much? Greater than rupees 50. So these are specified records or let's say books of accounts which these professionals have to maintain. Okay, now please be very careful, guys. Okay, now my question to all of you is, let's say the gross receipt of a particular practitioner, let's say an interior decorator, it does not basically exceed 1,50,000. Let's say for any specified profession. Okay, not persons carrying specified profession, let's say interior decorator, but his gross receipts does not exceed 1,50,000. Then is he required to maintain books of accounts? What do you think? The answer is, please understand, if let's say his gross receipts does not exceed rupees 1,50,000, still he should keep books of accounts so as to enable the assessing officer to compute his taxable income. Okay, so please understand now. Okay, I am just dividing it into two parts, guys. If gross receipts is greater than, let's say, 1,50,000, or let's say in other cases, the books have not been specified. The books of accounts which needs to be maintained has not been specified, but he needs to basically maintain such books of accounts. Okay, he needs to maintain such books of accounts and other documents as may enable. So I'll just write it here in this manner. Okay, you are going to study all this in tax, but yes, let me just discuss it in brief. So okay, so maintain books or records to enable assessing officer to compute basically his tax liability, to compute his taxable income. Okay, so what did I tell you? Please understand, section 44AA only specifies books of accounts to be maintained in cases of specified professions wherein their gross receipt exceeds rupees 1,50,000 in immediate 3 preceding years, or if I am a new entity, it is likely to exceed in the current year, then only the books of accounts to be maintained has been specified. Only in this case. For other cases, for other professionals, for professions who do not, let's say, come up in this category, who are not, covered in this category, they need to maintain books or records just to enable enough books of accounts or records just to enable the assessing officer to compute his taxable income. Okay, is this part clear? This is the first part. Is this part clear?
Yes.
Okay. Now, guys, when I cover, coming to this part now, again, case 2. What about other assessees? Now, what about other assessees? Okay. Now, please understand this, that in case of other assessees, be very attentive now. In case of other assessees, there is no books of accounts to be, kept, to be maintained. There is no specified books of accounts to be maintained. Okay. So, in case of other assessees also, they need to maintain such books of accounts and other documents as may enable the assessing officer to compute the taxable income. Okay. Now, other assessees, again, let me tell you that there are no prescribed books of accounts to be maintained. In short, if I say this is the criteria, there are certain conditions, other conditions also, but in a way, I can say that in case of other assessees, let's say somebody who is into business, okay, they are required to maintain such books of accounts and other documents as may enable the assessing officer to compute his total income in accordance with this act. Okay, but then but in certain cases, let's say, let me just give you an example. Okay, let's say somebody has opted for presumptive taxation scheme. Okay, let's say somebody has opted for section 44 AD, which is presumptive taxation scheme for business, and he is declaring an income of 8% of his turnover. Okay, then should he be maintaining books of accounts? Is it required? He is declaring his income to be straight 8% of the turnover. Should he now be maintaining books of accounts? Will the AO be interested in his books of accounts? What do you think? No, right? So, for the timing, just understand, guys. Okay, what I'm trying to tell you is, in case of other assessees, okay, if let's say you are not falling under presumptive taxation scheme, okay, and there are certain other conditions, but primarily just remember this thing, that you have to maintain such books of accounts to enable AO to compute your taxable income. Just this much is relevant for our case at the moment. Okay, but there are certain other conditions and points here also. Let me just give you an example. For example, if the person's income from business or profession exceed rupees 1,20,000, or let's say in case of profession his gross receipts exceed rupees 10 lakhs, then he needs to maintain books of accounts. So there are certain other conditions also. Okay, but that is not very relevant at the moment, right? So what I'm trying to tell you is, be very clear on this. A lot of time, many of the professions, they get confused that 44 AA, it specifies the books of accounts to be kept only in case of specified professionals when the two conditions are met. What are the two conditions? That you have to be a professional from these categories that we have discussed, and your gross receipt in the immediate preceding 3 years exceeds 1,50,000, or if it's a new entity and you feel it very likely that it is going to increase 1,50,000, then you have to maintain these specified books of accounts. So in short, in a nutshell, guys, the requirement to keep specified books of accounts is only for whom? Specified professionals whose let's say gross receipts exceed 1,50,000. Is this clear to everyone? Yes or no? Is this clear? Yes. Okay. Now, having understood this, let us come to the clause again, clause number 11. Okay. It says books of accounts under section 44 AA. Number 1 point. Whether the books of accounts are prescribed under section 44 AA. Please be very careful. Whether the books of accounts are prescribed under section 44 AA. If yes, list the books so prescribed. If yes, list the books so prescribed. Okay. Now, this particular part of clause 11, now what do you think? It will be applicable to only which type of SSCs? Yes, I want an answer from you. Whether books of accounts are prescribed under section 44AA. If the answer to this is yes, I am asking you a question here. If the answer to this part is yes, basically which type of SSCs are we referring to, guys? The ones who are into business, or only in cases of specified professions? Specified professions. Okay, so please be very careful. I have seen, professionals also doing a mistake. Whether books of accounts are prescribed under section 44AA. If yes, list of books so prescribed. So this clause is only applicable in case the client is engaged in what kind of business? He is a person carrying on this specified profession. For others, it will be no. Because what I have told you, for all other SSCs, they just need to maintain books and records so as to enable the assessing officer to compute the income. There is no prescribed books of accounts. In both these cases, here also, there is no prescribed books of accounts. Okay, it is only prescribed for professionals who fulfill this criteria. For specified professionals who fulfill this criteria. So please be very careful. Again, whether books of accounts are prescribed under section 44AA. If yes, list of books so prescribed. Okay. And for your again better understanding, see, I have given a point here, an explanation to this part basically. Okay. Let's read it. It says, check that the books of accounts have been maintained as required by law. In case of professionals, the specified professionals, requirements of section 44AA read with rule 6F of income tax 1962 should be kept in mind. Of course, because I told you it is only with respect to the specified professionals that books of accounts have been prescribed. Okay, and again, it says rule 6F read with section 44AA has prescribed books of accounts to be maintained by specified professionals. So under this rule 6F, books of accounts has been prescribed only for the specified professionals. Okay, so in case the SSC is a professional, then only, if the SSC is a professional, then only inquiry under clause 11A will be answered in the affirmative, yes and no, and list of books prescribed will be given. In case of SSCs engaged in business, someone who is not into profession, who is into business, then no such books have been so far prescribed. This is just a note from my end. No such books have been so far prescribed. Hence, this question will be answered in negative. This part will be no. If it is a business, this part will be no. Is this clear?
Yes.
Yes. Okay. Now, just a very common thing, okay, common sense thing. Let's say my SSC is a company. Okay. If the SSC is a company, will this clause be applicable? What do you think, guys? See, company, if it is a company, who is going to basically the companies has to, it is mandatory for them to maintain books of accounts, and it has to be as per what? The Companies Act, right? So we have a point here. In case of a corporate SSC, if it is a corporate SSC, the books of accounts required has to be maintained as per, provisions contained in the relevant statute. Okay, so of course, in case of companies, if it is a company, 44AA will not prescribe the books to be maintained. They will have to maintain it as per what? The Companies Act. Do you get this point, guys?
Yes, sir.
Right? Okay, great. All right. So this is yes, this is about section 44AA. Okay, the thing that I wanted to explain. Okay, now but again, let me tell you. Let's talk about other business and profession. Okay, the other businesses, they have not been prescribed as to these are the specific books that you need to maintain. But again, I told you they have to maintain books of accounts, right? If their income exceeds certain amount, let's say they have to maintain books of accounts. So if your client, let's say, is into business and they are maintaining books of accounts, so in clause B you just have to list of books of accounts and records, let's say, maintained. What are the books of accounts which the client is maintaining? You just have to mention this now. Okay, list of the books of accounts maintained by the client and address at which the books of accounts are kept. So two things, you have to mention the list of books that my client is maintaining and the address at which it is kept. Is this clear, guys? I just said, please be very careful. Let's say this is the case. My client is engaged in a business. I did not say that they are not required to maintain books of accounts. I just said that no prescribed, it is, under 44AA it is not prescribed. Okay, it is not prescribed. But let's say they are keeping books of accounts, then under part B of clause 11, you just have to mention the list of books that they are maintaining, and also at the same time you have to mention the address at which the books are maintained. Is this clear, guys? Yes, okay. Now let's say you mentioned that, okay, these are the books and the address, which this is the address. In the third part, you have to mention, okay, if they are keeping these books, what are the books out of these books and records? What are the books and records that you have examined? You as an auditor have examined. So clause C, I'm again saying clause C, part C again, it says list of books of accounts and the nature of relevant documents which have been examined by you. So B was basically, this part was focusing on the list of books which is maintained by the client and the location, I mean the address where it is kept. Part C is basically focusing on, out of those list of books, what are the books that you have examined. So generally in office, what do we do? In office, what do we do? If you mention a list here, most of us, we just copy paste it here also. Yes or no? ऐसा ही होता है, right? So, but then again, we have to basically ensure here the list of books. We need to mention those list of books that we have actually examined. Okay. Now, this clause is not yet over. Okay, I have to tell you a few more things about it. So, there's an explanation again here. In case the books of accounts are maintained in computer system. So, this is the case almost now in all the entities. The books of accounts are maintained in the systems. So then, what location will you mention? Okay, so mention the books of accounts. You have to mention it that it is generated by such computer system. So please mention that the books of accounts are generated by the computer system. If the books of accounts are not kept at one location, please furnish the addresses of locations along with the details of books of accounts maintained at each location. So it might so happen that the books of accounts are kept, let's say, 2 offices. So you have to mention address of both the offices, and against the address of both the offices, you have to also mention the respective of books that are kept at each of the location. Okay. So 2 points with respect to part B. What are the 2 points? So list of books of accounts maintained, and secondly the location. Great. Okay, so you have to mention, you have to make it very clear that if they are using computers to make the books of accounts, mention it. Okay, and secondly, if their books are kept at multiple locations, you have to mention the address of all those locations along with the books that are being maintained by each of these locations. Okay, now is it clear, everyone? Yes, okay. Now, see, I tried to write this section just for your understanding, okay? But then, now, if you really want to take a note of something, I mean, just to understand this provision, let me just draw a chart, again, a chart for you. If you want, you can take a note of this, okay? So, clause number 11, what are the 3 things that we have to basically talk about? Okay, so we are discussing about, let's say, books of accounts. Okay, and under this part, this is basically clause 11. I'm just drawing a chart of clause 11 for your better understanding. So with respect to books of accounts, we have to understand 3 aspects. Okay, what was the first aspect? Whether it has been prescribed. Under which section, guys? Under section 44AA. Okay. Secondly, we just have to mention whether the list of accounts, list of books, plus what? The location. And thirdly, third part. What was the third part? Let's say books or documents that has been examined. Right, this is what we have to mention. Okay, now if this is yes, let's say we have to give a list. All right, now when I talk about this particular whether it has been prescribed, okay. So please understand, as per section 44AA, okay, specified books of accounts have been prescribed. Let's say books of accounts have been prescribed, or let's say specified, for whom? Books of accounts has been specified only for some specified professionals. Let me just write it here, only for specified professionals, okay. And but again, only there are two conditions, right? Only for specified professionals, plus they also have to have what? Gross receipts must be greater than how much was the limit? 1,50,000 for each of the three preceding previous years. So gross receipt must exceed 1,50,000 for each of the three preceding years, and if it is a new entity, let's say if it is likely to exceed 1,50,000 in the current year. So these are the two conditions. If these two conditions are fulfilled, then only this will be applicable, that yes, books of accounts are specified. And books of accounts are specified, if I want to go into more details, okay, this is as per what? Rule 6F. Okay. Now few more points. Okay, this is books of accounts specified. Now if I write in very simple terms, guys, for other SSCs, let's say who are into business, let's say for other SSCs, okay, who do not fulfill the this criteria, let's say of turnover, okay, then for other SSCs no specific books of accounts are prescribed. Okay, is it clear? Okay. And one more point I wish to draw your attention upon is, in case our SSC, let's say it's a company. In case our SSC is a company, then is books to be maintained specified under section 44A? What do you think? Books to be maintained, it is not prescribed under section 44A, rather as per what? Companies Act 2013. This is just a summary, guys, for your understanding. Fine? Is it fine now, Sudhir?
Yes, sir.
Yes, okay. All right. Now, just one basic thing again, okay. I don't know if because everything is now important because from the MCQ's perspective, I just want you to understand one thing, okay. Now, when we talk about, guys, books of accounts, okay, what is the section number? 44AA. And the rule wherein the books have been the specified books, the prescribed books is there. The rule is basically 6F. Okay, but when I talk about the auditing provision, tax audit provision, what is the section? 44AB. Okay, and the format basically of tax audit reports, 3CA, 3CB, 3CD, the statement of particulars, it is prescribed in rule 6G. If you can just see, I'll just show you this thing. See, under form 3CD, what is written? Rule 6G. Okay, and under this form 3CB, see, it says rule 6G, clause 1, subclause B. Okay, for 3CA again, what will be the rule? Rule 6G, subclause 1, and again small a. A basically again, because it has got two parts. Tax audit report has two parts. Tax audit report is prescribed in, let's say, rule 6G, subclause 1, and then part A again, which is 3CA. Then for B, 3CB, and then 3CD is again 6G2. So in short, what I was trying to convey to you is, books of accounts section is 44AA, but the rule is 6F. okay, EF, and then audit section 44AB, and the rule is basically 6G. Is this clear?
Yes, sir.
Okay, all right. So done. So section 44AA. Now this particular clause, if you must have realized, it relatively took greater amount of much time, because I had to explain you 44AA, because if you don't understand 44AA, you will not understand as to what has to be reported under this clause. Okay, so it took us time. Now on the similar grounds, guys, when we do the remaining clauses, okay, some clauses will be really fast, will be covered really fast, and in certain clauses wherein I have to discuss the relevant income tax sections, okay, it is going to take time. All right. So now coming to the next clause. Again, it's a very simple clause. Why would it be simple now? Because I have already discussed the relevant clauses. Okay, let's understand. It is a clause on presumptive income scheme. Okay, and it says whether the profit and loss account includes, so the assessee that we are auditing, whether his profit and loss account includes any profits and gains assessable on presumptive basis. So if my client that I am auditing, has he opted for presumptive scheme of taxation? Okay, if the answer to this is yes, then indicate two things: the amount and the relevant sections. Okay, so I have to include two things here. I have to include the amount, okay, and the relevant section of the presumptive taxation scheme, right? It can be if he's into business and he certifies if he fulfills the conditions, then I will choose section 44AD, let's say. If he is a professional and on meeting upon the conditions, I'll choose section 44ADA. So similarly, if he is into business of goods carriage and he satisfies the necessary conditions, he doesn't own more than 10 goods carriage, so I might choose section 44AE here, right? So I just need to basically I need to basically see whether the client has opted for presumptive scheme of taxation. If the answer to this is yes, two things I have to report, guys. Indicate the amount, I mean amount of profits, and the relevant sections. That's it. So you need to mention the profits, the amount, and also the relevant section. Okay, now you all know this 44AD we have already covered. Okay, if you want, I discussed the provisions in detail. 44AD, ADA, it is for professionals. AE, B, double P, we have already discussed. Okay, 44B is something new, shipping business of non-residents. BBA is operation of aircraft by non-residents, again just for your understanding. Then we have chapter 12G, then it is about special provisions relating to shipping companies. Then we have first schedule, which is on insurance companies. Okay, so there are other presumptive income schemes, taxation schemes. So you just have to mention under which of these categories our client falls. Okay, now done. This is a very simple provision. It is done. Okay, but how are you as an auditor going to assess the same? How are you going to assess the same? Probably you'll have to do a revenue analysis. You have to go through the revenue and check whether there is any business which is taxable on presumptive basis. You can compare the past profits with the current year profits with the previous years, so that you get an idea. Okay, so this is how you basically check whether the client has opted for any presumptive scheme of taxation. Okay, now but a very important thing which I want to discuss with you is, a question has been asked from this part. Okay, we are going to discuss the question later. I mean all the questions in detail towards the end when we are done with all the clauses. But let me just discuss the question which was asked. Okay, so a question was asked that your client has opted for presumptive scheme of taxation. Okay, so how will you report the same in the tax audit? Okay, now please be very careful, guys. If a question is asked on presumptive scheme of taxation, whether the client has opted for presumptive scheme of taxation or not, the reporting needs to be done in two clauses. Okay, one, of course, it will be done in clause number 12, wherein we need to check whether the client has opted for presumptive scheme of taxation. If yes, the amount and also the relevant section we have to mention. But at the same time, guys, if I take you to part A is basically again Part A, clause number 8, if you go through it thoroughly, 44AB, applicability. Don't you think this would also be impacted? If my client has opted for section 44AD, let's say, so under which clause of 44AB will the tax audit be done? Under which clause? Clause E, right? 44 AD clause E, because I made you go through 5 clauses, right? So please be very careful. If a question is asked on presumptive income scheme, always try and mention then clause 8 also. Clause 8 also needs to be mentioned. Okay, so under clause 8, okay, how do you need to now write the answer? I'll just read it out. It says, under clause 8 of form 3C, the tax auditor is required to mention the relevant clause of section 44AB under which the audit has been conducted. Okay, so in case, let's say the auditor opts for 44BB or maybe let's say 44AD, so we have to mention the relevant clause. So if he is opted for AD, then the clause will be what? Clause E of section 44 AB. Is this clear? Samajh aaya? Okay, so be very careful, but we'll cover this aspect again, guys. Don't worry about it when we go through the questions. Okay, now the next clause number 13, which is method of accounting and ICDS. Okay, again an important aspect, method of accounting and ICDS. Okay, so what is it that we have to cover under clause 13? Okay, there are, if you can see, guys, we have 6 points here. 6 points: A, B, C, D, E, F. Okay, please, for your understanding, just remember these 3 points. These 3 points are with respect to the method of accounting. I mean, it is with respect to accounting methods. Okay, and point D, E, F is with respect to ICDS. What is ICDS? Income, the government has power to come up with, the central government, they have come up with certain income disclosure and income computation and disclosure standard. In short, we call them as ICDS, income computation and disclosure standard. So we call it as ICDS. So we are going to cover ICDS portion here. Okay, so clause 13 has got 6 parts. First 3 is with respect to accounting methods, very simple, and second is basically ICDS. Second part, I mean DEF. There are 3 points with respect to ICDS. Okay, now what are the points? Let us understand. So under clause 13, we are going to learn about method of accounting and ICDS. Okay, so number 1 point is very simple: method of accounting employed in the previous year. Method of accounting employed. Okay, and what method of accounting did they opt for? Okay, was it on cash basis or mercantile basis? I'll teach you the details. Okay, and if in the current year, whether there has been any change in the method. Okay, and if there is a change, in method of accounting, what would be the impact on the profits? What would the impact on the PL? Whether there will be increment in the profits or decrement. We have to report about these 3 aspects with respect to method of accounting. Very simple. See, method of accounting, number 1 is method of accounting employed in the previous year. Whether there has been any changes in the method of accounting employed from the immediately preceding previous year, and if there are changes, if answer to B is affirmative, let's say if there are changes, yes, then give details of such change, the effect thereof on the profit or loss. So we have to just mention about the changes. So serial number, particulars, increase in profits or decrease in profits. Now income tax department will be very cautious here. What do you see? There can be change in your accounting method, but if you are doing it and it is drastically reducing your profit, thereby impacting your tax liability, then the income tax department will definitely catch you out. Okay, so they will, of course, this is a matter of concern for them, so we have to report this aspect. Okay, so with respect to accounting method, guys, okay, though I did not teach you the accounting method yet, but yes, with respect to accounting method, 3 things you have to understand: method of accounting which has been employed by the SSC, if there is any change, and if there is change, let's say if the answer to this is affirmative, if there is change, the impact of such change on either the profit or loss of the entity of the SSA. This is what we have to report, right? But then again, before I go into this ICDS aspect, okay, let me just tell you some things about, there are accounting standards and income computation and disclosure standards. So section 145 basically tells us the method of accounting. Okay, how can the SSCs keep their books of accounts? So it says under section 145(1), income chargeable under the heads profits and gains of business or profession or income from other sources shall be computed with either in cash or mercantile system of accounting regularly employed by the entity by the SSC. So cash basis is acceptable. Mercantile is also acceptable. Mercantile basically means accrual. Okay, so both the systems are okay, but yes, please understand the words that have been used. I am reading the section again. It says income chargeable under the heads profits and gains of business or profession or income from other sources shall be computed in accordance with either cash or mercantile system of accounting regularly employed by the SSC. Regularly means institute. I am again saying the word institute. The department also expects the SSC to maintain consistency. You cannot be very random in selecting your method of accounting. 1 year you do cash basis, again you are doing mercantile. No, it simply says accounting which is regularly employed by the client. So they also expect some consistency from the SSC that you are going to at least follow cash basis, or let's say if you are following accrual basis mercantile, then you are going to follow it for a good period of time. Okay, now so this is basically with respect to method of accounting. So method of accounting, you have to mention whether it is basically cash basis or it is mercantile basis. Okay, please remember guys, please remember, hybrid system is not allowed. Hybrid system, when I say hybrid system, I mean that you are doing some parts in cash on cash basis and then some parts on accrual basis. This is something which is not allowed at all. Okay, now let's now discuss about the ICDS part. Okay, now what is ICDS and all? First let us cover it from this part. Okay, now section 145 subsection 2 empowers the central government to notify in the official gazette from time to time income computation and disclosure standards. So now the department has come up with their own income computation and disclosure standards. Earlier, prior to ICDS, the department only, the accounting standards were only prescribed, AS1 and AS5 specifically. Okay, so but now they have come up with their own income computation and disclosure standards, which is to be followed by any class of SSCs or in respect of any class of income. The central government has prescribed 10 income computation and disclosure standards as under to be followed by all SSCs other than individual or HF who is not required to get his accounts of one previous year audited. Okay, so it is applicable for all SSCs but not those individual or HF who is not required to get its accounts of one previous year audited in accordance with 44 AB. But please be very careful. So it is applicable to all SSCs who are following mercantile system of accounting. So the ones who are following cash basis, they don't need to comply with the provisions of ICDS. Please be very careful on this. ICDS, the compliances, or let's say with the provisions of ICDS will be for all SSCs, but the ones who are following mercantile system of accounting for the purpose of computation of income chargeable under tax from profits and gains of business or profession or income from other sources. So you have to basically follow mercantile system of accounting. Then the provisions of ICDS will be applicable to you. Okay, now you don't have to learn all this. Okay, there are, I told you, 10 basically ICDS standards, 10 income computation and disclosure standards relating to accounting policy, inventory, construction contracts, revenue recognition, fixed assets, changes in foreign exchanges, etc. Okay, now please be very careful guys with respect to this aspect. The above ICDS are to be followed by all SSCs following mercantile system of accounting. Okay, the ICDS needs to be complied with all SSCs who are following mercantile system of accounting. Therefore, it is clear that those SSCs who are following cash system of accounting need not follow the ICDS notified above. So the ones who are following cash basis of accounting, they don't need to comply with ICDS. Okay. Now, why did I teach you all this? Why did I go with the basics of ICDS? Now let us understand this part. Okay. See, again, this clause has got two aspects: methods of accounting and ICDS. Now, if somebody has opted for cash basis of accounting, okay, will ICDS be applicable on him? Is he required to comply with the provisions of ICDS? The answer is no. Right now, okay, now parts D, E, F. Now in this clause 13, D, E and F, as I have told you, it pertains to ICDS. So what all things do we have to mention about ICDS? Number one, whether any adjustment is required to be made to the profits or loss for complying with the provisions of income computation and disclosure standards notified under section 145 subsection 2. Now see, it might so happen, please understand that, you know, the books was prepared by the, let's say it is an individual, and it's a proprietor, and when he was preparing his books, he did not comply with ICDS. I mean, he just prepared the books, and he did not follow the ICDS. But then again, when he's filing the returns, or let's say if it is a case of tax audit, again he needs to do certain adjustments. He might need to do certain adjustments to bring his basically books and consequently his income as per ICDS, right? So whether any adjustment is required to be made to the profits or loss for complying with the provisions of ICDS. So if there was any adjustment, if there are any adjustments to be done, number one. If answer to D above is affirmative, okay, if let's say adjustments needs to be done, then you need to give details of such adjustments. You need to mention the ICDS number, the name of the ICDS, if because of the adjustment there is increase in profit or decrease in profit, and the net effect. Okay, so number one point, if there are any adjustments to be made in your profit or loss. Second, if the answer to this is yes, we are going to mention about the kinds of adjustments and the corresponding impact it has on the profits, whether because of the adjustment there is an increment in the profit or decrement in the profit, net effect. Okay, and then there are certain other things that needs to be disclosure as per ICDS. So we have to disclose as per the 10 ICDS standards. Okay, so all the standards name will come and the relevant disclosures will come. Okay, so D, E and F is basically for all the assessees who are following mercantile system of accounting. Please be very careful that it will not be applicable to the assessees who follow cash basis of accounting, cash system. Okay, so in short guys, again if I want to summarize this clause 13, it is of course with respect to books of accounts. So if I want to summarize this, there are two aspects here. Clause 13 has got two aspects. Okay, number one was with respect to what? Method of accounting, and the second is with respect to ICDS, right? Under method of accounting, what are the three things that we have to basically write about? Number one is method. Number two is basically what? The changes. And number three, if the answer to this is yes, then let's say impact. I'll just write the word impact on profit and loss for your understanding. Okay, what is the point that we need to mention with respect to ICDS? Number one, if there are any adjustments to be done. Yes, if the answer to this is yes, then what are we going to give? If the answer to this is yes, then we are going to give the details, let's say impact on the profit and loss. And then the third part is basically with respect to disclosure as per ICDS. So this is A, B, C, D, E and F. Very simple. In very simple manner I have written it for you. Okay, but then again this ICDS portion, it is going to be applicable to whom? It is going to be applicable to all assessees except individual or HUF who are not required to get their books audited. Okay, so this is one condition, and at the same time applicable to all assessees except individual or HUF who are not required to get their books of accounts audited, and it is only applicable for those entities who follow what system of accounting? Mercantile system of accounts. Okay, so this is again just for your understanding. This would basically help you in revising, or let's say understanding clause 13 in a very quick manner. Fine. Any doubts, guys? Any doubts?
No, sir.
Done. Okay, great. All right. So again, let us just try and recall the different clauses. What was clause 1 and 2 about, guys? 1. Clause 1 and 2. Name and address. Great. Okay. 3 and 4.
And
yes, and PAN is basically registration for direct taxation, and let's say for indirect tax registration 3 and 4. Okay, 5, 6, 7 I told you to remember together. Status of the individual, status basically of the SSC, and 6 and 7 previous year and assessment year. Okay, right. Clause 8 again. Now clause 8 has clause 8 and 8A also. So clause 8 is basically as to the applicability of section 44AB, under which section, under which clause of section 44AB is the tax audit conducted. Okay, and 8A is only for companies. Whether my company, whether my SSC is a company, if the SSC is a company, whether they have opted for the concessional rate of taxation. Okay, this is what I have to mention. So the answer to this will be either yes or no. Okay, all right. So in part B, clause number 9 that we covered is with respect to partnership. Okay, I told you we have to give details of the partners, the profit sharing ratio, and the changes. Okay, 10 was basically with respect to the nature of business. If they are carrying on multiple business, we have to give them the details, and if there is change in the nature of business. Okay, 11 was with respect to books of accounts under 44AA. 3 things we have to mention. I think I made a summary also. Yes, 3 things. Whether prescribed under section 44AA, list of books plus their location, and books and or documents which has been examined or verified by you. Okay. So, yes, clause 12 was with respect to presumptive income scheme, and 13 also we have covered, which is basically method of accounting and ICDS. Okay. Now, let us cover one more clause, which is, let's say, on method of valuation of closing stock. See, the clauses that you are considering, right? Now, all these clauses which is a part of, tax audit report, I mean 3CD, the statement of particulars, all these are points wherein there can be a lot of impact on the profit and loss. So if you see stock, closing stock, if there is some gapla in closing stock, if they have changed the method of valuation of closing stock, it would impact the profits. Okay, so that is why income tax department is very concerned that if there is change, what method of stock valuation are you opting, and if there is any change in the method of valuation of your stock, you have to report. Okay, so let's understand this method of valuation of closing stock, which is basically clause number 14. So method of value, what is it that we have to mention here? Method of valuation of closing stock employed in the previous year. Method of valuation. Now generally, see, the institute generally says, let's read this point, section 145A provides that the valuation of purchase and sale of goods and inventory for the purpose of computation of income from business or profession shall be made on the basis of methods of accounting regularly employed by the SSC. So if the client wants, Income Tax Act doesn't put any restriction. They can also value their inventory as per LIFO method. Okay, but yes, they have to be regular, they have to be consistent. If they are changing, let's say method of valuation of closing stock, if there is any deviation, details of deviation, if any, from the method of valuation prescribed under section 145A, if there is any change from what has been prescribed under section 145A, then the effect thereof on the profit or loss needs to be furnished. So see, the agenda, the insight, the logic behind coming up with these points in tax audit report, the income tax department just wants to see that whatever changes you have done, be it with respect to, let's say, ICDS or adjustments that you have done, or be it with respect to the method of stock, valuation of closing stock, how it is impacting your profits. Okay, because ultimately then consequently it will impact the tax liabilities, right? So the department is very cautious in this regard, right? So what are the two things that we have to mention here? Methods of valuation of closing stock is number one thing, and secondly, I am not talking about changes in the methods. If there is any deviation from what has been prescribed under section 145A, okay, so details of deviation, if any, from the method of valuation prescribed under section 145A, and if there is a deviation, what are the impact? What is the impact of the same on the profits or loss? Okay, so let us now understand first 145A. Okay, then only we'll be able to report, right, if there is a deviation from the prescribed section 145A. Now it says, for determining the income chargeable under the head profits and gains of business or profession, the value of inventory shall be made at lower of actual cost or net realizable value computed in accordance with the ICDS notified under subsection 2 of section 145. So it can, of course, the valuation of inventory will either be, let's say, made at lower of actual cost or NRV as per ICDS. Okay, and please be very careful here. The valuation of purchase and sale of goods or services of inventory shall be adjusted to include the amount of any tax, duty, cess or fee by whatever name called actually paid or incurred by the SSC to bring the goods or services to the place of its location and condition as on the date of valuation. So basically, in short, please understand this, that section 145A is basically asking the SSC to follow inclusive method of valuation. When I say inclusive method, it simply means that the SSC has to basically include the amount of any tax, duty, cess or fee which has been actually paid or incurred by the SSC to bring the goods or services. So please understand this, that when we are valuing, when the SSC is doing valuation of inventory, they have to follow inclusive method. Okay, we just call it as inclusive method. Now, to make things very clear, I'll just give you an example here. Okay, again, this is a part of taxation, but let's do it. Okay, it says, I have given a note here, accounting standards mentions exclusive method. Okay, as per AS, AS tells us to follow exclusive method, but again 145A mentions inclusive method, but then again there will be no impact on the profitability. How? Let us understand. Okay, I'll just give you an example here. Let us understand a case wherein I'll make a profit and loss statement on the basis of inclusive statement. Okay, and let's say on the basis of exclusive. Okay, let's do an example. Okay, so let's take the example. Let's say there's a firm, X and company. Okay, I'm just giving you a very brief details. Okay, they have opening stock of rupees 3 lakhs. Okay, and let's say this is excluding GST rate. How much should we take? Let's say at the rate 5%. This is excluding GST rate. Okay, and then they purchased 3 items during the year. Purchase. Okay, 3 items. They purchased 3 items during the year, and the purchase amount is, let's say, rupees 2,50,000 per item. 2,50,000 per item, and GST on purchase. Let's say GST on purchase is 5%. Okay, and let's say how they had opening stock of this much, they purchased 3. Yeah, let's take the case of sale. So they sold 3 out of, let's say they sold 2 items. They sold 2 items at the rate, let's say, rupees 4 lakh. Okay, per item, and GST on sales is how much? Let's say again 5%. So in order to just make things very easy, 5% everywhere. Okay, now this is the basically data which is given to you. Now if I opt for inclusive method, guys, okay, inclusive method basically is let's say as per the Income Tax Act, section 145A, we have to follow inclusive method, and then we can go for an exclusive method also. So if I go with the inclusive method, guys, okay, let's talk about the PL. Okay, so if I draw a PL, okay, I'm just doing it roughly. Okay, what would be the sales amount, guys? Now in sales, let's say I'm writing by sales, what would be the amount? 4 lakh was the amount. Okay, and I have to include GST of 5% on it. So 5% will be how much? 20,000. So in sales figure, I'll write how much? 4 lakh 20,000. Oh, okay, no, this was 4 lakh per item, right? So how many items are sold? 2. Okay, so this will come to how much, guys? 8 lakh 40,000. Do you all agree with this? Sales. Yes or no?
Yes, sir.
Yes. Okay. Now, how much was the opening stock? Opening stock was 3 lakhs. Okay, and 3 lakhs GST is, let's say we have only 1 unit in opening stock. Okay, let's say, and 3 lakh. So 5%. So let's say opening stock will come to how much? 3 lakh 5%. 3 lakh 15,000. ठीक है ना? You have to help me out guys here, right? What about purchases? To purchases, how many items they have purchased? 2,50,000 per item. 3 items they have purchased, and then we have to add 5% GST. How much will it come, guys? 7,50,000, right? 3 items, 7,50,000, and then we have to add 5% GST. How much does it come to? 7,50,000 into 5% GST. Okay, so it will come to 7,87,500. Is this clear? Yes or no, guys?
Yes, sir.
Okay, but then if we are following an inclusive method, what is going to happen? Are you going to get, when you let's say when you purchase, are you going to get GST credit? Yes or no? Are you going to get the yes? So let's say by okay, first let me write about closing stock. How much will be the closing stock now? One opening. How many items did we sell? 2. 3 purchased. Okay, how much will be the closing stock now, guys? Yeah, 4 items, 2 sold. Okay, so for 2 items, basically how much will be the closing stock? 2,50,000 do 2 and on it 5% GST. Yeah, will it come to 5,25,000? Yes, because we are left with 2 units. Okay, now of course you must have got some ITC input credit, right? So let's say by GST credit, I'm just writing here, okay, for your understanding. By GST credit, how much credit? 87,000. It was coming to 7,50,000, right? So how much amount have we taken as GST? 6. How much amount, guys, as GST? Taken on cost of goods sold. We are going to consider GST credit now on cost of goods sold. Yes, please. Can you please calculate this, guys? GST credit. Okay, let's say it comes to. Let me do the calculation. 27,500. Okay, and of course you will have to pay GST also. To GST paid. You are going to pay GST on sales. So this amount, how much is it? 40,000. So now if you compare the profits, guys, okay, let's say to net profit, or let's say, sorry, not net profit, gross profit. Okay, let's say the gross profit now comes to 2,50,000. Okay, now in the case of exclusive method, how are things going to be dealt with? So we are just going to write what? We are not going to consider the GST aspect here. Okay, so the sales amount would be without GST now, 8 lakhs. Okay, the closing stock will come to how much? 5 lakhs. And opening stock will come to how much? 3 lakhs. Very simple. The purchases was how much? 7,50,000. We are not going to consider the GST aspect. So again, if you see 8, 5, 13, okay, and this is how much? 13. The gross profit will come to how much? 2,50,000. So in what I'm trying to explain to you is, either method you follow, the ultimate result will be the same. The ultimate result is same, right? But for your understanding, you have to understand this as per accounting standards, as per AS. AS basically mentions to follow exclusive method, and as per 145A it mentions inclusive method. But in either case, guys, the profit is going to remain the same. Alright, so this is just for your understanding. Of course, again, you are going to learn more about it when you cover section 145 in your Income Tax Act. But as of now, guys, what do we have to follow? In this particular clause, you have to know about 2 things. What are the 2 things? Number 1, what is the method of valuation of the closing stock, and whether the method is as per 145A or not. So in case, please be very careful, in case our methods basically is our accounting has been as per AS and we are doing a exclusive method, then of course then you have to report. So if there is a deviation from what is prescribed under 145A, so this is a very common thing. I mean, if there is a deviation, if the SSC is not following an inclusive method, of course then you have to mention. Okay, like see, under section 145A, the methods prescribed are very much similar to the principle of accounting standards, but the only difference is 145A says to basically follow inclusive method, whereas AS basically says to follow the exclusive method. Ultimately, for indirect taxes, but ultimately the impact on the profit is going to be same. There will be no change in the profit. Okay, so the effect of profit as such will not be there, right? So very simple. Clause number 14 is over. Two things again. Method of valuation of closing stock. Don't make this mistake. We are not reporting on the changes in the method of closing stock, but rather if there is a deviation from what is prescribed in section 145A, then the same needs to be reported with the effect on the profit or loss. Right? Is this clear, everyone, guys? Is the example clear? I see. This is again, I'm telling you, I'm just trying my level best to make all the provisions very clear to you. But again, to be very honest, if I go into the details of the entire clause of tax audit, it is going to take a lot of time, and of course this should be then a subject matter of income tax. Okay, so I am trying my best to give you knowledge of the provisions in a very brief manner, trying to be as much as practicable as possible and covering the syllabus from the perspective of auditing paper. All the questions that has been asked, all the questions that will be asked, you will be able to solve it. Okay, so yes, we are done with now clause number 14 also. Any doubts? Alright guys, so we were studying the form 3 CD, which is basically the statement of particulars, and up until now I think we have covered 14 clauses. Okay, so what are the clauses that we have covered? Let me just remind you quickly that there are two parts in form 3 CD. One is basically part A, which pertains to the basic information about the entity, okay, about the SSC, wherein clauses from clause number 1 to 8A is covered. Okay, so part A basically consists of the name clause, name and address I told you to remember together, then permanent account number, that means income tax registration number and other registration numbers also with respect to the indirect taxations. Okay, then 5, 6, 7 together, the status of the SSC, whether it is an individual, HUF, company, firm. Okay, then previous year, assessment year. Clause 8 basically tells us we have to basically mention the clause under section 44AB where the applicability rather. Okay, so whether it is because of the turnover exceeding 1 crore rupees or because of the gross receipts, let's say is a professional, the gross receipts exceeds the amounts, specified amount, so we have to mention the clause. Okay, then we have 8A. 8A is basically, I told you, this is a new point added, and this is for basically companies. Okay, companies have been given an option for concessional rate of taxation. So whether if our SSC is a company, okay, number one, whether the company, whether our SSC has opted for the concessional rate of scheme, we have to answer this in yes or no. Okay, so this was entire part A. Okay, in part B we started with clause number 9, which is partnership. 10 is nature of business, the changes therein. Okay, 9 basically partnership, you have to mention two things. I told you this, that if it is a firm, we have to write the name of the partners plus their profit sharing ratio. If it is a AOP, the name of member plus the profit sharing ratio. Okay, under 9B basically we have to mention the details of changes in the previous year. Okay, next is basically the nature of business. So I told you that you have to mention here the nature of either your business and or profession. Okay, and changes during the year, we have to give the particulars of the changes. So I in fact asked you also, how do you practically how do you specify the nature of business? So there is a drop down you have to select, and then a code comes. Okay, all right. Then regarding books of accounts, okay, this was a important clause that we covered. Okay, so regarding books of accounts, I told you two things. Section 44AA is with respect to maintenance of accounts, and we covered two cases here. Okay, so persons carrying on the specified profession. So there are 7-8 professions mentioned here, and if their two conditions are fulfilled, if their gross receipts, let's say in the preceding 3 years exceed rupees 1,50,000, they have to maintain the specified books of accounts. What are the specified books of accounts? Cash book, journal ledger, photocopies of let's say bills of receipts if they have issued, which is greater than rupees 25, and original bills of expenditure greater than rupees 50. Okay, in all the other cases, all the other SSCs, of course they might have to keep books of accounts if required, if needed, unless let's say they are into those presumptive scheme of taxation. They have to maintain books of accounts, but as such no books has been prescribed. Okay, so prescribed books is only for persons carrying on the specified profession. Okay, so now under section 40, under this clause number 11, okay, we have to be careful about 3 things. Number 1, books of accounts, whether it has been prescribed under section 44AA. If yes, we have to mention the list. Just a simple question again. If let's say the SSC that we are auditing is a company, so will this part A of clause 11 be applicable? Whether the answer is no, because this is only for specified professionals, and the companies, they have to maintain their books of accounts as per the relevant statute. Okay, so next is for other SSCs, what are the books that they have maintained and the location, and thirdly, what books and documents have been examined by us as auditors. Okay, now very important point that you have to understand here is I told you that for company, there is no books prescribed under section 44A of the Income Tax Act. Rather, it is prescribed as per the relevant statute. That means the Companies Act 2013. Okay, this was clause number 11. Alright, then clause number 2 was again with respect to presumptive scheme of taxation. So we have to basically, write 2 things here. Okay, we have to write, if our SSC falls under presumptive scheme of taxation, we have to write 2 things here. Number 1, basically, if it includes any profits and gains accessible on presumptive basis, if yes, indicate 2 things: amount and the relevant section. Okay, so but be careful, I told you one thing, this will be more clear when we go through the questions. We are going to discuss clause wise questions also towards the end. Why I am keeping the questions towards the end in this particular chapter? Because so that we are able to revise the clauses again towards the end. Okay, so we'll do all the questions that have been asked in the exam. So there also you'll see that when a question is asked with respect to presumptive taxation, okay, so please remember 2 clauses. Okay, clause 8 also, the applicability of tax audit, and clause 12 also. Okay, then we covered 13, method of accounting and ICDS. So I told you that income tax, basically method of accounting, it can be cash basis or mercantile basis. Okay, and if there is any change in the method of accounting employed in the previous year, so first 3 points, if you can see, it is with respect to accounting. Okay, and if there is any change, if there is a change, if the answer to this is yes, then we have to give the details of such change and the impact, basically. In short, if I say impact of such changes on the profit and loss account. Okay, then point DEF is with respect to ICDS, whether any adjustments have been made with respect to ICDS. I think I made a chart also for this. Yes, whether any adjustments have been made. If the answer is yes, the details have to be given, and then finally disclosure as per ICDS. But please remember guys, ICDS is applicable to all SSCs except for individuals and HUFs who are not required to get their books audited, and at the same time who also follow, all the SSCs who follow mercantile system of accounting. If somebody is following cash basis of accounting, then ICDS is not applicable. Okay, they don't need to comply with the provisions of ICDS. Okay, then we covered this method of valuation of closing stock also, guys. I think this was the last clause that we covered in the previous session. So method of valuation of closing stock is basically, you just need to understand that we have to mention the method of valuation of closing stock. Okay, and secondly, if there is any deviation from what is prescribed under section 145, then we have to basically make a table and state the impact. I mean, whether there will be increment in the profits or decrease in the profits. Okay, now 145, let me be very clear on this, that regarding stock, even income tax, as per income tax, you can also maintain your stock on LIFO basis. Okay, so it doesn't specify a method as such, but it says that you need to regularly follow it. So it says that whatever valuation of inventory, the method you follow, basically it shall be made on the basis of methods of accounting regularly, which is regularly employed by the SSC. Okay, now generally what happens is, you all know this is very similar to AS, but yes, lower of cost or NRV, I mean lower of actual cost or NRV, whichever is lower, basically we have to value the inventory. And secondly, the income tax, basically just to ensure, I mean just to make you understand, I gave you an examples also, which is very simple. simple inclusive and exclusive basis. So accounting standard mentions exclusive basis of accounting of for stock, and 145A, this particular section, it mentions inclusive method. This is the only difference. However, it is not going to have any impact because profit in both the cases, I showed it to you practically also, it is going to be same. Okay, so these are the clauses that we have done up until now, guys. And see guys, let me be very clear on this, that you must have realized it also that there are things, I mean, I don't want the students, my students specifically, to have this feeling in their minds that tax audit is boring and all. Of course, see, many students find it complicated, and I've already told you the reason of complicacy. I mean, why do they find it complicated? Because some of you might be appearing just for one group, you are yet to study direct tax, and probably because we are covering all the sections of taxation here, you are not going to open the section and do all the research and relevant connections and all. Okay, so here what I am trying to do is basically why we take longer time basically in tax audit. I am trying my best to make you guys understand the relevant section also, though not in detail. Of course, your DT faculty will be doing that. Okay, but yes, whatever I think is relevant for your understanding and for your practical purpose also. Okay, at least that much I feel I should be discussing with you. Okay, so with this intent in mind, okay, let us now understand the remaining clauses. We are going to now start today with clause number 15. Up until clause number 14 we have covered it. Let us start now with clause number 15. It says conversion of capital asset into stock in trade. Okay, so this is again just a heading, as I told you earlier, that we are only going to this is just for your understanding. Okay, so that somehow you are able to remember the clause. Okay, so clause number 15 is if the SSC, he converts his capital asset into stock in trade, then we have to give particulars of the capital asset converted into stock in trade. Okay, so let's say I have a capital asset. Okay, I am using a very heavy, let's say, PC machinery, or a very supercomputer, let's say, not supercomputer, but a very powerful computer for recording the lectures, let's say. Okay, now then again, after few years, let's say after 1.5 years or 2 years, I start the computer business. Then because I have this computer already, okay, I might convert it into what? My stock in trade. Okay, because now I am dealing into computers. I have a computer shop. So what will happen in that case? If you are converting your capital asset into stock in trade, so what particulars do we need to give in tax audit report? Let us understand. Give the following particulars of the capital asset converted into stock in trade. What are the particulars? Description of the capital asset. Okay, number one. Date of acquisition we have to give of the capital asset. What was the cost of acquisition and amount at which the asset is converted into stock in trade. At what amount now the capital asset is converted to stock in trade. These are the details that we have to provide. Okay, what are the four things again? Description of the capital asset, date of acquisition of the capital asset, cost of acquisition, and then again asset at amount at which the asset is converted into stock in trade. Okay, now again, don't just go through, okay, these are the things that we have to mention in the 3CD, but understand the intention behind this clause. Okay, now let's say I own a land. Okay, it is my capital asset, but then I become a real estate broker, or let's say I get into real estate business. Now I convert it into my stock in trade. So what is going to happen? Please understand. Let's say if it would have been my capital asset, okay, and then I sell it, I transfer it. I mean, there is a case of transfer of capital asset. Of course, then what is going to arise? Capital gains will arise, and capital gains, I'll not be able to claim much of expenses, right? What is going to happen? Let's say I bought a land in 2011. I'm selling it in 2021. Let's say. So what is the maximum benefit that I can get? Let's say I'll whatever consideration I receive minus the index cost of acquisition of the land, I'll do the indexation and some other, let's say, expenses if allowed. This is what I can maximum do, and whatever difference amount comes, okay, this will be my capital gain, right? But then imagine if I convert it first into stock in trade, okay, and let's say I'm selling it at some amount, but then because now it is my business, it is in my stock, I'll claim so many expenses against it, that for selling I did this, I did that, and I did all the expenses you can claim. So there will be a loss to the department, right? So department wants to be very much alert with this point, that if you are converting your capital asset to a stock in trade. You can do it, but there are certain points that now you need to understand. Okay, so these are the details as such that the auditor needs to ensure, the company, the SSC needs to fill in. Okay, but now let me just tell you a few points here. As per section 45.2 again, this is with respect to capital gains. Okay, it says such a conversion or treatment of capital asset into stock in trade will be deemed to be a transfer of the previous year. It will be considered as transfer of the previous year in which the asset is so converted or treated as stock in trade. So I'll give you an example. Okay, let us first take an example and then I'm going to read these points out. Okay, now what is the example? Let me just put it in this way. Let's say there is Mr. A. Okay, he owns a land. He owns a land and let's say he purchased it on 25th April 2010. Okay, and the cost of the land is, let's say, rupees 10 lakhs. I'm just trying to explain this with the help of an example. Okay, so Mr. A purchased land on 25th April 2010. Okay, now he converted the same land, into his stock in trade. He converted the same land, was converted into, I'm just writing stock. He converted the same to stock in trade, let's say in the financial year 2019-20. Okay, and when he converted, the fair market value of land 10 lakhs say kitna ban gaya, from, let's say, it was 10 lakhs initially and then it became 1 crore, or let's say 100 lakhs. Okay, now please be very careful. So he converted his capital asset, this was capital asset, right, and he converted it into stock now. Okay, in 2019-20, wherein the fair market value of land was rupees 100 lakhs. Okay, now please understand, in 2020-21, let's say, further what he did, he sold this land now. Sold when? Let's say in 2020-21. Okay, he sold this land for rupees 1,50,000. I mean 150 lakhs. Okay, now I just want you to understand the entire transactions, the scheme of transactions and the taxability that is going to arise. Okay, so what I'm trying to tell you is the land from capital asset, it was converted to stock in trade in 2019-20. Okay, so as such there is a transfer that your capital asset is now being converted to stock in trade. Okay, so capital gains should arise in which financial year, guys? I'm asking financial year. Capital gains will arise in which financial year? Yes. Please tell me, guys. Capital gains, he converted his capital asset into stock in trade. So capital gains will arise in which case? So in which year? So let's talk about capital gains first. How much will be the capital gain, guys? Fair market value at the date of conversion was how much? 100 lakhs. Okay, and then he bought the land at how much? From 10 lakh rupees. Okay, so minus, I'm just writing it in short, 10 lakhs into if you remember, for 1920, what is the index cost? What will be the index cost of acquisition? 289, let's say, upon 167. I'm just calculating roughly. Okay, 17 lakhs, let's say it comes to 17 lakhs 30,538. Okay, and the balancing figure, let's say somewhere around 82 lakhs, Okay, this is his capital gain, and this capital gain, it has been computed in which financial year? Computed in which financial year, guys? 2019 and 20. Do you understand this part? Is this clear? Capital gains will be computed in financial year 19 and 20. Do you understand this?
Yes.
Yes. Okay. Now there will be some profits and gains. Okay, from business and profession also. Some business income will be there. So he sold his land for how much, guys? 150 lakhs. Okay, so let me just write the sale consideration. He did the sales in how much? 150. What will be the cost? He acquired it. How much? This is the fair market value, right? So 100 lakhs. And the remaining amount will be his business income now. Okay. Now my question to all of you is, this business income will be taxable in which year? Yes, taxable in which year? He sold it in which year, guys? 2021? Yes.
2021.
2021. So this will be taxable in financial year 2021. Okay, but now a very important point to understand here is, okay, see that the capital gains on conversion of capital asset to stock in trade, you have to compute the, let's say, long term capital gain. It was computed in the financial year 1920, but very important point to understand here is that this amount, you know, the capital gains taxability, you know, it is going to be, this 82 lakhs will be, is chargeable. It is going to be chargeable to tax in financial year 2021 when he actually sells his asset. So the LTCG is computed, let's say, in financial year 1920 only, but then it is going to be chargeable to tax. The tax thereof needs to be paid, let's say, for in financial year 2021. This is what you have to understand. Okay, all right. Now this is basically the entire section which I wanted to teach you. Now if you have understood this, with the help of example, things will be very clear to you. Okay, so let me just make you go through this sentence again. It says, as per section 45 subsection 2, such a conversion or treatment of capital asset into stock in trade will be deemed to be a transfer of the previous. It will be deemed to be a transfer in which year? As per my example, it will be deemed to be transferred in which year? Of course, financial year 1920, right, in which the asset is so converted or treated as stock in trade. However, very important line, the capital gains arising from such a transfer will become chargeable in the previous year in which such converted asset is sold or otherwise transferred for calculation of capital gain arising from such transfer. Do you get this point? Just to make you understand this line, perhaps now with the help of this example, is it clear or not? Yes. So this capital gain, the transfer happened in financial year 19 and 20, but basically the chargeability of tax will arise in which financial year? 2021. Why? Because in 2021 this capital asset which has been converted into stock in trade, because in 2021 this was sold. Okay, so the liability, the capital gains, you have to pay in the year in which basically the stock in trade is now sold. Okay, alright, so this is what I have to make you understand. And again, why does the income tax want this detail? I have already told you, because if they convert their capital asset into stock in trade and they merely sell it off, they'll say that there is no transfer, then again it will be a loss to the department. And I gave you the reason also that, okay, even if they convert to business asset and then sell it, of course the income department will charge some tax, but there might be loss of revenue to the department, because I told you, if a particular stock, now land is sold as stock, they'll claim a lot of expenses against it, right, in the PL, which will be allowed, let's say, because it is a PGBP income now. But then department is very cautious. Department says you cannot be smart, we'll charge both. We'll charge capital gains also and we'll charge PGBP also. Okay, so is this clear, guys? Clause number 15.
Yes, sir.
Yes, all right. Let's move to clause number 16 now. Okay, it says, okay, clause 16 is amounts which are not credited to P&L. Okay, so let's read this point. Okay, clause number 16 is, it's a big lengthy point. Let's understand it. Okay, so it says, clause 16, amounts not credited to profit and loss account. Okay, any amount, let's say, which is not credited to profit and loss account. Okay, being items falling within the scope of section 28. Now if you remember, guys, section 28 is the charging section of PGBP. It states all those thing basically which will fall under PGBP. Okay, so whatever is mentioned in section 28, you have to basically credit it. If you have earned anything, you have to credit it in your PL account. Okay, so it says amounts not credited to profit and loss account being the items falling within the scope of section 28. Okay, what are the items falling within the scope of section 28, guys? It can be profits and gains of business for profession. Okay, let's say compensation received on termination of an employment. It can be export incentive. It can be amount received under key man insurance policy. If you remember this key man insurance policy, I'm very sure you have gone through these in CA intermediate. Okay, so section 28, anything which is mentioned, let's say in section 20, non-compete fees. Okay, so it has to be, if the SSE has received any such kind of money, okay, it has to be basically credited to the PL account. Okay, so amounts which are not credited to profit and loss account, let's say any item which is there in section 28, if it has not been credited, okay, Okay, next, let's say the pro forma credits, drawbacks, refund of duty of customs or excise or service tax. Okay, so this is a point with respect to drawbacks, or refund of sales tax or value added tax, where such credits, drawbacks or refunds are admitted as due by the authority. Very important word to understand, which are admitted as due by the authorities concerned. Now, very simple point, guys. If you are receiving any refund, let's say, or in case of exports and all, you receive drawback, okay, duty drawback, okay, if you are receiving any refund of duty, customs, excise, service tax, or refund of sales tax, okay, it should be credited to your P&L account. Okay, but the point here is very important point to understand here is the word admitted. The word is admitted here. Okay, when I say the word admitted, it simply means that, you know, it has to be admitted. I mean, you have made a claim. Let's say you have made a claim for receiving a refund or drawback. You, on making a claim, doesn't mean that you have to credit the amount in your P&L account. It must be admitted. Let's say the department has admitted the amount, okay, that this is the refund that they are going to give it to you. Then you need to show it in your credit side of the PL. Okay, the word is admitted. In exam, a question was asked that only a claim has been made. Okay, it has not, let's say, not been admitted yet by the department or authorities. Then there is no need to basically credit it to PL. The word is admitted here. Okay, all right. Next is escalation claims accepted during the previous year. Now, escalation claims is basically, guys, with respect to contractors. Now, what is escalation claim? Again, let's say, I think I have written this point here also. Yes. Escalation claims is particularly relevant to SSC, engage in real estate, construction, infrastructure, business and all. So what happens is, you know, what is this escalation claim? Now, sometimes, let's say, if I am into construction, or I am into a contract, I am a contractor, okay, there is a clause in our agreement that in the event of prices being increased, the contractual price will go up by this amount, let's say. Okay, so if there is an escalation, you know, there can be an escalation point, I mean claim, I can make it, okay, if there is an increase in the price and all, right? So if an exclamation, escalation, I'm saying exclamation, if an escalation clause, or let's say claim, is made, accepted during the previous year, of course, I am a contractor. If, you know, I told them to increase the prices and also they are going to pay me the increased prices. So if it is admitted, I need to show the increased price in my P&L account. Okay, so this is a simple, very simple point. This needs to be created in the PL point. Okay, P&L. Now I told you guys this regarding this point regarding admitted. Okay, so we have a point here. Inquire whether there has been an admitted any claim in respect of a pro forma credit, drawback, refund or duties, etc. Note that item admitted by the authorities will mean that the item admitted before closing of the accounts. It must be, yeah, very important point, it must be admitted basically by the authorities. Let's say if it has been admitted in this financial year, particular financial year, okay, so the income will come in the before closing of the accounts. Basically it should be admitted. Okay, if let's say they accepted but they admitted, okay, I mean, let's say the payment with respect to the same, or they admitted in the next financial year, 6th of April, then it will be credited in my PL account next year, not this year, right? So it says a very important line here. Note that the item admitted by the authorities will mean the item admitted before closing of accounts. I mean, if it has to be, let's say, pertaining to this year. Now let's say there's a company, A Limited, okay, their financial year ends on 31st March 2022, okay, and they made a claim for refund of customs, okay, and which was admitted by the customs authorities, which was admitted in April 2022. Okay, now my question to all of you is, because it was admitted in April 2022, is there any requirement to report in the tax audit report pertaining to financial year 21-22? The answer is no. Okay, the point here is the item admitted by the authorities will mean the item admitted before the closing of accounts. Now because my accounts has already closed in 31st March, they admitted it only in the next year, it is going to be a part of next year's tax audit report. Do you get this, guys?
Yes.
Okay, all right. So coming back to clause number 16, what is clause number 16 all about? Amounts which have not been credited to P&L account. Okay, so number 1 was section 28 items. Number 2 was basically drawbacks, refunds of taxes, etc., which has been admitted by the authorities before the close of the accounts. Okay. Third is basically escalation claims accepted. The word here is accepted. Okay, accepted during the previous year. Okay, any other item of income. Okay, any other item of income. What can be any other item of income? Let's say you have received interest on fixed deposit. Okay, discounts received, insurance claims received, any type of reimbursements. All this will be a part of your P&L account. Okay, and any capital receipt, if any. What is capital receipt, guys? Okay, now this is an important part here. Okay, a question has been asked from this portion many number of times. Okay, it says if there is any capital receipt, generally what happens, please understand this, that okay, I have mentioned here the examples here. Okay, so the following is an illustrative list of capital receipts. Just for your understanding, a question was asked on this part, that what can be the examples of capital receipt which needs to be reported in clause 16 of the 3CD. Okay, so it says the following is an illustrative list of capital receipts which, if not credited to profit and loss account, are to be stated under clause 16E of form 3CD. So if they are not credited to the P&L account, okay, if the SSE has credited them, and then there is no need to report. All the things I am mentioning here, it simply says the amounts are not credited to the P&L account, right? So let us understand some examples of the capital receipts. Let's say capital subsidy received in the form of government grants, which are in the nature of promoters' contribution. So capital subsidy, let's say government grants. Okay, 2 points are with respect to government grant only. Point number A and B, it says government grant in relation to a specific fixed asset. So one is capital subsidy received. Okay, then it is with respect to specific fixed asset. Let's say compensation for surrendering certain rights. So you surrender a right to something. Okay, then if you receive a compensation for it, it is capital received. Profit and sale of fixed assets. This is very simple. Profit on sale of fixed assets or investment to the extent not credited to the profit and loss account. Okay, so if you don't credit it to the profit and loss account, to the extent it is not credited, it is a capital receipt. Okay, so these are the examples, right? So what I'm trying to tell you is, these are things that needs to come in the PL. This needs to be credited in the P&L account. If the SSE has not credited the same in their P&L account, the auditor needs to report in the 3CD, clause 16. Okay, so that's it. This is, guys, all about clause 16, amounts not credited to P&L. Okay, now in short, if I wish to show you, okay, so please remember it in this way. How many points are there? Okay, one is, let's say a basic point. Okay, this is basically scope of section 28, the basic chargeability section of PGBP. Second is with respect to tax. It can be drawback, it can be refund, and it has to be admitted by the authorities. Okay, third is basically escalation claims. This is mostly for the contractors. Okay, then we have capital receipts, and finally any other items of income. So 5 things we have. Okay, capital receipts can be sale of fixed assets, it can be government grant. Any other item is basically, I've already given you certain examples: interest on fixed deposit, discounts, insurance claims, etc. So all this should be a part of your P&L. Okay, all right. Now, okay, so any doubts in this clause, guys? Is it clear? Okay, now let's go to the next clause, which is, yeah, it's a very interesting and sweet kind of clause. Okay, and I'm very sure, in offices also you must have dealt with this in proper manner. Okay, I think there's a mistake here. Clause 17, this should not be amounts not credited to PL. Clause 17 is basically with respect to stamp valuation. Okay, now what is this point all about? Let's understand. Okay, 17 is small. Okay, we don't need to go through much of explanations here, but yes, let's understand it practically. Okay, so it says where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or assessable by any authority of the state government. Okay, referred to in section 43 CA or 50 C. Okay, a simple point, very simple point. Okay, now let's say I buy a land from Prachi. Prachi has a land and I buy it from Prachi. Okay, now let's say what happens is each local area, you know what happens. Okay, let me just give you a brief background also. Okay, the state government, you know, they earn in the form of revenue, which we call it as stamp duty. You must have heard about it. Any agreements and all you make, you buy those stamp papers of 100 rupees, 50 rupees and all, right? And the money that you give to buy those bond papers, or let's say the stamp paper, it goes to the state government. Okay, but the amounts are relatively very small, 50 rupees, 100, 500. This is how we make an agreement, right? But then, you know, state government, what they also get, you know, stamp duty tax, I mean stamp duty on properties, okay, and which is very high. Okay, so the state government's major source of revenue is again this, you know, when somebody buys or sells asset, or let's say movable property, they have to pay stamp duty, and the stamp duty in this case is high. Let's say if I buy a property here in Assam, Guwahati, if I'm buying let's say a commercial area, commercial space, okay, and let's say it is of around 1 crore rupee, okay, just a hypothetical example. So I will have to pay around 5 lakh rupees, I mean 5% of the value to the government in the form of stamp duty. And again, who is going to buy it? Who is going to pay it? The one who buys the property, right? So I need to pay 1 crore rupee to the person whom I'm buying it from, and just to for when I do the, you know, this transaction, I'll have to pay another, let's say, amount of 5 lakhs to the government in the form of stamp duty. Okay, and the stamp duty and all, we cannot claim it also, so it's gone, right? So but this is a major source of revenue for the state government. But then what happens now, this stamp duty value, stamp duty, how much stamp duty do I need to pay? It is dependent on the value of the consideration, right? So what happens is, now I would not be very happy giving 5 lakh rupees as stamp duty. So what I'll tell, let's say I'm buying the commercial property of 1 crore rupee from Prachi. So I'll tell Prachi, let's do one thing, Prachi, let's show that I am paying you only 60 lakhs. Okay, I'll give you 1 crore, but in the banks, I mean in the form of check, I'll only give you 60 lakhs, and 40 lakhs I'll pay you in cash. Okay, so now because I'm doing the transaction, I mean in Pakka, of only 60 lakhs, I'll have to pay stamp duty on what amount, guys? 60 lakhs, right? So I'll be paying on 60 lakhs, which will now, let's say if I take stamp duty as 5%, it is going to come to 3 lakhs. So I've outrightly saved some amount here, right? So this is how people, I mean, generally things operate. Okay, but then again further, I don't want to give 3 lakhs also. I'll tell Prachi, hey, I'll give you 1 crore, but let's show that the value of his property is only 30 lakhs. Okay, now if I reduce the value to only to 30 lakhs, again it is going to be a huge loss for the state government. State government will say, what you are doing? I mean, now if the value is only 30 lakhs, 5% of which is going to be 1,50,000. I will only give 1,50,000 to the state government, right? So state government was like, no, this is not how things should work. So what happened is, the state government, you know, the various departments of state government, they basically now assess the areas, and then they determine the value, okay, which we called it as basically, let's say, assessable value adopted or assessed or assessable by any authority of the state government. So the departments of the state government, they assess the values as per the areas and all, and they determine that, okay, for this area, if this is the type of property, this must be the minimum value of transaction to be done. This must be the minimum amount of this particular area. Let's say the property that I was referring to, I bought from Prachi, let's say. So let's say the government will say that, okay, in this area, the value of property should be 4,000 rupees per square feet. Right now, please understand what is the clause all about. The government has fixed, the state government has fixed that, okay, this is the minimum value, 4,000 rupees is the value as per the government. Okay, now if I try to understand this, okay, so it says where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assigned or accessible by any authority of the state government, then the details needs to be furnished. So let's say the property that I am referring to, the state government, as per the state government, the value of it should be 40 lakhs. Why? Because the rate is 4,000 rupees per square feet. Okay, but then if I only pay 20 lakhs to Prachi for this, let's say if I only pay 20 lakhs to Prachi for this, maybe I might have paid more. I might have paid the balance part in cash, right? But let's say if I'm paying 20 lakhs in white, I'm showing that I have paid only 20 lakhs through check, then the government, then the department, now income tax will also come into play. What we will have to report here, we will have to report, the details of the property, consideration received or accrued, and value accepted or assessed or assessable. So I'll write here what, 20 lakhs, and here I'll be writing 40 lakhs. So 3 CDs, wherever an SSC can, try to fool the department, they have included all the points with respect to it. Okay. Now, the stamp duty, I was talking about the stamp duty, stamp valuation, the stamp duty, the revenue goes to the state government, but then income tax also told, the taxation will of course go to the central government. Okay. Now they are of the view that state government has already determined the value, so let's use that value only for income tax purpose also. Okay. State duty determine the value area wise so that they get the proper stamp duty, right? But this amount only has to be used by income tax department to assess the right value, right consideration. Okay. So it says, again I am reading the point, where any land or building or both is transferred during the previous year for a consideration less than value adopted or assessed or accessible by any authority of a state government referred to in section. Now what is these two sections, I'll tell you. So if I hope the example makes it clear that if I buy it for 20 lakhs instead of 40 lakhs, reporting will be done here. Okay. Now there are 2 points, guys, here. It says as referred to in section 43 CA and 50C. So basically 43 CA is with respect to, let's say, the ones who are holding land as stock in trade. So this is basically a case of PGBP, and 50C is basically capital gains. If I transfer, it says it's where I transfer, okay, it was my capital asset and I transfer, so 50C will be attracted. Okay. So where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or accessible by any authority of state government referred to in section 43 CA, this is for PGBP, and 50C, then the details needs to be furnished. Is this clear now, guys? You understand the purpose? Why would somebody do it? Why would Prachi only accept 20 lakh rupees? Are you getting my point?
Yes, sir.
Yes, okay. Now, the thing is, see, income tax will not be worried about the stamp duty. Or income tax will say that, okay, Prachi, for a thing which was of 40 lakhs, you have accepted only 20 lakhs. So you are going to pay tax on 20 lakhs. We are not going to, understand it. We are going to charge you tax on 40 lakhs itself. Okay. And the department knows it, that how things operate, right? So she must have taken cash for the balance amount. Of course, she is not going to sell a property 50% less rate than what is the minimum value as given by the state government, right? So she must have taken cash. So department is going to be, they might take action. All right. So, all right, now if I go with this section again, guys, very practically, generally what happens, let's say the property that I was talking about, even if the value, fixed by the government is, let's say 4,000 rupees. Again, let me write rupees 4,000 per square feet, okay. But then generally what happens, guys, this is the fair market value. This is the market value. Let's not market value, DLC rate we call it. This has been fixed by the government. But then when you actually go to buy the property in the market value is going to be much higher, always much higher than this. The Prachi will be saying, no, what, 40 lakhs? No, I am not going to sell it below, let's say 1 crore rupees. So then what is going to happen now? If I am the buyer, generally what is going to happen? I'll show that I have bought it in 40 lakhs so that the department, income tax, state government, everyone is happy. But the balance amount will be paid to Prachi in the form of what? Cash. Are you able to understand? Unaccounted money. Samajh mein aaya? Right? Okay. Anyways, all right. So this is how things work. Okay. So a very simple and good point. I hope you are clear on this 43 CA and 50C. 50C is basically if I am transferring the asset. This was my capital asset, and this will arise when this is, let's say I am transferring the land, and this is a part of my stock PGBP income. All right. So yes, we started with 15, 16, and 17. 3 clauses done. All right. Let's come to the next part. Again, this is a very simple clause, depreciation, clause 18, and at the intermediate level, this was a good topic. I mean, a lot of practical questions I think was asked from this area, and you know this, that as per income tax, you know, the depreciation is charged on the block of assets, etc., right? So yes, I have a few points to tell you here. It says particulars of depreciation allowable as per income tax 1961. We have to mention the particulars of depreciation allowable in respect of each asset or block of assets. Okay, so what are the particulars? You all know this, you have been doing it in the office. There is a table given, so description of asset or block of asset, the rate of depreciation, actual cost or written down value as the case may be. Now this is a new point, adjustments made to written down value under section 115 BAA. This is only for guys assessment year 2021. I mean, this is with respect to the concessional rate of tax which you know, a company may opt for. Okay, so there are certain adjustments to be made. Then adjusted written down value, then additions or deductions during the year. This is what you make a table like, right? So description of the asset, rate of depreciation, what is the WDV, then if there are any adjustments to be made, after adjustments what is the adjusted WDV, and then if there are any additions, deletions, etc., you have to you have to take into consideration. So additions, deductions during the year with dates, in case of any addition of an asset, date put to use, okay, and including adjustments on account of central value at tax credits claimed. Now you know this, I believe. Let's say if I buy an asset, if I buy a plant and machinery worth rupees 1 lakh and I pay 18% GST on that, so I have got two options. Either the amount of GST that I have paid, I can capitalize it and I can claim depreciation, but or let's say if I'm taking inputs on those 18%, 18,000, then I cannot claim depreciation, right? I hope you know this, right? So it says if there is an addition, then you have to take into consideration the adjustments on account of central value added tax credits claimed and allowed under the central excise thing, change in rate of exchange of currency if you have bought it from outside India, and subsidy or grant or reimbursement by whatever name called. Okay, then apart from this, what is the depreciation that is allowed, and towards the end, after all adjustments and all, written down value at the end of the year. Okay, so very simple point with respect to depreciation under clause 18, and I am very sure all of you do this. At least this clause is mostly in all cases you have to fill something or the other, or let's say in many cases you write not applicable, but this clause is something that you must have, you know, practically filled in basically in your offices also. Any doubts, guys? Any doubts? Yes. Okay. Now one point I would, again coming to point number, clause number 17. Okay, one point I would like to tell you. Okay, here please understand that, you know, in case I told you that in this example I told you, if there is a difference between the consideration taken and the value as assessed by the state government, we have to report. Okay, but I would like to add one more point here. Okay, let's talk about, we were referring to two sections here. Okay, section 43 CA and one is again section 50 C. What is 43 CA about, guys? This is if the asset is our stock, and 50 C is basically with respect to what? If it is a capital asset. Now is this clear to you? First, is this clear? Right, now please understand, we have to report when there is a difference between the consideration and the value assessed by the government. Okay, but then please understand, we have to report, let me just put it in this way, if let's say consideration, whatever consideration has been received is less than the stamp act value, let me write it in this way. Okay, and the difference, if difference between these two, if difference is more than 10%, earlier it was 5%, if difference is more than 5% of consideration, okay, then it will be taxed. Okay, I told you, I mean, we in our report we don't need to see whether it should be taxed or not, we just have to report. But I just gave you an extra explanation that if consideration difference, basically it is more than 10%, if difference is more than 10% of consideration, then it will be taxed. Okay, now but please understand this, that earlier it was 5%. Earlier it was 5%. This is one thing that I just wanted to tell you. Okay. Now, in case of land and building, if the consideration amount is less than the Stamp Act value, in the 3CD report, what are the three things that we have to give? We have to give the property details of the property, the consideration that is we have received, and the Stamp Act value. Three things we have to mention. Okay. So the addition, whether it will be taxed or not, again, this is to be taken care by the assessing officer. So I just gave you an idea as to when it will be taxed. Okay. All right, guys. Yes, so clause 18 is also done with respect to depreciation. Again, clause number 15, we started with clause number 15. What is 15 about? If you convert your capital asset into stock in trade. Okay, then we covered clause number 16. Under clause number 16, 5 things we covered, that if these things are not credited to P&L account, then you have to report amounts not credited to P&L account. Okay, 17, again, it was a very simple section on Stamp Act value. Basically, this is with respect to land or building or both. Okay, and then clause 18 with respect to depreciation. Okay. Now, coming to clause number 19, again, this is a bit, boring, because there are, see the table here, so many number of sections, 32 AC, AD, AB, and the list still, yeah, so many sections are here. Okay, but then for your understanding, okay, we are not going to dive much deep into this aspect, but yes, for your understanding, how you have to remember this aspect, yeah, let me just tell you this. Okay. All right. Yes. So it says amounts admissible under. Now please understand, all the sections that I have written here, you don't have to learn them anything, right? But yes, these are, let's say, scientific research assets, etc. Scientific research assets, etc. Okay. And it says amounts admissible under this section. Now, just for your understanding, let me just put it in this way, that let's say we have a section here, 35D. We have a section 35D. So section is mentioned, then amount debited to profit and loss account, and amounts admissible as per the provisions of the Income Tax Act, and also fulfills the condition. So what happens is, in respect of these sections, if we incur any expenditure for a particular year, it might so happen that the entire amount is allowable expense. It might so happen that sometimes lesser amount is allowed. Let's say now, for example, 35D. Do you by any chance remember what is 35D about, guys? Do you remember? Okay, I think preliminary expenses. I'm just giving you an example. Preliminary expense. Okay, now, in the P&L, it says amount debited to profit and loss account. It will be how much? 100% of the preliminary expenses will be debited to P&L account. But again, when you do the computation and all, do you remember how the preliminary expenses amount is basically allowed? Kuch yaad hai? 5 years, in 5 years, do you remember? So 20% of this will be allowed, right? So I am saying amount debited to profit and loss account might be 100%, whatever amount is. But what will be the amount admissible? Amount admissible will be how much? For a particular, it is going to be only 20% of the preliminary expenditure. Are you getting my point, guys? Yes. Okay. Now in certain cases, okay, let's say, let me just give you an example. Okay, yeah, from 35 1 to 35.4. Okay. Now, of course, amount debited to PL would be, let's say, 100%. Whatever expenditure they incurred with respect to these sections, 100%. But then, as per income tax, the admissible amount was 150%. So that is why we have got two columns: amounts debited and amounts admissible. So for all these sections, basically, what is the amount debited? If there are any amounts with respect to these sections, we have to mention two things: amounts debited in the PL and amounts admissible. That's it. Okay, you don't have to remember each of these sections, guys. Okay, and if we go with each of these sections here, I'll probably end up teaching you direct taxes, which I'm not very good at, so no point going through all these sections here. Okay, of course you are going to go through PGPP chapter, so then it is better if you go through the sections there. But then again, when you are doing audit, you don't have to have a very detailed knowledge of these sections. Okay, is this clear? Do you understand the clause now? What is the purpose? Basically, how much amount is debited in the PL and how much amount should be admissible. See, assessing officer, basically with all the points that is included in 3CD, assessing officer is only trying to, make things easy for him. He wants the entire data ready-made. Wherever SSC can, try to fool income tax department, they have already incorporated all the points with respect to them, those things. Okay, so they will, through form 3CD, they have got the ready-made data, which of course has been again verified by chartered accountant, right? So it is going to be very easy for them to assess. So that is why everything with respect to very detailed information is sometimes also required to be given in 3CD, right? Okay, so clause 19 is also done. 20 is again, guys, very simple. Okay, let's read the point. Clause 20. I'll not read the heading here first. Let me just try and explain it to you. Okay, now it says any sum paid to an employee. Okay, any sum paid to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profits or dividend. Now, what do you mean by this? Okay, let me read the point again. Any sum paid to an employee as a bonus or commission for services rendered. They must have rendered a service, okay, where such sum was otherwise payable to him as profits or dividend. Okay, now let me give you an example for this. It is going to be better if you have an example. Let's say there is a firm. There is a partnership firm and there are 4 partners, A, B and C, D. Okay. A and B are sleeping partners. They are not active. C and D are active partners. They are what? Active partners. Okay. Now, at the end of the year, all their profit sharing ratio was 25%. Let's say the profit sharing ratio for each of them was 25%. Okay. But then, of course, C and D, because they were active partners, they used to get some extra bonus also. Let's say bonus or commission. Okay. Now, let's say there was a total profit of 400, okay, and each of them will get how much? Now 100, okay, and or let's say before considering after all the expenses, let's say the profit was 400 and it is divided, but because C and D were active partners, let's say they also got 50 rupees extra. Okay, 50 because they were working partner in the form of bonus or commission. Okay, so after giving bonus and commission, whatever was left is divided now equally. Okay, this is how it should have happened. But then what happened? Please try and understand. How much is the firm's profit, guys? How much is the firm's profit? 400. Okay, after all the expenses, the firm's profit is 400 and it was divided. Okay, so basically, if I talk about the taxation part, on what amount will the firm need to pay tax? On rupees? Do you agree with this? Yes. Okay. But then the firm is very smart. What they did, please try and understand. What they did, the profit sharing was 25%. Let's say he got 100, he got 100, and then actually C should receive 150, right? C should be receiving 150. D also should be receiving 150. What they did, they reduced their profits to, let's say, 50 and 50, and here in the bonus part they did 100. Why do you think they must have done this, guys? Yes, I see, my example might not be 100% accurate here, but what I'm trying to tell you is, now bonus is allowable expense or not? Yes or no? Bonus is allowable expense, right? Now the tax will be, the amount on which the firm will be taxed is how much? 300. The partners are also happy because they got what they're supposed to get, let's say. Are you able to understand my point? So if this is done in any particular organization, in any particular case, as an auditor, we have to report. So let us read the line again, okay? This, don't get into mathematics here. I might not be 100% correct, but I just wanted to convey you the information, okay? So it says, any sum paid to an employee. Now these are more or less what? They are active partners, so they might be getting some compensation or in the form of bonus or commission, right? So any sum paid to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profits or dividends. So it was payable to him as profits, but then they have showed it as what? Bonus. So then if the answer to this is yes, details of contributions received from employees for various funds as referred to in. So we have to give the details. Okay, so yeah, so we have to report here and then details. Okay, so this is second part. Sorry, no. So let me just, there are two parts. Okay, one is basically for yeah, I have already explained you this. Now second is basically details of contributions received from employees for various funds as referred to in section 36(1) VA. So it can be what, guys? Let's talk about PF. So of course you all know this. When I talk about provident fund, it has, amount is contributed by the employer as well as the employee. So details of contribution received from employee for various funds as referred to in. So if the SSC has received any contribution from employees for various funds, then the details of the same will come here. Okay, so it will be, of course, it can be PF, etc. Okay, so please now be very careful here that we just have to disclose the amount. We just have to disclose the amount here, and we are not going to give an opinion. In this case also, I am not saying that as an auditor you have to say that this is wrong and this amount has to be added back. No, we just have to give the information. Whether it needs to be added back or not, it is the work of assessing officer. We just have to give the information here. Okay, so I hope the 2 points are clear here. Now see, that is why I told you I'll read the heading later. The heading now, if I read the clause heading, there are two parts: sum paid to employees otherwise payable as profits, number one, and contribution to funds, let's say PF and all. So if the employee has contributed to his fund, the details of the same will come here. Details of contributions received from employees. Is this clear, guys? Two things. Clear?
We need to mention remuneration over here. Partners remuneration.
Part A में पूछ रहे हो क्या?
नहीं,
we just have to mention if any sum has been paid to an employee as bonus or commission for services. So if this is the case, guys, if this happens, then we'll have to mention the, let's say, the amount which has been paid as bonus, etc. But then what I'm trying to tell you is we are only going to disclose the amount and the, just the amount. We as tax auditors, we are not expected to express our opinion that it should be added back or this is the adjustment that needs to be done. We just need to disclose the amount. So aap jo bol rahe ho, this is correct. Okay. Yes, Sutir, you had some doubt.
No, sir.
Okay, all right. Yes, so clause number 20 is also done. Okay, two parts here. Okay, be very careful. One is with respect to contribution to funds, etc., let's say PF, and this is basically, I told you that if any employee has to receive an amount which otherwise he would have received as profits or dividends, then again the disclosure of the amount needs to be done. All right, great. Okay, now we are coming towards I should say that the most extensive and the longest clause in the entire tax audit report. Perhaps this is clause number 21. Okay, 21. If I make you walk through the clause, in clause 21 itself, we have so many number of points. Okay, how many points are there? Okay, clause 21, clause A, sub clause A or whatever it is, 21A, B. Okay, then B is continuing, C 3, D 4, 5, 6, 7, 8, 9. 9 points under clause 21, and that too, if you see, some of the points are huge. I mean, point number B is huge, point A is again huge. So this is the longest, most extensive, I should say, clause in the entire 3 series. But it is very simple, guys. Okay, so let us go through it. Now, clause 21, it says, number 1, I am reading point number A. Please furnish the details of amounts debited to profit and loss account. Okay, being in the nature of, so all amounts, if they are debited, if the amounts, we have to look in for the amounts which are debited into PL. Okay, what kind of amounts we are referring to, what is the nature? Basically, if it is a capital nature, if it is an amount debited to PL which was of capital nature, if it is a capital nature expenditure, of course it will not be debited to P&L. So if a capital expenditure nature is debited to P&L, of course we have to report, right? So then it says again, let me just tell you again here that we just have to report. Again, we are not here giving opinion that this should be added back or etc. If we feel it is a capital expenditure and the SSE has debited it to the PL, then it has to be reported, right? So the capital, if any expenditure which is of capital nature. Second, personal expenditure. You know, it's a company, but the directors were enjoying doing vacation and all the expenses have been debited to the PL of the company. This is wrong. So if the auditor feels it is a personal expenditure, then the particulars needs to be given. Okay, so all right. So capital expenditure, personal expenditure. Then we have advertisement expenditure. Advertisement expenditure, if the company, let's say the SSE, they have done any advertisement expenditure in any souvenir, brochure, pamphlet or the like published by a political party. Now very important point here to understand is, if it is a newspaper or a brochure published by political party and the company, the SSE, makes any advertisement expenditure there, then it has to be basically, the details of this has to be furnished here. Why? Because it is actually disallowed. Okay, but then again, it is actually disallowed. I mean, this is added back if you have debited it into your PL account. But again, if you remember, I mean, there is another way out. I mean, the politicians, they found another way out for this. Okay, else nobody is going to contribute. Nobody is going to advertise in their newspapers or brochures, etc. Right? So what they came out with, okay, this will be added back, but then, whatever amount you pay to the political parties, you are going to get a deduction of the same. If you remember, I think it is in under section 80 GGB. So again, the amount is added back here, but then you will get a deduction in 80 GGB. So this is just a way so that the politicians can be funded, let's say. Okay, anyways, next, these 2 points are with respect to clubs. Expenditure incurred at clubs being entrance fee and subscription. So these 2 points are with respect to clubs. Now please understand, expenditure incurred at club being entrance fees and subscriptions, the annual fees that we pay. So if a company has paid annual fees and all for a club, then we need to furnish the details. And then there is also one more point, expenditure incurred at clubs being cost for club services and facilities used. Okay, see, again, I am not saying that these expenses will be disallowed. It is up to the AO to see. Okay, we are not saying that ye expenses disallow hoga. I am just saying that we have to mention it here. Okay, it might so happen that this particular expenditure was incurred because few of our clients came in, prospective clients from Japan, they came in, and we because the company had membership of a club, we took them to a very fine dining place and we had dinner. So it is a part of business expenses. This is very much allowed, nothing wrong in it. So I am just saying that we need to quote the particulars and the amount here. That's it. Okay, we are not giving opinion as to this should be disallowed or allowed. Okay, then these 3 are basically again more or less same, by way of, these are basically by way of, let's say, penalty. So expenditure by way of penalty or fine for violation of any law for the time being in force. So you all know this, if you pay any penalty or fine added back or whatever it is, so we have to disclose the same. Expenditure by way of any other penalty or fine not covered here. Okay, so let's say this was by law, this was with respect to law. Okay, and here expenditure by way of any other penalty or fine not covered above, that means it can be, let's say because of a contractual, we were not able to meet the requirements of the contract, so we have to pay penalty. Okay, because the penal point was mentioned in our contract agreement. So something other than law, basically. Penalty, you paid penal charges, but it is with respect to, let's say, the contract. Okay, or let's say I was not able to fulfill the requirements of the contract, so need to pay damages, etc. Penalty. Okay, and then we have expenditure incurred for any purpose which is an offense for or which is prohibited by law. Let's say bribe. Okay, so in order to secure the work, a bribe was given. So you cannot debit the bribe in your P&L account, right? So expenditure incurred for any purpose which is an offense for which is prohibited by law. So if these are the expenses which the auditor finds has been debited in the P&L account, he will report about the same in the tax audit report. Okay, so clause 21A is basically, please remember, if the expenditure is of capital nature, personal nature, advertisement in political parties magazine, or 2 points with respect to clubs, 3 points with respect to penalties, if these are the nature of the expenses, then the reporting needs to be done. Okay, next, coming to the next part, it says amount inadmissible under section 40A. Okay, so very simple. Any payment has been made to non-residents, okay, any payment has been made to non-residents, okay, and there are now two parts. Details of payment on which tax is not deducted. So TDS has not been deducted. Now a payment was made to non-resident and TDS has not been deducted. So we have to basically mention the date of payment, amount of payment, nature of payment, and name and address of the payee. But basically this is, you know what happens, guys, this is 100% disallowed. If a payment is made to non-resident without deducting the TDS, basically it is 100% disallowed. This is just for your understanding. Okay, so if this is the case wherein TDS is not deducted, we have to mention these four things: date of payment, amount of payment, date, amount, nature, and to whom the payment was made, name and address. Okay, but then let's say if they deducted the tax, if they must have deducted the tax, sometimes what happens, tax has been deducted but it has not been paid to the government. They deducted the tax but it has not been paid yet to the government. So let's say details of payment on which tax has been deducted, okay, but has not been paid during the previous year. Tax was deducted but it has not been paid during the previous year or in the subsequent year before the expiry of time prescribed in section 201. So if you remember, what is the, tell me this, what is the timeline for TDS payments? Yes, TDS का काम किया, TDS payment returns ऑफिस में किया प्राची? नहीं किया. तो generally it is 7th of the next month, but for the month of March you are given more days. Okay, so if the payment has not been done till then, generally what happens, we have to report here. So what was the case here? The tax has been deducted but the payment has not been made. So date of payment, amount, nature, name, and amount of tax deducted. One more extra point which has been added here is amount of tax deducted. Okay, so this is basically now 139.1. Okay, so the time limit is as per the date of return. All right, so see, what this is very simple. If I tell you, under B part we are going to cover 2 points. One is with respect to non-residents, and same points we are going to cover with the residents. Okay, this is basically subclause IA is basically payment to residents. Okay, and in case of payments to residents, same points, details of payment made on which tax is not deducted, so outrightly 30% of it will be disallowed, 30% disallowed. And let's say if they have, tax has been deducted but they have not paid it, so these are the details that needs to be mentioned: date of payment, amount of payment, nature of payment, same thing, address of pay, amount of tax deducted, and amount out of above deposited. So it might show up, and let's say they have deducted 100 rupees, they have deposited only 50 still left. So this is one more point that we have to mention. Okay, and then again, guys, there are some other points. Okay, we are covering amounts inadmissible under section 40A. So 2 points with respect to TDS. One is for non-residents, B is basically for, second point is for residents. Okay, payment made to residents. But then there are more points. You don't have to remember all the points, but still I'll try and write. Let's say clause, this is for FBT, which is abolished. Okay, this was for clause to wealth tax. This is for wealth tax. Okay, then let's say this is for PF, the employer's contribution. Okay, so you don't have to remember everything, but yes, these are the things that we have to mention in 3CD. Okay, so please remember, only remember this much, that under clause 21, there are how many points? Number 1, again 2, 3, 4, 5, 6, 7, 8, 9. Under 21 there are 9 points. Okay, we have covered 2 points. Number 1 is basically amount which has been debited to P&L, but which is of capital nature, personal nature, advertising, etc. Okay, so we have to report. Second is with respect to amounts which is inadmissible under section 40A. Please remember, this is 40 small a, not 40 capital A. 40 capital A is totally different. Okay, this is 40 small a. Okay, and under 40 small a, we are going to majorly, we have to remember that if any payment was made to non-residents, whether TDS has been deducted or not. This is what you have to see. If it was made to residents, again same thing, whether TDS has been deducted or not. With respect to, let's say, FBT payment, wealth tax payment, if PF had to be deducted, employer's contribution, etc. All these things you have to mention. Okay, now next part, amounts debited to profit and loss account, being interest, salary, bonus, commission or remuneration inadmissible under section 40B or 40BA and computation thereof. Now this is again very simple. Okay, now amounts debited to profit and loss account being interest or salary or bonus, commission or remuneration inadmissible under section 40B. Now we are going to learn it primarily from the perspective of 40B. 40B is for firms and 40BA is basically for association of persons. So if you remember, guys, I think taxation of partnership firms you must have done at CA intermediate level. So what is the maximum interest rate allowable? कुछ याद है? 12, right, yes. So if let's say, if any amount to profit and loss is debited, let's say being interest, salary, etc., inadmissible under section under 40B. So if for a particular partner, let's say the firm is paying interest at the rate 16%, so how much will be allowable? Only 12%, rest 4% will not be allowed. Do you understand this? Again, are there certain conditions with respect to remuneration of the partners? Do you remember? 90% of book profits or 3 lakh, कुछ ऐसा था? Yes. So if those conditions are not complied with, if you are paying extra, or if you end up paying, let's say, not 12% but rather 16% rate of interest, then of course the information needs to be disclosed here. So amounts debited to profit and loss account, let's say, of a firm being interest, salary, bonus, commission or remuneration inadmissible under section 40B or BA. BA is for AOP, and I'm very sure you remember particularly this aspect more. Okay, and computation thereof. Okay, so basically the thing is, any excess amount will be what? Right? Fine. Is this clear, guys? Okay. Alright, now coming to the next part, we are still in clause number 21, guys. Okay, the next part, D part, out of 9 we are now on the 4th part. Okay, so what is this portion? Okay, it says disallowance deemed, or let's say deemed income under section 40A3. Now please be very careful, this is 40 capital A3. Okay, and earlier that we covered amounts inadmissible, this was section 40 small a. Okay, and I'm very sure 40 capital A3 you all must be knowing. बताओ, कोई बताओ, प्राची, सुधीर, please tell me what is 40A3 about?
Paying cash.
Yes.
Cash more than 10,000.
More than 10,000 cash. If it is paid, more than 10,000, then what is going to happen? It is going to be disallowed. Okay. So if in simple words, if I say, if any business they make payments or expenditure to a single person, what are the conditions? Let me just write it in this here. Okay, I'm going through section 40 A3 first. Okay, so if payment for any expenditure or payment is made to a single person, first criteria. Second, in a single day. to a single person in a single day, other than how you are paying by cash. Let's say, so in the terms of law it is written other than by account pay check, or let's say bank draft. If you pay to a single person, if an entity doing business, let's say they pay to a single person in a single day an amount other than by way of account pay check, or let's say account paying draft, how much is the amount exceeding rupees 10,000, then it is going to be disallowed. So in simple way, what I'm trying to tell you is that all the entities, businesses basically, they have to make payment if it exceeds rupees 10,000 rupees to one person in a single day. It has to be made through account pay check, or let's say through banking channels. I mean, it has to be in white, okay, because no usage of cash there, okay. If let's say the payment is made to a person 20,000 rupees, business paid to a consultant or someone 20,000 in cash, then such expenditure will not be allowed as deduction under section 40A(3), okay. So this simply means that it will not be considered as a business expense. So if I pay 20,000 rupees to somebody in cash, it will not be considered as business expense and it will be added back to the income. Are you getting my point? Prachi, samajh mein aaya? Yes, okay. But then there are certain cases, rule 6GD again, but there are certain cases it says, so let me just point it out here. On the basis of examination of books of accounts and other relevant documents evidence, whether expenditure covered under section 40A(3) read with rule 6GD were made by account pay check drawn on a bank or account pay bank draft. If not, please furnish the details. So all the transactions exceeding rupees 10,000, if it is done in cash, needs to be reported here, okay. So the limit is of, guys, how much? 10,000, and please remember this limit will become rupees 35,000 in case of the persons who are involved in hiring or leasing or plying of lorries and trucks. I mean, in case of transporters. In case of transporters, this limit will increase to 35,000. That means transporters can make payments up till the amount, let's say 35,000, okay. It should not exceed 35,000, okay. Is this clear? Now I have just read one part of the clause. Is this clear? Okay, but then again it says read with rule 6DD. So rule 6DD is basically exception. Now let's say if I am making any payment, I am making a payment to the bank itself or any credit institution. Let's say I am making payment to RBI, I am making payment to LIC, I am making payment to banks, government, etc., cooperative banks, then the payment can be made in cash, not a problem, okay. If the payment is made to the government, when I say let's say it is a payment for taxes, direct taxes, GST, customs, then it can be made in cash, okay. Even if I make a payment of 50,000, 40,000 in cash with respect to taxes, I am paying it to the government, it is allowed, okay. Then so there are certain points. There are certain I'm not going to go through the entire rule 6DD, but there are certain exceptions to this. But primarily what you have to remember that, and as per section 40A(3), if any expenditure is incurred in one single day to one person, the total of which is, let's say, more than 10,000 rupees, then the amount will be inadmissible, okay. Now a question was asked, I remember a question was asked, let's say let me check, I think it was with respect to a hotel, I think, yeah. So yeah, I'll just read a question, though we'll discuss it later also. I'm just asking you one question, okay. So it says, a company has a company, let's say XYZ Limited. XYZ Limited, paid maybe 6 of the employees of XYZ Limited, 6 employees, let's say they stayed up in a hotel, they might have gone for some work and also they stayed up in a hotel and they took up rooms and they must have eaten and also for each of the employee the amount was, let's say 7,500. The amount was 7,500. Okay, so the total comes up to how much? 7,500 into 6 is basically how much? 45,000. So basically what I'm trying to tell you is X Limited paid 45,000 wants to, let's say the bill has been raised by hotel. Okay. Now the hotel is of the view that, sir, yes, you can pay in cash. It will be very much allowed. Why? Because the amount for each of the employees is 7,000 and it is below 10,000 rupees. What is your viewpoint, guys? Can XYZ Limited pay? What do you think? Yes, Suthir, what do you think? Are you clear on the question what I am trying to ask you?
Yes, sir.
Yes. So again, because the amount is less than 10,000 for each person, is the hotel's viewpoint correct that no XYZ you can pay us in cash? Because it is well within the limit. Each bill is within the limit. So what did I tell you guys? For XYZ Limited, is XYZ Limited paying on a single day to a single person more than 10,000? Yes or no? We have to see from the perspective of XYZ Limited. XYZ is paying on a single day to a single person. Where is the point that I wrote here? XYZ Limited is paying on to a single person in a single day. So if they pay in cash, and of course the amount is exceeding 10,000 rupees, it will be disallowed. Yes or no? Yes, got my point. So this is irrelevant that the bill, individual bill is 7,500. Even if you split the bills, the point is if you pay in excess of 10,000 rupees on one day to one person, then you have to report here. Is this clear?
Yeah.
Yes. Okay. Now, all right. So see, we all know this that clients mostly, let's say, follow accrual basis of accounting. Okay. Now, as per accrual basis, let's say for financial year, for the previous year, a liability was incurred. Okay, the liability to pay was around, let's say, 50,000. So I create the liability in the books. So will this be allowed? I create the liability. I have not yet made the payment. Will this be allowed? Yes or no? It is an expense on accrual basis. It will be allowed. So this was allowed, let's say, in the previous year. But now in this year, I want to pay. I have to pay this 50,000 to the person. So now I pay them 50,000 in cash. What do you think? Earlier it was allowed, but now don't you think it should be added back? It should be disallowed because they have paid 50,000 in cash. So even if one expense has been allowed to you, but in the subsequent year also you cannot pay more than 10,000 rupees in cash. I mean, you have to pay it either through the bank or the bank draft. Okay, so it has to be made through account payee check or account payee bank draft. So this is the point that we are going to now understand here. It says, on the basis of examination of books of accounts and other relevant documents or evidence, whether the payment referred to in section 40A3A read with rule 6DD were made by account payee check drawn on bank or account payee bank draft. If not, please furnish the details of accounts deemed to be, now it will be what? Of amount deemed to be profit and gains of business or profession under section 40A3A. So 40A3A is basically, in simple words, if I write it here, okay, this is basically a case wherein if an expense, let me just write it in very simple terms, if an expense was allowed on due basis in the previous financial year and is paid in cash next year. Are you clear on the condition, guys? If it is paid in cash in the next year, then also if in very simple terms, if I say as per section 40A3A, the one which we are reading, when an expense payable is allowed in a year and in any subsequent year the SSC makes payment of such expenditure in such in cash or through bearer check exceeding rupees 10,000, then this payment is deemed to be profit of business or professions. Okay, so if I make this payment, let's say in my example I had to pay 50,000, if I make this payment in subsequent year in cash, then for that year it will be deemed as my profit. Because earlier it was allowed, right? I must have gotten the benefit of tax. But this year, because I paid the amount in cash, let's say through account or through bearer check or cash, this will be deemed as my profits for the current year. Is this clear? So that is why it says it shall be deemed to be profits and gains of business or profession. Is this clear, guys? समझ आया? I can understand, see, without you having, and these are provisions that you have covered at the intermediate level also, but then it becomes relatively difficult because it might be time that you have not gone through the provisions. But then see, this is a very, very common point, and if you are actually working seriously in the office, you must be knowing about it. Okay, so this is something very practical and very much applicable to almost all the companies, all the SSCs, right? So we have to check on this aspect. Anyway guys, yeah, we are still in clause number 21, and out of the 9 parts that we have to cover, I have only covered 4. Okay, what was the first one? Expenses with respect to capital nature, personal and advertisement. Second, inadmissible amount with respect to taxes to non-residents, residents, FBT, wealth tax, PF funds, etc. Okay, then if you pay if in a firm, and let's say in AOP, Association of Persons, if any amount is paid in excess to with respect to the provisions of 40B. Okay, so let's say interest, remuneration, etc. And then disallowance. So this is basically disallowance. Part 1 is disallowance, and then subsequently if you pay in cash, it will be considered as deemed income for that year. Okay, now coming to the 5th part, very simple. Now we are not going to go into the details, let us just go through it. Provisions for payment of gratuity. Provision has been made for payment of gratuity not allowable under section 40A7. See, please understand this. It says provision for payment of gratuity, it says it is not allowable, but when you make the payment, it is allowed. Okay, so provision for payment of gratuity not allowed, but when you make the payment, actually it is allowed. Okay, any sum paid by the SSC as an employer not allowable under section 40A9. Any sum paid by the SSC as an employer. Now please understand this. Let me put it in this way. Perquisites, you all know perquisites, right? Let's say I am an employer and you guys are my employee. So so we give you this facility of food. Okay, we give you the facility of food, free food. Okay, you can have a particular 2 meals a day when you come to the office. Let's say we are giving you the perquisites. Of course, perquisites, let's say this will be chargeable to tax, but let's say we are giving it to you. Okay, and then when I say perquisites, it is chargeable to tax. Then as an employee, you might ask me that, okay sir, with respect to this particular perquisite, whatever tax amount comes, you only pay the tax also on our behalf. Government wants the tax, whosoever pays it, it's okay. So you only pay the tax also, so that we get the benefit. So in this case, please understand, any sum paid by the SSC as an employer is not allowable under section 40A9. So this means if I am paying tax on employee's behalf, okay, this will not be allowed. This will not be allowed. Okay, any sum paid by SSC as an employer not allowable under section 40A9. So there will be a double loss for the company. Now the expense, the tax will not be allowed, and of course I am not going to get the benefit of any tax also. So double, I am paying the tax also, and then I am not getting benefit also, right? So it will be very difficult situation for the company. Okay, particulars of any liability which of contingent nature. Amount of deduction inadmissible in terms of section 14A in respect of expenditure incurred in relation to income which does not form a part of total income. See, simple, in very simple terms, if an income is exempted, let's say if I talk about any income which is exempted, so any expense with respect to exempted income should it be allowed? What do you think? So what I'm saying here is exempted income. Let's say exempted income expense. Okay, it is what? Not deductible. So it says amount of deduction inadmissible in terms of section 14A in respect of expenditure incurred in relation to income which does not form a part of total income. So any expenditure that is incurred with respect to an exempted income will not be allowed. Of course, it is not deductible. Okay, and amounts inadmissible under the proviso to section 36 1(2). This is again with respect to some grants and all. Okay, so no need to get into the details. Okay, so now we are done, guys, with clause number 21. There are 9 points in clause number 21. Okay, so again, what are the points? Number 1 is with respect to amounts which have been debited to PL. What are the amounts? It might be of capital nature, personal, advertisement, expenditure, etc. Amounts which is inadmissible. Remember all the tax payments basically. Okay, so one was TDS to non-residents, TDS to residents. Then I gave you certain examples here: FBT, wealth tax, okay, etc. Then a point with respect to, let's say, partnership firm. So if you give your partner, if a firm pays more interest or remuneration which is allowed, then of course any excess amount will be disallowed basically. Okay, and then we have this is a very important point: disallowance and deemed income. So if you pay any expenditure or payment otherwise than by an account pay check or a bank draft in excess of 10,000 rupees to a single person on a single day, then it will be disallowed. Okay, so this will be basically a disallowance, case of disallowance. But then if you are following accrual basis of system, let's say we we booked an expense in the previous year and the payment is made subsequently in this year. Okay, so when you make a subsequent payment, then also you cannot make payment in excess of 10,000 rupees in cash. Basically it has to be through the banking channels, account pay check, etc. If you do so because previously, let's say, the expense was allowed, but if you make the payment in the current year not complying with the provisions of 40A3, that means you make the payment in cash, let's say, then the entire amount will be considered as income for this year, deemed income. It will be a deemed income for this year. Okay, then provision for gratuity, payment of gratuity is allowed, please remember this. Then there are a few more points. Okay, 9 points in total. All right, so this is all about, guys, clause 21. Any doubts? Yes, do you have any doubts, guys? क्या प्राची सब ऊपर से जा रहा है? हाँ या ना? Nah, but it is just a matter of one more day. I mean, tomorrow we'll finish off the entire, all the clauses. Okay, but again, see, if it was totally upon me, I mean, I could have finished tax audit in 3 hours time also, but just by making you mark and refer to income tax when you study income tax. But then ultimately that would have not served the purpose of you learning the audit. So I am just taking time, not enough time also, or else I don't want to extend this topic for 25 hours by explaining you all the provisions. But yes, whatever is relevant, I am trying my best to make you understand. Okay, all right. So next, clause number 22. Abhi jo clauses are fatafat ho jayega. Okay, we are going to be quick now. Okay, so my target is let's complete till clause number 30 today. Okay, so that remaining 13-14 clauses we are going to cover tomorrow. Okay, so what is clause 22? It says, very simple, clause number 22. Yes, it says any amount inadmissible under section 23, amount inadmissible under section 23 of Micro, Small and Medium Enterprises Development Act 2006. Okay, now what is this all about? Let me just tell you first. Okay, I'll just have to give certain explanation here. It says amount inadmissible under section 23 of Micro, Small and Medium Enterprises Development Act 2006. So there is a MSMED Act, you all know this. Okay, and we are going to talk about section 23 of MSMED Act. But before that, let me just try and make you understand. But there are 3 types of basically enterprises that we are talking about here. Okay, one is micro enterprise, then again we have a small enterprise, and then we have medium. Okay, can anyone tell me the difference? First, let us try to understand the basics. What is the difference, guys? How will you classify some a manufacturing entity or entity into service as micro, medium or small? Yes, so we have to look into two aspects. Okay, let's say investments in plant and machinery, and also we are going to check their turnover. Okay, 2 criteria we are going to look upon. Okay, so investments in plant and machinery and turnover. So if any entity, let's say, who is into, if any enterprise, let's say manufacturing enterprise, or it may be enterprises rendering services, if their investments in plant and machinery is not more than, let's say, not more than let's say 1 crore, or their annual turnover is not more than I'll just write not more than here, and it is for every, not more than 5 crores. Okay, then this type of enterprise will be called as what? Micro enterprise. Okay, for small enterprise, what is the limit? Very simple. You just multiply this limit by 10. So this will become how much here? 10 crores, and annual turnover is, let's say, 50 crores. Okay, and again you multiply this by, let's say, 5. So if your annual turnover is 250 crores, and then this will become how much? If your investments in plant and machinery is not more than 50 crores, then you are, let's say, a medium enterprise. So this is just to make you understand what micro, small and medium enterprise means. Okay, but then what is section 23 of MSMED Act? Okay, what is the point that we are covering? Amount inadmissible under section 23 of MSMED Act. Okay, now please understand, I'll just give you a situation here. Okay, now let's say okay, this section 23. Now first of all, section 23, even though the name of the act is micro, small, medium enterprise, right? Micro, small and medium, but this section 23 is, we are covering only 2 types of enterprise here, micro and small. Please be very careful. I'm just trying to make you understand the section. Okay, let's say there is a micro or a small enterprise. Okay, and they make a sale. And this is the buyer here. This is the buyer. They make a sale and this is the buyer. Okay, and what happens is, when a sale is made, and also this buyer, he fails, he does not pay, let me just write it again here, he does not, or you'll get confused, let me write buyer does not pay in prescribed time. Okay, so we are discussing section 23, guys. Okay, what do we have to report? I am not discussing yet. I am just covering section 23 of MSMED Act. Okay, not Income Tax Act, MSMED. Okay, micro, small, medium. This thing, the full form is written here. Development Act. Okay. Now, so buyer does not pay in prescribed time limit to the micro or small enterprise. So now what will happen? So as per section 23 of this act, the buyer will now have to pay interest. Please understand, the buyer will now have to pay interest to whom? The micro and small enterprise. Yes, this is as per the act. The buyer will have to pay now interest to micro and small enterprise, and this interest amount is very huge. Interest is almost 3 times the bank rate. So the buyer will first have to pay interest to the micro, small enterprise, number 1. Okay, now from the perspective of this buyer, we are talking from the perspective of this buyer. Okay, now this buyer, when he pays this interest, which is almost 3 times of the bank interest, it will not be allowed as deduction. You cannot claim it as deduction in your PL. It will not be allowed as deduction. Okay, and then in form 3CD, what we have to do, if this is my client, if this is the SSC, this buyer, if the buyer has to pay because he failed to make the payment in time to the micro and small enterprise, if they have to pay any interest amount, of course the interest amount will also be disallowed. Okay, so we have to report the same. So give the interest details. This is what we have to give in 3CD. Are you understanding my point? See, there is this section, okay, for micro and small enterprise. So if I am buying anything from micro and small enterprise and I fail to make the payment in time, I will have to pay them interest of, which is basically 3 times of all of the bank rate, and then this interest will be disallowed. Okay, so please now understand. Again, of course this is going to be a loss for me, yes, because even double loss, because I am paying interest also now, which will be disallowed, and correspondingly more tax basically I'll have to pay. So there will be a lot of burden on the buyer. So in so much of restrictions that the buyer will almost try and ensure to make the payments in time to micro and small enterprise. Okay, so this is the entire section. Basically, I have not taught you yet that what has to be reported, but yeah, this is the entire section. So in 3CD, what has to be reported? The thing that has to be reported is amount inadmissible. Okay, sorry. Amount inadmissible under section 23 of micro, small, medium enterprise needs to be reported. So what is the amount which is inadmissible? This is not allowed, and hence this needs to be reported. Give interest details. Is this clear? Yes.
Yes.
Okay, one point very important again. We are covering section 23 of the act's name is Micro, Small and Medium Enterprises Development Act 2006, MSMED Act 2006. But this section 23 when I am discussing, guys, it is only for micro and small enterprise. So this thing will be applicable for only micro and small enterprise. Are you clear on this? Aaya samajh? Okay, all right. Okay, great. So clause number 22 is also done. Okay, now coming to the next clause. Yes, clause number 23. It says particulars of payment made to persons. That means 40 we are reading clause 23. Sorry, clause 23 is basically, it says particulars of the payments have to be made in the 3CD, which are made to persons specified under section 40A 2B. Okay, this is 40A 2B. Okay, so particulars of payments made to persons specified under section 48 2B. Now 48 2B is also very common. You must have you must have filled in this clause when you are actually doing tax audit in your office. Okay, now 48 2B is basically for person specified. So generally the relatives is specified. If it is a company SSC, the directors are basically the specified persons, firm, the partners are specified persons, any person having substantial interest in the concern, all these are basically the specified persons. Okay, so particulars of payments made to persons specified under section 40A 2B. So let's say if I am an individual, okay, and I made a payment of 5 lakh rupees rent to my mom, okay, to my mother. So now my question to all of you is, does the auditor, will this amount be reported in 3CD? The answer is yes. Okay, because as per 48 2B, my mom is my relative, lineal ascendants, descendants, the definition of relatives just covers. Okay, so what I'm trying to tell you is, under clause 23, only particulars of payment which has been made to person specified under section 48 2B has to be given. So I just gave you an example. If I am making a payment to my mother, rent, in my business, let's say I'm an individual, I'm doing a business and I'm paying rent of 5 lakhs to my mother. So will the amount be disclosed in the tax audit report? The answer is yes. Okay, is this amount too much? Is this amount, should it be allowed or not? This is not the thing that the tax auditor is going to look into. He just needs to give the list of the transactions, payments which has been made to the specified persons. Okay, whether the amount is justifiable or not, or whether it should be allowed or not, again the AO is going to look into the aspect. Okay, so a question was asked. Okay, an SSC has paid rent. An SSC has paid rent to his brother at the rate of, let's say, 2,50,000, and he has paid interest to his sister, which amounts to 4 lakh rupees. And the question was, state the reporting requirements in tax audit report. So the reporting will be done under clause 23. Okay, but again I'm just telling you this, that we just need to make the list here. Okay, whether it will be allowed or not, it is not our concern. Okay, but then again I have a point here. It says 40A2 provides that the expenditure for which payment has been made or is to be made to certain specified persons listed in the section may be disallowed. The word is may be disallowed. It is not that because I have paid rent to my mother, it will be disallowed. No, it says it may be disallowed if in the opinion of assessing officer, not the tax auditor. Okay, if in the opinion of assessing officer such expenditure is excessive or unreasonable. So it is up to him to decide. If he feels that the expenditure is unreasonable, excessive, then he may disallow the same. But then how will he decide whether the expenditure is unreasonable or too much or excessive? So the point here is, you have to, the assessing officer should give regard to 3 aspects. Okay, what are the 3 things? Number 1, the fair market value of the goods or services or facilities for which the payment is made. So he needs to see the fair market value, FMV. Secondly, whether if I have paid 5 lakh rupees to my mother as rent, whether there was a legitimate need for it in my business. So it says for the legitimate needs of the business or profession, was it actually required? And thirdly, the benefit derived by or accrued to the SSA from such expenditure. He's also going to see, he's paying his mother only. What if the rent is, let's say, 1 lakh and let's say he's paying his mother 5 lakhs, maybe he's claiming, you know, benefits in the business. But then again, if the mother is also, if my mother is also taxable under 30%, it is going to be of no benefit to me, right? So then he might be okay with it, right? So what I'm trying to tell you is, it is totally upon the assessing officer to assess basically whether a particular expenditure should be allowed or not. Okay, but when he is considering this, he is going to take into consideration these 3 aspects: the fair market value, the legitimate needs of the business, and third point is basically the benefit derived by the assessee. Is this clear? Yes. Okay. Now, alright, so basically the 3 points that I have covered here, these are parameters to determine whether it is unreasonable or excessive. Okay, now coming to the next part, next clause. Okay, again this is very simple, I'll keep it very simple. Okay, so it says clause 24 is basically about the, you know, deemed profits. Again, this is with respect to deemed profits. Okay, it says amounts deemed to be profits and gains under section 32 AC, 32 AD, 33 AB or 33 ABA and 33 AC. ACA is no longer, it's basically it was allowable only till assessment year 18-19. So let's not talk about it only. Okay, so this particular section, it is basically about deemed profit. Okay, deemed profit. Now please understand, I'll just make a very simple chart for you to make things very clear. Okay, so it talks about certain sections. Now section 32 AC and 32 AD, please, I'll explain it to you very everything will be super clear, but yes, I'm just giving you an overview. This is with respect to, guys, additional depreciation. Okay, this is with respect to additional depreciation. I'm just writing the section 32 AC, 32 AD. Okay, now under section 33 AB, and we have 33 AB and 33 ABA. 33 AB, these are sections. Basically, I'll tell you, 33 ABA is basically, you know, for those SSEs who are carrying on the business of prospecting, extraction and production of petroleum or natural gas in India, and 33 AB is basically for the ones who are into tea or coffee or rubber in India, manufacturing of tea or coffee or rubber in India. Okay, what is this section all about? I'll just give you an idea. Okay, so a person who's an SSE who's engaged in growing and manufacturing of tea or coffee or rubber in India is eligible for claiming deduction under section 33 AB. So they are eligible for claiming certain deduction. Okay, but when they claim this deduction, the amount, basically accordingly, for claiming the deduction, the SSE is required to deposit the amount. They have to deposit certain amount in either of the following specified accounts. In either of the following specified accounts: deposit an amount in specified account or maintain with the national bank, or deposit an account in deposit account. So in short, guys, you know, they have to deposit this fund. This is basically with respect to deposit, both the cases. Okay, be it a manufacturing company manufacturing tea, coffee or rubber, or let's say an SSE who's into business of prospecting, extraction or production of petroleum or natural gas. So if they want to claim deduction under their respective sections, they have to deposit certain amount, okay, in specified, let's say, special account or deposit account. Okay, now my question to all of you is, let's say they got a deduction. Okay, now additional depreciation is basically, again, depreciation over and above the rates that have been specified in the act. Okay, some extra depreciation is given so that it is, you know, for the companies it becomes very easy, because if you get extra depreciation, of course the profits taxability part is going to come down, right? So now let's say if we are going to read the sections, okay, but I'm just giving you an idea that let's say if there were certain conditions to avail additional depreciation. Let's say if there is a condition, I'm just giving you a case that you have to keep that asset for 5 years, let's say, okay, but then you claim the additional depreciation in the first year, and then in the second year you sold that asset. So now you have got two benefits. You did not keep the asset for 5 years. It was, let's say you had to keep it for 5 years, and then only, the extra depreciation you got in the first year was on the basis that you are going to keep it for 5 years. But then you sell it in the second year itself. Then what is going to happen? So in this case, it says that amount which you claimed as extra depreciation will be deemed to be your profits. Okay, similarly, because if you are claiming deduction under section 33AB and 33ABA, you have to deposit that amount in a fund. If you withdraw the funds before only, then whatever amount you withdraw will be your deemed profits. Are you able to understand this? So this is the section. Okay, this is what we have to learn about in the section. So just let's read the points. It says amounts deemed to be profits. Okay, so it says section 32AC and also AD. Okay, AD is different, but yeah, both 32AC and AD is with respect to, guys, additional depreciation. Are you able to recall the word additional depreciation? Intermediate, you must have covered this.
Yes, sir.
Yes, okay. So both the sections are with respect to additional depreciation, right? So section 32AC allows deduction at the rate 15% in respect of investments in new plant and machinery to a company which is engaged in the business of manufacture or production of any article or thing. So these are the conditions. And who acquires and installs new assets after 31st March 2013 but before 1st day of April 2015, and the aggregate actual cost of such new assets, what is the amount of assets that need to buy, is 100 crore rupees. This was when the standard, the section came into force, but then it was further amended. Okay, the Finance Act 2014 amended section 32AC with effect from financial year 14-15. The investment amount was reduced to only 25 crores from 100 crores. But yes, the depreciation was 15%, additional depreciation of 15%. Okay. Now, this is just a brief about section 32AC. As an auditor, what you have to check now, as a tax auditor, the auditor is required to report the deemed income. See, if the asset is now transferred, if this asset is now sold, so the auditor is required to report the deemed income chargeable as profits and gains of business under the circumstances specified in subsection 2 of section 32AC. Only because section 32AC subsection 2 provides for chargeability of deemed income under the head profits and gains from business or profession in addition to the taxability of capital gains. So capital gains will be there, but if you have if you have claimed additional depreciation, okay, the point here is the auditor is not required to report any capital gain. Okay, but yes, on arising on transfer of the said asset. So my point for you to basically make you understand this, basically if the asset, after you claim additional depreciation and if you sell the asset, okay, and then of course whatever benefit additional depreciation you had claimed, it will be deemed as your profits. Similar in these two cases, if you are into manufacturing of tea, rubber or coffee, you have to deposit some amount if you are claiming deduction under 33AB. But if you withdraw the amount, okay, if you withdraw the amount or let's say if you close the deposit account, then the same will be taxed. It will be deemed profits. This is what we have to cover in this section, in this clause. Okay, so with this clause number 24 is also over. Okay, how will you remember it? Deemed profits under how many sections, guys? Please remember 32AC and AD, it is with respect to additional depreciation, and 33AB and 33ABA. 33AB is for tea, rubber and coffee, and 33ABA is basically for extraction or production of petroleum or natural gas. Okay, site restoration account, etc. can be opened. Okay, so 24 clause is also now over. Clause number 24. Great. Is there any doubt, guys? Okay. Now, what is clause number 25? Again, this is a simple clause. 25 is a simple one. Okay. Yeah, it says any amount of profit chargeable to tax. So any amount of profit is which is chargeable to tax under section 41 and computation thereof. Now again we have to understand what section 41 is all about. Okay, so it says any amount of profit which is chargeable under section 41 and computation thereof. This is what we have to mention in the tax audit report. Any amounts of profit which is chargeable under section 41 and computation thereof. So sir, what is section 41(1)? If I don't teach you this, then this particular clause will be meaningless, right? So what is section 41? It says very simple. In business, I have just given it in very simple terms here. In businesses, guys, there are circumstances where a person might have incurred a liability, but later on he need not have to pay it for one or the other reason. So I created a liability. Okay, let's say I created a liability and I might have got it might have been allowed. Okay, I create a liability, it is allowed, but subsequently I might not have to pay for that liability. So then what is going to happen? The point here is it will be now deemed as your profits. Again, it is a case of deemed profits. Okay. Now what is the difference? I mean, please understand. Okay. Let's say if I put it in very simple terms, okay, I created a current liability. I mean, there is a, let's say, or not, let's not just write it in this way. Okay. Let's say I incurred a loss. Okay, and subsequently somehow the loss was recovered, or let's say I got an insurance claim for that. So when I incurred the loss, I must have made, the provision, or I must have debited into PL. Okay, and it is allowed. But then subsequently the entire loss is recovered. Let's say I get an insurance claim, etc. Then whatever is recovered will be your deemed income, deemed profit. Okay, so this is the point. It says, let me just read the point. In business, there are certain circumstances where a person might have incurred a liability. Liability is incurred, but later on I don't have to pay it. I did not have to be paid for one reason or the other. The Income Tax Act brings to tax such liabilities which are no more payable. Earlier they allowed us that you have to pay, but we are not paying it now. So again it will be basically deemed as profits. Okay, so the section brings into its ambit benefit in cash or in kind obtained by a person by remission or cessation of liability. So please, the heading for this should be what? Cessation of liabilities. I mean, there was a liability but it no longer exists. Or it says basically the section brings in to its ambit benefit in cash or in kind obtained by a person by remission or cessation of a liability. Remission means, in simple words guys, waiver. If there is a liability which is no longer exist, waived, or let's say, and cessation means the liability doesn't exist. So only condition that is that the person must have obtained a deduction or allowance in his computation of income for the said liability in the previous year. So of course I must have obtained a deduction for the said liability in the previous year. If nothing was done in the previous year and now the liability doesn't exist, so I don't need to do anything, right? So this, as per this clause, let's say if I put it in very simple terms, if I had created a liability, okay, in last year, let's say, but I did not have to pay in this year because let's say the loss was recovered, or the liability, there was a cessation of liability. So I don't need to pay it now. But then what is going to happen? Because earlier in the previous year it was allowed as a deduction, now the same will be deemed as your profits. Is this clear? Okay, so let's say it can be a case of let's say recovery of loss, or let's say expenditure. Clear, guys? Okay. So now let us start with clause number 26. Okay, it says in respect of any sum referred to in clause A, B, C, D, E, F, G of 43B, section 43B, the liability for which pre-existed on the first day of the previous year. Okay, so we are discussing section 43B. Okay, it says in respect of any sum referred to in section 43B. What is 43B about? I'll tell you. But the point here is, if in respect of any sum which is there in section 43B, the liability for which pre-existed on the first day of the previous year, but was not allowed in the assessment of the preceding previous year. Okay, so it existed. It says pre-existed on the first day of the previous year, but was not allowed in the assessment of the preceding previous year. Let's say we talk about our financial year, let's say 21-22 and 2021. Okay, so there was a liability which existed on 31st March 21. There was a liability which existed on 31st March 21. Please be very careful. Okay, so it says there pre-existed on the first day of the previous year. So this is my previous year at the moment. So it existed basically on the first day. I mean on 1st of April it existed. It existed on 1st of April. Okay, and but was not allowed in the assessment of any preceding year. This particular thing was not allowed here. It was not allowed in the previous preceding previous year. Okay, and was now it existed, this liability existed on the first day of this previous year, and it was paid during this year. The liability was paid during this year, during the previous year. Or let's say if it still remains, it was not paid, the same needs to be reported. Okay, what kind of liability? I'm going to just tell you. Liabilities with respect to section 43B. Okay, so in short guys, whatever things which we are going to discuss in section 43B, in simple words, it says section 43B lists down certain expenses. There are certain expenses written there in clause A, B, C, D, E, F, G of section 43B, wherein deduction will be allowed only when you make payment for the same. Okay, it will be basically payment based deduction. You cannot create a liability and deduction will be given to you. No, you have to pay and then only the deduction will be allowed to you. So what is section 43B all about? Let us first understand, and then we are going to talk about these 2 points. Okay, so section 43B I have again written in the explanation part for your understanding. Section 43B of the Income Tax Act provides a list of expenses allowed as deduction under the head income from business or profession. Okay, so it is a list of expense. It states that some expenses that can be claimed as deduction from the business income only in the year of actual payment, not when the liability is created, but only it will be claimed only in the year of actual payment and not in the year when the liability to pay such expenses is incurred. Okay, so 43B is nothing but guys a list of expenses. Okay, and as per the list, payment for certain liabilities only when it is made, when the payment is made, will be allowed as deduction, not when the liability is incurred or created. Okay, so what are the payments? The following deductions are specified in this section, so we don't have to learn all the points here, but yes, let's understand. So any tax, duty, cess, fee paid under any law in force is allowed as a deduction when it is paid. This includes GST, custom duties and other taxes. So you cannot create a provision that you have to pay. It is going to be allowed only when you pay it. Okay. Secondly, contribution by employer to employees benefit fund, namely PF and all. So I told you, if you remember in gratuity also, I just told you, by creation of provision is not allowed, but when you actually make the payment, it is allowed. Okay. Then bonus or commission payable to employees. Then we have interest on borrowings from public financial institutions or SF, state financial corporation. Okay, interest on loans and advances from scheduled bank, leave encashment by an employer to his employees, payment to Indian Railways. So these are the 7 clauses under 43B which will be allowed to an SSE only when the same has been paid. Okay, it is not going to be allowed when the liability has been incurred. Okay, it is going to be allowed only when the same has been paid. Now, number one thing, is this clear? Do you have a rough idea about now 43B? Do you understand 43B? Yes, okay. Now, having understood this part, let us now read this point. Okay, so we are now covering in respect of any sum referred to in the 7 clauses that I have just gone through. Okay, of 43, the liability for which pre-existed on the first day of the previous year, but was not allowed in the assessment of any preceding years. Of course, so it is coming in your opening balance. So we just have to mention the opening balance and the treatment, if any, that was done in the current year. Did you pay? Then mention. Did you not pay? Mention. Okay. Opening balance and its treatment. Paid during the previous year, not paid during the previous year. Done. Or let's say, secondly, what can happen if the expense was incurred in the previous year and also was paid on or before the due date of furnishing the returns of income of the previous year under section 139. So let's say second case, if the liability was incurred in this financial year only and the payment was also made before the due date of this financial year as per section 139, then the reporting needs to be done. Or let's say not paid on or before the aforesaid date. So see, the compliance, this clause ensures compliance with 43B. Amount will be only allowed if payment for the same has been made. It will be allowed in that year wherein the payment has been made. But then, of course, please understand, if let's say an expenditure was pertaining to this year, liability was for this year, but then they paid it before, let's say they paid it on 25th September. Let's say the due date is 30th September. So will this be allowed in this financial year? Will the expense be allowed in this financial year? Yes or no? this expenditure, let's say they made a payment, they created a liability in this financial year, and they paid it, let's say they paid it well within the due date. It says no, the paid on or before the due date for furnishing the returns of income of the previous year. So if they paid, then of course it is going to be allowed. Do you all agree with this?
Yes, sir.
Yes. So either they paid in the very same financial year, or either they paid till the last date of, let's say, filing the return, okay, or let's say not paid on or before the aforesaid date. So even if it is not paid, then also the reporting needs to be done. So in simple words, guys, any sum with respect to any amount with respect to 43B, you have to report two aspects. If any opening balance was there, what was the treatment in the current year, or if there is no opening balance, but yeah, if it is incurred in current year, I mean, what if there is any closing balance and its treatment. That's it. Okay, so this is what we have to understand in clause 6. Clause 6, please remember, it is with respect to section 43B, list of expenses. Okay, or in short, I should basically write this clause is basically for deduction on payment basis. Deduction will only be given deduction on payment basis. Fine. Okay, next is again very simple. Now the clauses that we have to cover are relatively, guys, very simple, don't worry. Okay, so 27, 28 we'll try to cover as much as possible. I mean, let's cover it up till clause 30 today. Okay, so let's see clause number 27 now. Okay, so what is clause 27? 27 is basically again a very simple one. It says amount of central value added tax credits availed, okay, availed or utilized. Okay, it can be GST. Okay, so amount of any value added credits, it is availed or utilized during the previous year, and its treatment in the profit and loss account and treatment of outstanding any credits in the accounts needs to be disclosed. Okay, so basically what I'm trying to tell you is, if you are the auditor and your SSE, basically the SSE has availed any input tax credits or utilized. Now what do you mean by availed and utilized? Let's say if I buy an asset of 100 rupees, I pay 18 rupees GST, okay, and 18 rupees I get ITC. So basically I have availed the 18 rupees credit, and then when I have to pay my liability of GST, let's say I use this, so basically this is utilizing, right? So any amount of GST, let's say GST credits, input credits availed and utilized during the previous year, and its treatment in the profit and loss account and treatment of outstanding credits in the accounts. Okay, so in simple words, guys, if I say what do we have to report, we have to check upon, let's say we have to report in this manner: opening balance, let's say of your GST input, okay, opening balance. Then we have to report about let's say availed GST, whatever you have availed, whatever you have utilized, and basically the closing balance. That's it. Okay, so this is how we have to report. Okay, and the second part is particulars of income or expenditure. Now this is good point. So clause 27 is also about two things. Okay, one is with respect to the SENVAT, the GST input. Okay, and second is basically particulars of income or expenditure. Please be very careful here. Particulars of income or expenditure of prior period, credited or debited to the profit and loss account of the, let's say, current year. So now, particulars of income or expenditure of prior period, okay, it can be an income of or expenditure of prior period, okay, pertaining to prior period, credited or debited to the profit and loss account. Now this is a point that it would only be relevant for the SSEs who are following a mercantile system of accounting. Why? Because under cash basis, what happens? Under cash basis, generally, of course, the expense, the payment, the income will be recorded only if it is received or paid, right? So the concept of prior period will not arise only in case of cash basis of accounting. So this says, this point is particulars of income or expenditure of prior period if it is credited or debited to the profit and loss account. So I have also mentioned this point here. Please note this. It may be noted that information under clause 27B would be relevant only in those cases where the SSE follows mercantile system of accounting. Under cash system of accounting, expenses debited or income credited to the P&L would be current year's expenses income, even though they may relate to the earlier year. So when you receive it, then only you, okay. So this is only relevant, you know, prior period items. It is only relevant in case of mercantile system of accounting. Okay, so clause 27, we have to understand two things. One is basically about the Senvet credits, and the second one is with respect to prior period income or expenditure. Fine. Alright, so let us start now with clause number 28. Okay, so clause 28 is basically, it says whether during the previous year the SSE has received any property which can be being a share of a company, not being a company in which the public are substantially interested. I mean, if the SSE, who is the SSE here, I'll just discuss it. Okay, if the SSE has received shares of any company, shares of a company which is not, let's say, a company wherein the public are substantially interested. So this simply means it is a closely held company. Let me just put it in this way, closely held company. Okay, so if my SSE has received shares from a closely held company, or shares of a closely held company, okay, it says either without consideration. Okay, now it can be there can be two cases here. Okay, so case one is either the SSE has received it, let's say, at no consideration, that means let's say free of cost. Or case 2 can be basically what? Let's say they have received for inadequate consideration. So these are the two cases. Okay, so what am I discussing? I am discussing clause 28, wherein it says if the SSE has received shares from a closely held company, either at no consideration, I mean without consideration, or let's say at an inadequate consideration. Okay, as referred to in section 56 clause 2 7a, if yes, please furnish the details of the same. So as a tax auditor, if this is the case with our SSE, we have to report it in this particular clause. Okay, now but it says as referred to in section 56 to 7a. What is 56 to 7a? Let's understand this. It says 56 to 7a specifically is an anti-abusive provision which provides for taxation of a company in which public are not substantially interested, or a firm. Okay, so now please be very careful. This clause will only be applicable, guys, in my tax audit when the SSE is either a firm or it is a closely held company. Okay, so it says section 56 to 7a specifically is an anti-abusive provision which provides for taxation of a company in which the public is not substantially interested. That means a closely held company or a firm where such specified company or firm receives shares of a specified company for no or consideration which is below the fair market value. Okay, so we have understood the applicability of 56 to 7a. Now please be very careful. This clause, the clause number is clause 28. Okay, now you should understand, guys, this is going to be applicable only when we have a SSE which is a firm, or let's say they are a closely held company. Okay, they are in receipt of shares from another closely held company. Now they have received the shares either without any consideration or inadequate consideration. Okay, now what is going to happen? So please understand, so there will be a taxability in the hands of SSE now, because they have received shares. Let's say if they have received it without any consideration, then there will be a case of taxability here. Okay, who is going to pay the tax? I mean the tax will be basically levied on the SSE. Okay, let's understand this. Okay, it says the tax is levied on the receiver of the shares. Okay, now please understand how will the tax be levied. Okay, let us understand 2 points here. Now if let's say the company, if my SSE has received certain shares from a closely held company without any consideration, okay, then and the fair market value of such shares is greater than rupees 50,000. The fair market value, they did not pay anything, but yes, the fair market value of such shares is greater than 50,000 rupees. Now how will you determine the fair market value of a closely held company? See, shares which are public or listed, they are publicly traded. A lot of the public are basically substantially interested in those companies. But in case of a closely held company, generally the fair market value is determined by rule. There is a rule basically, okay. So according to the rules, the fair market value is determined, okay. Then please understand now, again coming back to the case, if my SSE has received shares of a closely held company without any consideration and the fair market value of those shares exceed rupees 5,000, then entire fair market value, the entire fair market value will be taxed, and it will be basically taxed in the head of income from other sources. Income from other sources. In whose hands will the amount be taxed? Of course, the receiver, okay. And if there is inadequate consideration, let's say they have given some money but the consideration is inadequate, so in this case, let's say fair market value minus, let's say, the consideration, if this exceeds rupees 50,000, fair market value minus the consideration that they have paid, then this balance amount, I mean if it is more than 50,000, if the difference between the fair market value and the consideration which my SSE has paid, if it is more than 50,000 value, then the difference will be charged to income from other sources, okay. So this is clause 28, okay, very simple. But then again guys, you have to understand that this clause is, it was this section basically, okay, just a moment, this section 56 to 7A is applicable on or after 1st day of June 2010 but before the 1st day of April 2017. So applicability was still 1st April 2017. Hence now this clause is no longer relevant, okay. It says this clause is not applicable from assessment year 18-19. This is not applicable. Then why did I teach you? Because now this clause 28, it has been now superseded by clause 29B. We are going to cover this later. It has been now superseded by another clause 29B. Hence there was a requirement to teach you this clause so that again you'll be able to understand 29B, okay. Now it doesn't mean that that if let's say an SSE receives shares from a closely held company without consideration, now taxability will not arise. No, there is another section that we are going to cover, and for that section we have a different clause, okay. So the relevance of section 56 to 7A was till 2017 April, okay. Hence reporting under this clause in tax audit is not relevant from assessment year 18-19, okay. Now yeah, so see, I've told you this for your understanding. Whatever I'm saying, I have just tried to make it very clear. It should be made that the fact that 56(2)A of the Income Tax Act has been replaced with a new provision, section 56 to 10, and I hope in CA Intermediate also this was one of the most important sections from the chapter of income from other sources. I mean, if any practical question was asked, it was mostly from this section, okay, 56(2)A. So we are going to cover about this particular section in clause 29B, okay. So reporting now is required in the clause 29B, all right. So now, okay, so for the time being clause 28 is over, okay. So this is what we have to cover in clause 28, okay. Now coming to clause number 29, okay. So clause 29 is also somehow related to the shares. Let's understand what this clause 29 about, okay. So it says whether during the previous year the SSE received any consideration, the SSE has received any consideration for issue of shares. So this point is with respect to issue of shares, okay, which exceeds the fair market value of shares as referred to in section 56 to 7B. If yes, please furnish the details of the same, okay. Now please understand what is happening here is if SSE, now who is the SSE, I'm going to tell you. If SSE here, they have received any consideration for issue of shares. So my SSE is basically must have issued certain shares. They must have issued certain shares, okay, and for which they must have received what? Consideration. Okay, so this point says whether in the previous year the SSE received any consideration for issue of shares which exceeds the fair market value of the shares. Okay, now if this consideration if this consideration is basically, if I tell you, if it exceeds the fair market of the share, there is no limit of 50,000 here. Okay, now if I tell you very properly, if when I say consideration, let's say if the issue price at whatever price they have issued, that means consideration, is greater than fair market value. Okay, if whatever is the difference between the issue price and the fair market value, okay, this will be taxed under which head? Income from other sources. Okay, now please understand what is happening. Okay, and let us read this also, and then I'll tell you practically why this clause was basically implemented, basically required to be reported. Okay, so what is 56(2)(7)(b)? Okay, let us read this first. Section 56 clause 2(7)(b) was inserted, subsection 2 clause 7(b) was inserted via Finance Act 2012. The objective of introducing this section was to deter the generation and use of unaccounted money through subscription of shares of a closely held company at a value which is higher than the fair market value of shares of such company. So if SSE has, issued shares, and SSE will be here what? SSE shares of, basically SSE will be my whom? A closely held company. So SSE is a closely held company and they have issued shares. Okay, they are in receipt of consideration also, but the consideration is greater than fair market value. Consideration is greater than fair market value. Then this particular reporting needs to be required. Now please understand. Okay, let's say I am the company, guys. Okay, I am the company, and okay, so let's say I have got being a company. Let's say I have got 20 lakh rupees unaccounted money. You can call it as black money or unaccounted money. Okay, 20 lakh. And then let's say Prachi is the relative of the director. Let's say she's my relative. Okay, and then I ask Prachi, okay, let's enter into an arrangement. Let's say because let's say you are earning well, you have so much of money in white, you do one thing, you invest in my company, or let's say you buy shares of my company. Okay, then so I'll tell her, okay, the let's say the fair market value of the shares, let's say, is 40 rupees. Okay, but then I'll show that you have bought it for 60 rupees. Okay, so 20 rupees extra. Let's say she buys around how much? Let's say around 10,000 shares. Okay, 10,000 shares and of 40 rupees. Okay, but then I issued it at, the consideration I charged was how much? The fair market value is, let's say, 40 rupees, but then I issued it as 60 rupees. Okay, now what is going to happen? Please understand. I entered into this kind of agreement with not agreement, basically this kind of arrangement with Prachi because she is my relative. So I tell her that, Prachi, see, I have got 20 lakhs in cash. Okay, I'll give you 20 lakhs in cash because you have so much of income in white. You give me 60 lakhs. So what did I just do, guys? The 20 lakh rupees which was lying with me was an unaccounted money. It was a black money. So I gave that to Prachi, and Prachi on, along with the consideration, let's say fair market value of the share, she paid 20 lakhs extra to me. And then what will I do? I have got 60 lakh rupees in 60 lakh rupees. I am the company. I have received 60 lakh rupees. But then this 60 lakh rupees is not my income, right? So it cannot be taxed. This will go to the capital. But then income tax is, very smart. They say no. Why did you receive? Who is the person who paid you more than fair market value? You have definitely entered into an arrangement with some of your relatives, and that is why they paid you more than the fair market value. And this more portion, the extra money that you have received, we will treat it as your income, and it will be charged in income from other sources. So please understand this particular section was only introduced to deter the generation and use of unaccounted money. So this is for your understanding, which I have mentioned here. Okay, to deter the generation and use of unaccounted money. So if I have unaccounted money, this is how I can convert it into white money, and it will not be taxed also. So then income tax, they introduced this particular section, and if this happens in our client's case, we have to report it. Okay, so in case of tax audit, what do you need to report? Again, let me just read the point. Whether during the previous year the SSE, now who is the SSE here, guys? Who will be the SSE? A closely held company. Okay, they what has happened, they have received any consideration for issue of shares. So they have issued shares and they have received consideration which exceeds the fair market value of the shares as referred to in section 56(2)(7)(b). All right, so Yeah, it says again let us read the section also. 56 subsection 2 clause 7b of the act. It states that where a company not being a company in which public are substantially interested, so I have already told you it is for closely held companies, receives in any previous year from any person being a resident any consideration for issue of shares that exceed the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value. So what did I tell you? The aggregate consideration, this means the issue price minus the fair market value. This would be now what? Exceeds the fair market value of the share shall be deemed to be income of the concerned company, chargeable to tax under the head of income from other sources. Okay, so I think I made it very clear from this part. Yeah, so it can be like with any person. So they have basically issued shares to any person, and in return they have received consideration. Okay, so please remember guys, in clause 29 there is no such limit of 50,000 etc. as we had covered in clause 28. Okay, so here the case is of issue of shares. Okay, is this clear everyone? समझ आया? Logic समझ में? Yeah, so this particular section was only introduced so that the company doesn't engage themselves into bogus share capital building. Okay, and income tax ko pata chala that this is a very common practice which is going on in case of closely held companies, so they introduced this particular section, and as a tax auditor we need to report on the same in the tax audit report. Alright, so 28 and 29 done. Alright, please be very careful. 28 is basically the SSE has received shares. Okay, SSE has received, but here SSE has issued the shares. Okay, and SSE, who is the SSE here? Closely held company. Okay, done. Now, alright, so clause 29 again guys, we have two more clauses to cover, two newly inserted clauses to cover, which is very easy. Okay, as such we don't there is not much explanation required here, so let us quickly cover 29A. 29B again it requires some explanation. Okay, so what is clause 29A all about? Okay, it's very simple, let us understand. So it says whether any amount is to be included as income chargeable under the head income from other sources as referred to in clause 9 of subsection 2 of section 56. Now if this is what we have to report and you don't understand clause 9 of subsection 2 of section 56, how will you as a tax auditor understand? Forget about as a tax auditor, how will you even understand it for the exams? Okay, so again it is my duty to explain you in briefly what section 56 subsection 2 and clause 9 is all about. Okay, so it's very simple. Let's say it says any sum of money received as advance or otherwise in course of negotiations for transfer of a capital asset. Okay, if such sum is forfeited and negotiations do not result in transfer of capital asset. Now please understand, okay, probably by reading this you'll understand nothing, but let me just give you an example. Let's say I have a property, okay, and I was negotiating with Sudhir. He was interested to buy the property. Okay, let's say the property is worth 1 crore rupees. And then Sudhir almost agreed that he is going to buy the property, and then he paid me 5 lakh rupees in advance. Okay, 5 lakh rupees as advance. Now somehow Sudhir, he is no longer interested to buy the property, or let's say there's a change in his mind, or let's say something happens, he decides not to buy it. Okay, but then because I've received 5 lakh rupees as advance, okay, which of course I have forfeited, I'm not going to return it to him, because I'll say, see, you almost took 3 months to decide, I did not even look for more buyers, I suffered a loss, okay, whatever it is, so I forfeit the 5 lakh rupees. Now the question is, this 5 lakh rupees which I have forfeited, selling properties, let's say, or capital assets, it's not my business, so I cannot incorporate this, include this 5 lakh rupees in my PGBP income. Okay, and of course I cannot say that this 5 lakhs is my capital gain. Why? Because there is no transfer of property yet, there is no transfer of capital asset, right? So the point is, where will this 5 lakh income be shown now? The answer is income from other sources. So as a tax auditor, if this is a case with our SSE, we have to report the same in the tax audit report. So this is what 56 subsection 2 clause 9 is all about. Okay, let me read the section again. It says 56 to 9, any sum of money received as advance, see the word advance, or otherwise in course of negotiations for transfer of capital asset. if such sum is forfeited, what are the conditions? If such sum is forfeited and the negotiations do not result in transfer of capital assets. So ultimately, let's say I did not transfer the capital assets. So then this income will be shown under which head? Income from other sources. And if the answer is to this is yes, I mean if my SSC, I am the tax auditor, if my SSC has such kind of income, I need to furnish the details of the same. What details? Nature of the income and amount thereof. That's it. Okay, very simple, done. Clause 29A. Any doubts? You have understood the section, right? This section 56 subsection 2 clause 9. Is this clear?
Yes.
Yes. Okay. All right. Now clause 29B. Now clause 29B is a bit huge. Okay, how huge? How is it huge? Let's understand. Because as such, if you read the clause is very the size of the clause is very small, but the section that we are going to refer here is a bit elaborate. Okay, it's a bit exhaustive. I mean, it's a long section. Okay, but then again, you must have covered this in depth in CA intermediate level, so I think you would be having some knowledge. Okay, so it says whether any amount is to be included, yes, whether any amount is to be included as income chargeable under income from other sources. Again, same thing under section 56 to clause 10, 56 subsection 2 clause 10. If yes, please furnish the details of the same. Now same points, if you can see, it is only there is a only difference in the sections. There it was clause 9 here of 56 subsection 2. Now we are referring to clause 10 of 56 subsection 2. So what is 56 subsection 2 all about? Let us try and understand this portion. Okay, so yes, it says 56 to subsection 10, where any person receives in any previous year from any person or persons on or after 1st day of April 2017. Now please understand, this section is applicable after 1st April 2017. I mean 56 to 10. Okay, but then if you remember this section was only valid till what? I mean applicable till 1st April 2017. So that is why I told you 56 to 7A has now been replaced with new provisions of section 56 to X. And any transfer of shares that we refer to here, any shares that has been received, let's say, if this is the case now, the reporting will be done under which clause, guys? 29B. Please be very careful. Even though for your understanding, again, I think I made a note of it here also. Please, if you can see, yes. It says reporting now is required to be done under clause 29B. Okay, so what is 29B? Which section are we referring to under clause 29B? It is 56 subsection 2 clause X. Okay, so what is this section all about? Let's understand. Where any person receives in any previous year from any person or persons on or after 1st day of April 2017. So what does this receive? Number one, he receives any sum of money. A person, he receives any sum of money without consideration. That means he receives money, I mean he receives money as gift. Okay, so he receives any sum of money, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. So if it exceeds 50,000 rupees, then the entire value of such sum, the whole of the aggregate value of such sum, it will be basically taxable. Okay, now please understand. Okay, are you able to recall this section? Okay, 50,000, if you receive money as gift from any person which exceeds 50,000 rupees, okay, then it would be taxable. Okay, but then again, of course, we have some exemptions. If you remember that if we receive it from any relative or on the occasion of marriage, are you able to recall?
Yes, sir.
Or let's say under a will or inheritance, those were the exceptions to this section. Okay, but then again, I'm not going through the details of this section because you already know it, but yes, let us go through it. Okay, so this is basically if you receive money. Okay, second is basically okay, so this is basically any immovable property without consideration. You receive this was with respect to money. Okay, then you are receiving any immovable property. Okay, without consideration, the stamp duty of which exceeds 50,000 rupees, the stamp duty of such property. So if the stamp duty exceeds 50,000 rupees, the stamp duty of such property, and if you actually receive it for a consideration also, the stamp duty of such property exceeds such consideration if the amount of such excess is more than higher of the following amounts, namely 50,000 rupees and amount equal to 10% of the consideration. So this is just a section which I am reading. Okay, so in this case, let's say if you receive immovable property without consideration, and then what is going to happen, and the stamp duty basically exceeds 50,000 rupees, the stamp duty of such property will be now taxable. Okay, then again, if you received it for a consideration, then whatever consideration you pay, the stamp duty value of such property, if it exceeds the consideration, then the excess amount basically, then such excess is more than higher of the following amounts, namely 50,000 rupees and amount equal to 10% of the consideration, then whatever it will be taxed. Okay, and again, any property other than immovable property, let's say movable property, it can be jewelry, etc. Okay, same thing, without consideration and for consideration. Okay, so this is the section, guys. I'm not going into the details, but then if you are able to recall, this is a relatively very important and a significant and a famous section that you do it in CA intermediate also. And if again I tell you, there are certain exceptions. If you receive it from a relative, if it is on the occasion of marriage, it is under a will or by way of inheritance, etc., or in contemplation of death, then in these scenarios, of course, there are certain exemptions. Okay, so now in clause 29B, we have to just report all those income, under the head income from other sources as referred to in section 56(2) subclause X. So we have to furnish the details. That's it. Nothing much to understand here. Okay, so this is what we have to cover. Is this fine, guys? Yes. So 29A was with respect to what? 29A, please remember, it is 56. It is both of them are for income from other sources. Okay, but this is for clause number 9 here, and here in 29B we are covering 56 to clause X. Fine. Okay, next, again a very small clause, clause 30. This is with respect to hundi. Now, what happens generally, let's say Prachi has some unaccounted money. Okay, and let's say she has got 5 lakh rupees. 5 lakh rupees unaccounted. Maybe she received it somehow and she has collected it, whatever it may be the source. Okay, she has got 5 lakh rupees, and then I was in need of 5 lakh rupees. So I told her, Prachi, will you give me 5 lakh rupees? So because it is unaccounted, of course she cannot give me an account pay check. It is not in our bank, it is with her in cash, let's say. So then she tells, okay, I'll give it to you, no worries, but then you give it to me in writing that you have received rupees 5 lakhs from me and you are going to pay at the rate 12% per annum interest, and it is payable on demand, let's say. So I write a note on my letterhead and I give it to Prachi. Okay, then what happens is somehow that note which I had given, basically that is called a hundi because it has got no legal acceptability. But then again, if that hundi, if that note basically on my letterhead, okay, if it comes in the hands of income tax department, then what is going to happen? Okay, so because income tax will come to know now that, okay, Prachi had 5 lakh rupees, I have taken 5 lakh rupees now, okay, and I am paying 12% interest also to Prachi on that amount. So what is going to happen? Okay, so let us understand this from the example that I gave you. Okay, what is clause 30? It says details of any amount borrowed on hundi. Okay, so I have borrowed, the SSC has borrowed, let's say, okay, borrowed on hundi, or any amount due thereon, including interest on the amount borrowed, repaid, otherwise than through account payable check. So either I borrowed the money, otherwise through account payable account pay check, or I am paying you, let's say I am repaying you, or maybe I am repaying you the only interest component without account pay check, then this clause will be attracted. Okay, so it says the tax auditor needs to give details of any amount borrowed on hundi. Okay, or so we have to give details of any amount borrowed as well as any amount due thereon, or let's say due thereon or repaid also, otherwise then account pay check. Okay, I borrowed it otherwise than account pay check, that means in cash. So this is basically, this is written in section 69D. So what is 69D? Let us understand. It is very simple. Okay, what do you mean by hundi? Hundi, see, you must have covered this word basically, I think, in Negotiable Instruments Act also, but then it has got no legal as such acceptability. But then again, if you take money basically on the basis of this hundi, if you have borrowed money on hundi, okay, then of course this is basically an unaccounted money, because had the money been with Prachi in her bank account, she would have given it to me through account pay check, but then she has given it to me in cash, and I'm of course this is totally unaccounted. Okay, so let's read what section 69D is all about. So where any amount is borrowed on a hundi form, okay, hundi form, or any amount due thereon is repaid to, it should be hundi form basically, not from. Okay, so where any amount is borrowed on hundi form or any amount due thereon is repaid to any person otherwise than through an account pay check drawn on the bank, the amount so borrowed or repaid, please understand, the amount so borrowed or repaid shall be deemed to be the income of the person borrowing or repaying the such amount. So it shall be deemed to be the income of which person? The one who has borrowed the amount. Okay, so if I am repaying also, let's say, okay, the amount so borrowed or repaid shall be deemed to be the income of the person borrowing or repaying such amount. Okay, now let's say the hundi, I took money from Prachi, so I have taken the money, so it will be deemed to be my income. Okay, and whatever interest also I need to pay, it will be deemed to by my income, because of course I am paying interest now. So it will be, now it says, or repaid. Okay, the amount so borrowed or repaid shall be deemed to be the income of the person borrowing or, let's say, repaying such amount. Okay, it will be treated as income for the year in which it was borrowed or repaid. Okay, as the case may be. However, however, if it should be noted that if any amount borrowed on hundi basis, hundi has been treated as income of any person by virtue of section 69D. Let's say I borrowed money from Prachi and the income tax came to know, and they have already taxed me 5 lakh rupees, okay, in the year which I had borrowed. Then such person shall not be liable to be assessed again in respect of the same amount on repayment thereof. So now if I repay the same amount, I will not be taxed again. So there cannot be double taxation, right? So amount repaid shall include the amount of interest paid on the amount borrowed. Okay, so very simple thing. So if I take money on hundi in hundi form, I mean, in simple words, if I want you to understand this, basically this hundi form of money, generally of course it is what? It is unaccounted. Okay, so income tax will not spare us. Okay, they will not leave us. So for unaccounted money, if borrower is taking any money in the hundi form, it will be taxed. That's it. Okay. So this is very simple. Clause 30, it is done. It was with respect to if any amount is borrowed on hundi. So if you are the tax auditor, if your SSC has borrowed any amount of money on hundi and all, so then you have to give details here. Okay, but as you see, guys, you must have been doing tax audits, but these are certain clauses, I mean, which is not very common. I mean, most of the cases, I'm very sure you must have written not applicable here. Okay, all right, but and most of the times, because we write not applicable, we are generally not even interested to understand, okay, what is this clause all about. Okay, we are only focused with understanding those clauses which are actually common and applicable to most of our clients. All right, okay, so now we are going to do now very important, not important, but yes, few sections about which perhaps you have no knowledge if you have not yet started with income tax. Okay, and some provisions I am just going to discuss which you have not covered at the intermediate level also. Okay, so we are going to now cover 3 clauses, guys. Okay, clause number 30A. Okay, this is just the explanation. Clause is very small. Okay, this is just the explanation. 30A, 30B, and then I'm going to cover 30C. These are more or less related to the concept of transfer pricing. Okay, do you know what transfer pricing means? Yes, guys, do you know what transfer pricing means? Clause 30A and 30B are somehow related to transfer pricing. Okay, I'll just write it down. And okay, and clause number 30C is with respect to GAAR. What is GAAR? GAAR stands for General Anti-Avoidance Rules. Okay, so we are going to now cover these 3 clauses. Okay, the clauses. Okay, now before I start with the clause, let me just give you, a basic idea about what transfer pricing means, okay, because we have to understand this first and then only we'll be able to understand the clauses. So what is transfer pricing? Okay, now I'll give you some basic examples as to what transfer pricing is. Okay, now transfer pricing. Alright, so let's say, first of all, this transfer pricing, basically it is, the Income Tax Act, we have a separate chapter number 10, which is basically about transfer pricing, and the taxation with respect to transfer pricing is we study there. Okay, now this transfer pricing, okay, I'm going to take two cases to make you understand what transfer pricing means. Okay, one is basically for international transactions, because if you don't understand the basics, it is going to be useless to understand the clause. Okay, so one is for international transactions and the second one is for specified domestic transactions. Specified domestic transactions. What is this, sir? I'll just explain. So these are the two types of transfer pricing that we are going to cover. Okay, but the clause is only with respect to this part. Okay, so what is international transaction? What is the concept of transfer pricing? Okay, now let me just give you an example to make you understand. Let's say this is an Indian company. This is an Indian enterprise. This is an Indian enterprise here. Okay, and they have let's say they have an related associated foreign enterprise. So they have it might be a subsidiary, it can be anything. Okay, so they have a associated, somehow related foreign enterprise. Okay, now what happens, please understand, generally the rates of taxation, in India, some companies might find it very high. I mean, as compared to other countries, the rate of taxation in India is relatively high. Okay, so the big companies, what they do, the big companies, they get their companies incorporated in many different countries, right? Now please understand, let's say some countries, there might be cases wherein they don't even have any taxation, any scheme of taxation, any taxation regime. We call them as tax havens, like for example Mauritius, Cayman Islands. Okay, then there are certain other countries, okay, wherein there is no tax regime as such. Okay, so of course, so what is going to now happen, please understand. So let's say there is an Indian company, Indian enterprise, and they have an associate, I mean a foreign enterprise in another country, let's say the name of the Cayman Islands, where there is almost zero rate of taxation. Okay, now please understand, where will the company want to earn more now? In India or in Cayman Islands? Where would the company want to earn more now? Because when they earn more in a particular area, where will, of course in Cayman Islands probably they'll have to pay very less tax or no tax at all. Yes, so they would always be wanting to earn more in Cayman Islands. So now what happens, if they earn in India also, in the Indian enterprise that I am referring to, they would somehow want to, divert the profits. They would somehow want to shift their profits to this foreign enterprise. Why? Because the tax rate there is almost zero. They won't have to pay taxes there. So even if the enterprise is in India, it would always want to shift some of the profits to the associated foreign enterprise. Again, you understand the logic. Why? Because the tax rates here are very low, or let's say no tax at all. But then how can the shifting of profits be done? Very simple. Okay, let me just give you an example. Let's say if this company, if this Indian enterprise is making a sales, to this foreign enterprise, if it is making a sale, they are going to underprice the sale. So if they underprice the sale, what is going to happen? The profits of Indian enterprise will be what? Low. Are you able to understand? Similarly, let's say if they purchase from this associated foreign enterprise, what is going to happen? They are going to purchase it at a very high price, so that their cost increases, profit decreases, and here the profit is going to be up. Are you able to understand? Ultimately, see, the money, whatever money earned is going to go to the parent company. Okay, but then of course the parent company, the big companies, the MNCs, they would want to minimize their taxation, right? So this is how they basically try to shift profits. In India, if the rates of taxation is high, they might try to shift it in this way. Okay, are you able to understand this much? Yes. So now what is going to happen? Okay, so profits in India are being shifted to Cayman Islands now. Okay, so now please understand. So this is basically, you know, a case of transfer pricing. The department knows this is happening, so they have basically, you know, introduced some taxation aspect with this regard to this kind of arrangement also. Okay, so we are going to learn about it. Okay, so this is just one example. Now if let's say the funds, I mean, you know, the profits in India is now being shifted. In this example, the profits from India generating in India now shifted to, let's say, Cayman Islands. So again, of course, tax wise also there is a loss. The second thing is, you know, the funds of India are going outside India. The funds which was generated in India is now going outside India. So this is a very serious concern. Okay, so then the concept of transfer pricing was introduced. Okay, so this is with respect to international transaction, and in tax audits, guys, we are only going to refer to this particular transaction. Okay, but then later on, that concept of transfer pricing was introduced in case of domestic transactions also. How? So let me just give you an example just for your understanding. Okay, so let's say this is an Indian enterprise only. Okay, and it has got two businesses. This is an Indian enterprise. They have got two companies, two businesses. One is, let's say, we call it as non-eligible business. When I say non-eligible, this simply means you know, this particular business, the entire amount is taxable. Whatever they earn is taxable. Okay, and secondly, on the other hand, if I say eligible business, so let's say the eligible business is the one which is enjoying, let's say, tax holidays, let's say under section 80IB and all. Okay, so under 80IB, if they fall under 80IB, they will not have to pay taxes, let's say, for 10 years or whatever conditions it is. Okay, so what is going to happen now in this scenario also? Even though this Indian enterprise would always want to shift profits from this company to this, yes or no, so that here they don't have to pay any taxes. Do you agree with this understanding? Do you understand this, guys? So here also the concept of domestic, you know, the transfer pricing was introduced for specified domestic transactions. Okay, all right. So I have just tried and given you an understanding of what transfer pricing is. Okay, but then now how will the taxability arise? What do we have to report? Let us now try and understand this. Okay, now before we go through the clause, I am going to make you understand some terms at least that you need to refer to understand this clause. Okay, so let us understand a few terminologies, few terms. Okay, now what is transfer pricing? Okay, now please understand, transfer pricing means, the term transfer pricing refers to the price which is paid for goods or services that are transferred from one unit of an organization to its other units which are situated in a different country. So transferring of goods or services from one unit to another unit which is basically situated in a different country. Okay, now it says, okay, please understand the transfer, what has happened here. Okay, I told you that this Indian enterprise is making some sales, let's say. So they try to do sales at a higher price or a lower price, guys. They will try to do sales at a higher price or lower price. If they want to bring down their profits, this Indian enterprise would want to bring down their profits. They would want more profits here. Okay, so for this, will they increase their sale price or decrease the sale price? Decrease. Okay, so what I'm trying to tell you is, now they have not sold their product to their associated foreign enterprise at arm's length price. You understand what arm's length price is? Arm's length price is basically the price which is offered to those people, let's say, what unrelated. Okay, so now in this case, what has happened, the example which I gave you, the sales has been made by the Indian enterprise to its associated foreign enterprise at a price which is, let's say, lesser than the arm's length price. Do you agree with this? Yes. So then again, the department would be very, alert here. So let's understand now what has to be done. Okay, so this is transfer price, and then I told you, just a moment. Yeah, so this is transfer price, and then I just told you about the arm's length price also. Okay, now what has to be done here? So please understand, if the arm's length price, now please understand, if the transfer price, okay, or actual the arm's length price, if there is a difference, okay, then there needs to be, then we call it as primary adjustment. Okay, now please understand, it says when it comes to a transfer pricing, in the concept of transfer pricing, there are namely two types of adjustments to be made: primary adjustment and secondary adjustment. Very simple, primary adjustment and secondary adjustment. So what is primary adjustment? It is very simple, guys. If let me just put it in this way, either of the case, what is primary adjustment? I'll just write it here. Okay, let me just write it here. PA, primary adjustment, basically it means the transfer price minus ALP. I mean, if the transfer price exceeds the arm's length price, okay, or let's say it can also be the other way around. If let's say arm's length price is more than the transfer price. Now please tell me, when will this case be there? In case of sales or purchase? What, guys? Indian enterprise would always want to, let's say, show their profits as less, right? So either way, it will be a case of primary adjustment. So if there is a difference between transfer price and arm's length price, the case of primary adjustment would arise. Do you agree with this? Do you understand this? I mean, what is transfer pricing and what is arm's length price? If there is a difference between the two, in simple terms, if I say if there is a difference between the two, then the need to do primary adjustment will arise. What is primary adjustment? I am again going to tell you. Okay, so it says in layman's language, primary adjustment is defined to mean the determination of the transfer price in accordance with the arm's length principle, resulting in increase in total income or reduction in loss. Okay, transfer pricing provisions need to ensure that there is fair and equitable allocation of taxable profits amongst the tax jurisdictions of both the countries. So in cases where the underlying transaction is held not to be at arm's length price, now this is a very simple line. So in cases where the transaction is held not to be at the arm's length price, primary adjustments are made in order to align the transfer price with the arm's length price attained. This is called as primary adjustment. What is primary adjustment, guys? Number one, if the transaction has been done at a price other than arm's length price, okay, at a price which is not, let's say, the arm's length price, it is held not to be at arm's length price, the primary adjustments are to be made in order to align the said transfer price with the arm's length price attained. Hence, this is known as primary adjustment. Okay, I'll give you a very good example for overall understanding. Okay, now again, so there is primary adjustment. Then second, again we have to do a secondary adjustment also. Now please understand. Okay, all right, let me just give you an example. With the help of example, perhaps you are going to understand it better. So let me just take an example immediately so that you are able to understand. Okay, the terms. Okay, so I am still in clause number 30A. Let me just quote an example. Okay. Okay, so let's say X Limited, it is an Indian enterprise, okay, and they have YINC in USA. This is an associate enterprise. Okay, now simply I'm just saying, giving you example. Okay, let's say X Limited exported certain goods to Y Limited of 100 crores. Okay, and but then this was the transfer price. Transfer price was 100 crores, and the arm's length price as determined by assessing officer. Assessing officer told, no, how did you transfer it at lesser amount? The arm's length price for this transaction is 110 crores, let's say. Okay, now what is going to happen? Let's understand. So these are the cases: transfer price, arm's length price. Okay, what will be the primary adjustment? Is there any primary adjustment requires to be made, guys? Primary adjustment needs to be made. What will be the primary adjustment, guys? Arm's length price minus 100 crores. Okay, so this will come to rupees 10 crores. So 10 crore primary adjustment needs to be made. What is this adjustment about? That, okay, now 10 crore rupees is an amount which needs to be adjusted in the books of which companies? X Limited also and Y Limited also. This is the primary adjustment to determine the amount of adjustments to be made in the books of X Limited and Y Limited. Okay, see, in India they are, let's say, going to tax 10 crore rupees. Okay, let's say, okay, they are going to tax 10 crore rupees, they'll say that no, this is a part of your sale, we'll include it in your sales. So of course they will need to do changes in their books also, right? So now primary adjustment will basically tell us as to what amount the adjustment needs to be done. And then once this amount is determined, guys, okay, once this amount is determined, they are again going to do a secondary adjustment. Now what is secondary adjustment? Secondary adjustment is basically making adjustments in the books of accounts. Secondary adjustments is basically now, after having determined the primary adjustment, okay, this is the amount, both these companies will now have to make entries, pass journal entries in their books of accounts, maybe reverse the entries or whatever it is in the form of journal entries. So secondary adjustments basically in the books of companies they'll have to do. So in my example, if I give the example which I have taken, what will be the adjustments to be done in the case of X Limited, guys, RSSE? What entries do you think needs to be made in X Limited's case? Okay, this should be an income for X Limited or not? Because is it a part of their sales or not as per income tax? Yes, so the PL will be credited. Okay, so in case of X Limited, what is going to happen? Let's say I'll write associate enterprise account debit to rupees 10 crores, and I'll directly credit what to P&L account. The amount will be rupees what? 10 crores. This is the entry that needs to be done in the books of X Limited, okay? And of course, in the books of YINC, which is US based company, what entry will they make? Okay, so in their case, the profit will go down. Okay, so profit and loss account debit by rupees 10 crores and to what? To Indian enterprise. How much? Rupees 10 crores. So this is basically the secondary adjustment that needs to be made. Okay. Now, why did I tell you about this provision in so much of detail? Because if you don't understand what primary adjustment means, what secondary adjustment means, you will not be able to go through the clause. Okay. Now, few more points with respect to primary adjustment and secondary adjustment that we need to understand. Let's put it in this way. Okay. Let's go through the points now. Okay. Now, after the adjustment is made, of course, the amount should be brought back to India. Okay. Ultimately, what did I tell you? The concept of transfer pricing, no doubt there is shifting of funds, shifting of profits, but at the same time, Indian funds are going to other countries. So this is also not good. So the funds need to be repatriated back to India. They need to be brought back to India. Okay. So we have some points with respect to this also. So let us go through the section. I am basically teaching you section 92. If you can see, it is here also, CE, section 92 CE. We are reading the provisions of section 92 CE. So I told you what is transfer pricing. What is primary adjustment? Basically, primary adjustment in simple language, guys. If transaction is not done at arm's length price, okay, the difference between transfer price or arm's length price is primary adjustment. And when we have to make entries, adjustments in the books with respect to this primary adjustment, it will be called as secondary adjustments. Okay, so let's understand this. A secondary adjustment has to be defined to mean an adjustment in the books of accounts. So secondary adjustment is what? An adjustment in the books of accounts of taxpayer. That means the Indian enterprise and its AE. AE is the associated enterprise, to reflect the actual allocation of profits. So that actual allocation of profits is reflected between the taxpayer and its associated enterprise. Okay, and please understand, did I not tell you the funds also need to be brought back to India? So therefore the provisions on secondary adjustments seek to target such cash or fund benefit by seeking repatriation of such excess funds lying with the associate enterprise. So the funds need to be repatriated back to India. Now please understand, guys, here any funds not repatriated by the associated enterprise, the US, YINC, if it doesn't send back the money to India, then what is going to happen? It will be termed as advance given by the Indian enterprise, the SSE, to the associated enterprise, and notional interest rate will also be added to the total income of the SSE. So see how it is working now. If the amount, if your associate enterprise YINC, in my example, if it doesn't send back the money to India, it will be treated as what? That Indian enterprise has given loan to YINC, and they will also charge, the income tax is also going to add a notional interest to the income of the SSE. Okay, but a very important point to understand, guys, is this secondary adjustment, the making of entries in the books and repatriating the money back to India. No secondary adjustment is required if the amount of primary adjustment made in any previous year does not exceed 1 crore. So now please understand, this secondary adjustment will be made only if the primary adjustment amount is more than 1 crore. In my example, how much was the primary adjustment amount? It's 10 crore rupees. Of course, it is more than 1 crore. Hence we made the secondary adjustments. Is this clear?
Yes.
Yes. Okay. Few more points. Let us understand. Okay. Now it says, again. When I started with the concept of transfer pricing, I told you that transfer pricing is applicable for two types of transactions. One is international transaction and the second one is the specified domestic transactions. I think I made it here. Okay. Alright. But the concept of secondary adjustments that we have just covered, guys, okay, it is only applicable for international transactions. Okay, so we have one more point to cover, that secondary adjustments are applicable only in respect of transfer pricing adjustments relating to international transactions and not in respect of domestic transfer pricing adjustments. Again, you have to be cautious here. Both these two, in both the points, this is basically, you have to be alert here. It should primary adjustment amount, if it doesn't exceed 1 crores, no need to do any secondary adjustment. And also secondary adjustments are to be only done in case of transfer pricing adjustments relating to international transactions. Okay, now I told you if there is a secondary adjustment made, the amount needs to be brought back to India, repatriated to India by the associated enterprise, associate foreign enterprise, right? So again, there is a timeline also, time limit prescribed, that 10 CB, rule 10 CB provides for a limit of 90 days of repatriation of the excess money. So whatever excess money, in our example it was 10 crores. So whatever excess money is now lying with YINC, it needs to be repatriated to India within a period of 90 days. Else, I told you, they are going to treat it as advance, and again imputed interest, notional interest, or we call it as imputed interest also, that will also be levied. Okay, that will also be levied and will be added to the total income of the SSE. Okay, this is section 92 CE. Now again, I told you guys that alright, so in my example, the example which I took you, I told that, let's say X Limited has done some export sale to YINC. The transfer price was 100 crores, but assessing officer determined the arm's length price is 110 crores, right? So what I'm trying to tell you is here, where, in what cases will primary adjustments need to be done? In what cases will the primary adjustment needs to be done? If assessing officer says no, the arm's length price is this, which is different from transfer pricing, then perhaps you will have to do the primary adjustment. So let us understand this. When will the need to do primary adjustment arise? Okay, so number one is, it is voluntary, made by the taxpayer. He does it voluntarily, or it is made by the assessing officer and accepted by the taxpayer. Let's say it is determined by the advance pricing agreement entered into by the taxpayer under section 92 CC, made as per the safe harbor rules, mutual agreement procedures, etc. These are certain things, okay, you have to understand. But please remember that the need for primary adjustment, mostly it will arise when the assessing officer will determine that, okay, this is the arm's length price according to him and this is the transfer price. So then primary adjustment might have to be done. Of course, it can be done voluntarily also by the SSE. Okay, now having understood this, let us now go to the clause. Okay, so whatever I had to explain with respect to transfer pricing, I have done my best to teach you income tax, okay, with the help of an example, and now probably we'll be able to answer, you will be able to understand this clause in a very simple manner. Okay, number one, clause 30, again I told you it is with respect to transfer pricing. So under clause 30A, point A, what is it that the tax auditor has to report? So point is whether primary adjustment to transfer price as referred to in subsection 1 of section 92 has been made during the previous year. So in our SSE's case, whether any primary adjustment has been made, yes or no is what we have to reply. Now imagine, guys, how will you understand what primary adjustment means if I don't take you through all those examples and all these extra explanations? How will you understand? Okay, and again, like if you are not appearing for group 2, you are just preparing for first group, Okay, it is going to be really very difficult for you. So I have tried my best to incorporate all the explanations with the help of examples also I have taught you, so that you are able to understand the clause in very, well mannered. Okay, so whether primary adjustment has been done. What is primary adjustment? I told you, either transfer price minus the arm's length price, or it can be the other way around also, arm's length price minus the transfer price. If the answer to this is yes, then we need to furnish the following details also. Okay, now it says under which clause of subsection 1 of section 92C primary adjustment is made. Okay, so in my example, let me do one thing. Let us understand all these points through the example which I just gave you. So it says under which clause of subsection 1 of section 92C primary adjustment is made. So if you remember guys, in the question I wrote that the arm's length price has been determined by AO. Okay, and here I made you read a theory also, that primary adjustments, it might need be, it can happen in one of the following circumstances. It can be, let's say, voluntarily made by the taxpayer, or maybe let's say by tax officer. So because it is a case of tax officer, it is basically, I did not write clause number here, I just wrote the bullets 1 2 3 4 5, but then it will be made, let's say it will be made under which clause? It will be made under clause B of subsection 1 of section 92C. Why? Because it has been done by assessing officer. Had it been a case of voluntary basically disclosure, let's say it, voluntarily made by taxpayer, then it would have been clause A. Are you able to get this? So it says under which clause has a primary adjustment been made, either voluntarily done by the taxpayer, or let's say by the assessing officer. Is this clear guys? Yes, okay. Amount in rupees of primary adjustment. Amount in rupees. How much was my primary adjustment in my example? Rupees, how much? 10 crores. So I need to mention 10 crores. Okay. Next, whether excess money available with associated enterprise is required to be repatriated to India as per the provision subsection 2 of section 92CE. So because the amount, now please understand, secondary adjustment needs to be made only when the amount exceeds rupees 1 crore. But because the amount is 10 crores here, will the amount has to be repatriated to India? Yes. The answer will be yes. Okay. Now if yes, whether excess money has been repatriated within the prescribed time limit. What is the prescribed time limit? What did I tell you? What is the prescribed time limit guys? 90 days. 90 days.
90 days.
Rule 10CB provides for 90 days. So we as tax auditors now have to say right here, if the answer to this is yes, whether excess money has been repatriated within the prescribed time. So let's say yes or no. Let's say assume, let's say I write no. Then what is going to happen? If no, the amount in rupees of imputed interest income on such excess money which has not been repatriated within the prescribed time. Did I not tell you that the income tax will treat this excess amount as an advance given by the SSC to the associate enterprise, and a notional interest will be now added to the total income of the SSC. So we call it as imputed interest income. So again, if the amount has not been repatriated within prescribed time, then I need to write the amount in rupees of imputed interest income. So again, for computing the interest, there is altogether a different calculation. I am not going into the details of calculation of interest income. You don't need to know that. But yes, this is what we have to report under part B of clause 30A. Now is this clear guys? Yes, I think this example makes it very clear, and you remember this example, and then probably when you understand, when you read the clause, it is going to be super easy for you. Fine? Yes, okay. Now coming to the next clause, I told you we are going to cover few more clauses guys with respect to transfer pricing. Okay, and I told you it is going to take time because you don't know what transfer pricing means, so a bit of explanation was required here. Okay, now coming to clause 30B, it is also somehow with respect to transfer pricing. Okay, now before I read this, let me just explain you how transfer pricing is relevant here. Okay, so let's say again, this is an Indian enterprise. Okay, and Indian enterprise, let's say, yeah, this is associated foreign enterprise. I am just writing it AE. Okay, now please understand, See, let's say this Indian company, they want money to do more business or something. They want money, they are in need of funds. So either they can go for raising money through equity, or they can also go for debt. Okay. Now what happens when they raise money through equity? The cost of procuring, or let's say acquiring the capital, I mean, in case of equity, no deduction as such is allowed. But if they raise debts, of course the interest, do you think interest will be an allowable expense for this Indian enterprise? If they take loan, will the interest expense be allowable for Indian enterprise? Yes or no? Interest amount, is it allowed in P&L or not? Yes, right? So now, keeping this thing in mind, the Indian company would always probably, they would want to take in loan. Okay. So now what happens? This Indian enterprise, let's say, took loan from their associate enterprise. They took loan, they took debt, and in return, they must be paying what? Interest. And see, they take loan and they pay huge interest, and when they pay huge interest, of course this would be allowed in their PL, and ultimately the interest portion, it is again going back to another country. It is going back to altogether another country. Now again, income tax wants a restriction on this. Okay, you took a loan from your associate company, associated enterprise, associated foreign enterprise. Maybe this Indian company was not even in need of loan, but then they took it just to show the interest component, let's say, okay, and claim benefits here in India and pass the income. Pass basically, now this interest is an expense for this Indian enterprise, but it is an income for the associated enterprise where the tax rates are less. Right, so they are again shifting profits by this way, right? So in this case, what is going to happen? Now please be very careful. If the clause that we are going to cover, the section that we are going to cover here is applicable if the interest income exceeds 1 crore, then we have to understand what has to be done. Okay, so here the income tax says that, see, we are not going to allow you 100% of the interest that you give to your associate enterprise. Okay, we are not going to allow you the entire interest component, but rather we shall only allow you, so maximum interest which is going to be allowed to you is basically 30% of your EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, amortization. So the maximum interest which will be allowed is 30% of EBITDA. EBITDA of what? This Indian enterprise are SSC. This is what the Income Tax Act says. Okay, and so what is going to be the excess interest? Excess interest will be disallowed. What is going to be the excess interest? Let's say it will be what? Interest already paid. Interest paid minus how much? 30% of EBITDA. So this is the excess interest. Now what will be doing with the excess interest and all? Let us understand. Okay, so this is the overall concept. All right, so we are going to understand this case in clause number 30B. Okay, so but before this, again let us go through the points here. Clause 30B requires reporting for the purpose of examining allowability of expenditure by way of interest exceeding 1 crore. So I told you, this clause will be only applicable when Indian enterprise is paying their associate foreign enterprise interest which is exceeding rupees 1 crore in respect of debt issued by non-resident associate enterprise. Okay, now the excess interest is to be computed as the lower of. Excess interest will be what? Lower of, it says, total interest paid or payable in excess of, total interest which has been paid or payable in excess of 30% of earnings before, I told you, EBITDA, in earnings before interest, tax, depreciation and amortization, or interest paid or payable to an associate enterprise for the previous year. The lower of, we have to see the lower of both the two. This is basically the excess interest. Okay, so this will be disallowed. This will be disallowed for the current year. The Indian government, the Income Tax Act says no, we cannot allow you this much amount of interest. But let's say if you have paid that much amount of interest, then for this year we are only going to let you, let's say, give benefit to you for maximum 30% of this. But if you have paid more, you can use that in, let's say, subsequent years. Okay, this is somehow like the MAT taxation scheme, MAT credit scheme. Okay, so now the excess interest, it can be utilized for 8 years. You can basically carry forward. You can carry forward. Okay. Now in some year, let's say in some particular year, your the interest allowed basically is whatever interest you have paid, it is lesser than 30% EBITDA, then of course the excess interest which was earlier disallowed to you, you can basically use it. Okay, so 8 years it can be carry forward. Okay, so let me just read this point. The excess interest which is disallowed, it is disallowed now, right, is allowed to be carried forward for a period of 8 assessment years following the year of disallowance, to be allowed as a deduction against profit and gains of any business in the subsequent years, to the extent of maximum allowable interest expenditure under this section. So let's say in 7th year or 6th year, okay, what interest that was paid is not even 30% of this EBITDA. Okay, if it is not 30% of EBITDA, then whatever interest income was earlier disallowed, it can be now allowed. Okay, so subject to the maximum interest allowed. Now this is the entire case of clause 30B. But then again, because we have just understood the concept, now let us try and understand it with the help of a very again simple example, and then we'll try to understand the clause. Okay, so let us read it, put it in this way again. So there is X Limited, the Indian enterprise, and associate Y Inc is the foreign enterprise, associated foreign enterprise. Okay, now let's say they have obtained loan of rupees 500 crores, okay, at the rate of 12% per annum. This is the case. Okay, and the EBITDA of this EBITDA of X Limited, let's say it is rupees 180 crores. Okay, now let us do the calculations. Okay, yes, so how much is the actual interest paid, guys? Let's say actual interest paid. How much will the actual interest be? Actual interest paid, or let's say payable. How much will this come to? 500 crores into 12% per annum. Will this come to 60 crores? You get this right?
Yes.
Yeah. So how much is the EBITDA? EBITDA is rupees 180 crores. Okay. And how I told you how much interest is allowed, maximum interest which is allowed. Max allowed interest. Is it 30% of EBITDA? EBITDA 30%. Okay, so maximum allowed will be how much, guys? 30% of 180 crores. Right? How much does it come to? Rupees 54 crores. Okay. Now this is the maximum allowed interest. Okay, so how much excess have they paid? Excess interest. How much excess have they paid? Rupees 6 crores. So this 6 crores will be disallowed in the coming years. But can it be carried forward in subsequent 8 years? Yes. Let's say in one particular year, 30% of EBITDA was, let's say, coming to 60 crores, but they only paid 20 crores as interest. Then it can be used, right? So this excess interest will be now let's say it can be carried forward for 6 years. Okay, so this is the entire concept. Now Government of India, I mean the income tax department, will not allow this 6 days. They are going to basically add back this 6 crore rupees to the profits of X Limited. This is the entire section. Okay, now as a tax auditor, what do we have to report? Very simple. Now it is going to be very easy for you. So whether in the first part, whether the SSC has incurred expenditure during the previous year by way of interest or similar nature exceeding 1 crore rupees as referred to in subsection 1 of section 94B. So in our case, the answer is yes. Of course, they have paid interest to the tune of how much? 60 crores, which is of course greater than 1 crore. So the section will be applicable. Yes. Now, if the answer is yes, please furnish the following details. Amount of expenditure by way of interest or similar nature incurred. Amount of expenditure. So how much was the amount of expenditure, guys, in our case? Rupees 60 crores. Right? We were paying how much? 12% at the, I mean, on 500 crores we paid 12%, right? Now, earnings before interest, tax, depreciation and amortization during the previous year. How much was it, guys? Rupees 180 crores. Okay. Amount in rupees of expenditure by way of interest or similar nature which exceeds 30% of EBITDA as per above. Amount of expenditure by way of interest which exceeds 30%. How much was the excess? Right? And okay, so this is the excess. let's say it might so happen that this year there is no excess, so you might have any the brought forward basically interest component. So does any interest expenditure brought forward as per subsection 4? So let's say in this case was no. Does details of interest expenditure carried forward, if you are going to carry forward as per subsection 4 of 94P, so this 6 crores, is it not going to be carried forward? So you just have to mention it. Are you getting my point, guys? So you understood the entire section? Yes, okay. So clause 30B is also done now. Okay. Alright, so again, see, this is all with respect to transfer pricing. Now 30C, we are now going to cover clause 30C. 30C is very simple. This is basically on general anti-avoidance rules. What is general anti-avoidance rule? We'll just understand. Okay. Now let us first read the two parts here. It says whether the SSE has entered into an okay, there is a spelling mistake, I think. Impermissible avoidance arrangement. Whether the SSE has entered into something which is not allowed, impermissible avoidance arrangement, as referred to in section 96 during the previous year. So we just have to first say whether our SSE has entered into any impermissible avoidance arrangement as referred to in section 96. If the answer to this is yes, then what is the nature of impermissible avoidance arrangement and amount of tax which has been basically benefit which has been in the previous year arising in aggregate to all the parties to the arrangement. Now what is this section 96? Now before understanding section 96 which is with respect to general anti-avoidance rule, I would like you to go through section 95 first before understanding section 96. So I have mentioned section 95 here also, and then we have section 96. What is section 95? 95 is basically applicability of general anti-avoidance rules. It says an arrangement entered into by an SSE may be declared to be an impermissible avoidance arrangement, and the consequence in the relation to tax arising therefore may be determined subject to the provisions of this chapter. So it says an arrangement entered into by an SSE may be declared to be an impermissible avoidance arrangement. Now please understand, guys. Okay, I'll just give you an example first before we understand what can be impermissible avoidance arrangement. Okay, let's say there is a company in India, again X Limited. Okay, now what does X Limited do? X Limited, let's say they buy certain goods from UK. Okay, please understand, they buy certain goods from UK and it is exported, it is sent to US. The goods doesn't come to India. The company is in India. What is the work that they are involved into? They buy certain goods from UK and they sell it in USA. Okay, so what was happening? Of course, because the company is in India and all, whatever profits that they earn, of course it is going to be taxable in India, right? But then let's say this X Limited, they came to know about Cayman Islands, or let's say any other country wherein the tax rates is really very, very less. So what they did is, let's say they incorporated a different entity, another entity in Middle East, or let's say maybe in Cayman Islands or Mauritius. Okay, so XM Limited, X Mauritius Limited, let's say. Okay, they incorporated this entity XM in Mauritius. Now the same business they are doing it from Mauritius now, that they buy goods from UK and they are being sold in USA. But what is the advantage now to XM Limited? What is the advantage now? That they don't have to pay any taxes, or let's say a very less amount of tax as compared to India, right? But then please understand, the company was incorporated there in another country, but now the company is totally incorporated there, but it is totally managed from India. It is managed from India. It is a clear-cut case that it was done to basically basically transfer the profits there, or let's say not to pay higher taxes in India, but it is now being entirely managed from India. The companies in Cayman Islands, or let's say not Cayman, I gave Mauritius as example. Let's say the company is in Mauritius, but then it is managed from India. So now again the income tax department will be of the view that no, we are going to tax you here in India. Why? Because you are managing it from India. Okay, this arrangement this arrangement was only done to basically evade taxes in India. So this is from now onwards we say that this is an impermissible arrangement. See the language here, it will be declared to be an impermissible avoidance arrangement. You have entered into this kind of arrangement to avoid taxes in India. So we are not going to allow this. I mean, this is impermissible avoidance arrangement and consequence in relation to tax. So this is section 95 general anti-avoidance rules. Okay. Now, how will the income tax department say that this is an how will they declare something as impermissible? Okay, so let us now read section 96.1. 96.1 says an impermissible avoidance arrangement means an arrangement the main purpose of which to obtain is tax benefit. You are trying to obtain tax benefit and it creates rights or obligations which are not ordinarily created between persons dealing at arm's length. So you try to enter into an arrangement which is not normal, I mean which is not ordinarily created. How will they tell that okay, this is an impermissible avoidance arrangement? How will the department say? So they are going to look into the following things. So this is something which is not ordinarily done, number one. Second, it results directly or indirectly in the misuse or abuse of the provisions of this act. This is, let's say, violating the provisions of this act, or let's say whatever arrangement the SSC has entered into, it lacks commercial substance. Okay, and it is entered into or carried out by means of or in manner which are not ordinarily employed for bona fide purposes. That means the purpose, the intention is very, let's say, malafide there. Okay, so you don't have to learn all this, guys. This is just for your understanding. Okay, so if you know this is how an arrangement can be called as impermissible avoidance arrangement. So an impermissible avoidance arrangement means an arrangement the main purpose of which is to obtain tax benefit. Okay, so now in this case what is going to happen? Okay, in this case we just have to report. It says whether the SSC has entered into an impermissible avoidance arrangement as referred to in section 96 during the previous year, yes or no. So in the example which I gave you, it will be yes. On what basis? Nature of impermissible avoidance arrangement, let's say lack of substance. Okay, doesn't substance over form we say. So let's say the transaction, the arrangement that they have entered into, it lacks substance. They are totally managing the company from India. Okay, they have incorporated an entity outside India, but it is being managed in India. So then again the income tax might say that it is impermissible avoidance arrangement. Okay, so the nature and the amount of tax benefit, the amount of tax benefit in the previous year arising to all the parties because of this arrangement. This is what the auditor needs to report. Okay, so this is clause 30C, general anti-avoidance rules. Okay, is this clear, guys? क्या प्राची समझ में आ रहा है? ऐसे लग रहा है क्या हो रहा है, कहाँ कौन सा दुनिया में चलेगा? इनकम टैक्स, you must have not covered income tax, right? But you take your case only. I think you are only going to appear for one group, right? So if I don't teach you, I mean a bit of the provisions, फिर क्या मजा आएगा? मतलब थोड़ा भी कुछ समझ में ही नहीं आएगा. Tax audit, right?
Yeah.
So yeah, so don't ignore these. Okay, and see, I have worked a lot so that I I've compiled the notes, I mean the explanation part from a lot of different sources. Basically, if I just try and incorporate the language from the GAAR Act, it is going to be very difficult for you. So I've tried my best to put it in very simple, short, crisp manner, so that at least when you again revise the clauses, you will be able to, you'll have a full understanding. Okay, this is clause 30B all about, 30C all about. Okay, so done. So we are done with the transfer pricing clauses 30A, B and C. Okay, now coming to clause number 31. Okay, now again 31 is something which you all must have done in your office. Okay, and yes, so if I show you the length of the clause, guys, don't get don't panic and don't get afraid, but let's see how big clause 31 is. Okay, so it starts from here, part A. I mean, I'm just counting the number of parts. Part A, I mean this is 1, 2, okay, 3, 4, 5, 6, 7, 8, 9. 9 parts in only clause number 31. Okay, but then it seems to be very long, but trust me, this is going to be super interesting, and it is not that long. I mean, we are not, the amount of time which I took in transfer pricing, we are not even going to take that amount of time when we cover clause number 31. It is going to be super easy, provided you understand it. Okay, so what are the clauses all about? Let us now understand. Okay, so in clause number 31, sorry, we are going to understand basically we are going to cover three very important sections of the Income Tax Act. Okay, so clause, let me just write it for you. Clause 31A and 31B. Clause 31A and 31B, it is with respect to section 269 SS. किया नहीं प्राची ऑफिस में? 269 SS, you do it. Okay, so this is with respect to 269 SS. Okay, let me just mark it for you, 269 SS. Okay, first I'm just trying to give you an overview. Okay, now again 31, the next four clauses, BA, BB, BC and BD. Okay, just let me write it for you, BA, BB, BC and BD. These are with respect to section 269 ST. Okay, so you can see here in all the next clauses, 269 ST, 269 ST, 269 ST and again 269 ST. Okay, all right. Then again 31 clause part C, C, D and E. C, D and E. These are with respect to section 269 T. Okay, so if in all guys, how many parts? 4, 5, 6, 7, 8, 9. 9 parts in total, but very it's going to be very easy for you to understand. Okay, so yeah, but I think a bit of understanding is required here, and with the kind of in-depth analysis that we are going to do, these sections and these clauses are going to be very clear. Okay, so I want your full attention now. Okay, so what is 269 SS? First we are going to cover this, then 269 T, and then finally we are going to come to this part. Okay, what is 269 SS? Okay, now before I start with the clause, let us first go through what 269 SS means. Okay, so after this 9 points, if you can see 3 pages of clause 31, after these 9 points we further have explanation to this for your understanding. Okay, this is for your understanding. I have tried to incorporate the relevant sections in brief, in very simple language. Okay, so this is the explanation part is not much. We are just going to focus on the sections. Okay, so it says what is 269 SS? Okay, so it says a person cannot accept, he cannot accept. So 269 SS is with respect to acceptance. He cannot accept loan or deposit or any other specified sum. Be very careful. A person cannot accept, 269 SS is with respect to acceptance. He cannot accept any loan or deposit or any other specified sum. Now what is this specified sum? Specified sum refers to an advance or otherwise in relation to transfer of an immovable property. So I am the person, I cannot accept any loan or deposit or specified sum from another person other than by way of account pay check or account pay bank draft, or it can be through ECS also, all electronic modes. Okay, so if I receive in cash, in simple words, if I receive any loan, deposit or specified amount in cash, it says, or use of electronic clearing system through bank or otherwise specified or otherwise if or other specified manner, if it says, okay, yeah, so a person cannot accept a loan, deposit or other specified sum other than account pay check or through banking channels. Okay, so if I receive loan, deposit or other specified sum in cash, what is going to happen? So let's understand. If amount or loan or deposit, if amount of loan or deposit or specified sum is rupees 20,000 or more, number 1 point, if the loan amount or deposit amount or the specified amount that we are referring to, specified sum, if it exceeds 20,000 rupees, if it exceeds rupees 20,000, if it is 20,000 or more, we cannot accept it in cash. It has to be through what? Through account pay check, bank draft or other electronic clearing system. Okay, then so let's understand the example. So for example, I have given you examples here. Aman wants to take a loan of 50,000 from Nitesh. So it simply says he cannot accept it in cash because it is going to violate section 269 SS as the amount is more than rupees 20,000. Do you understand this? Very simple. Is this clear?
Yes.
Okay. Again, now few more examples to understand this section. Okay, so this is with respect to, again I'm writing it in bold here, in again acceptance. Okay, so sum total of loan, deposit or specified sum amount is 20,000 or more. Now let's say Aman wants to take a loan is only 6,000 and deposit is 15,000. He wants to take money from Nitesh in two forms. One is deposit and the other one is loan. So but now since the total of both these exceed 20,000, again 269 SS will be attracted, yes or no? So it says Aman wants to take a loan of 6,000 and a deposit of 15,000 from Nitesh. He cannot accept in cash because the total sum is 21,000, which is exceeding 20,000. Again 269 SS will be attracted, so he cannot take amount in cash. Is this clear? Yes. Yeah. So these are certain examples to make make this section very clear to you. One more example. So in case where a person had already received a loan, deposit or specified sum from the depositor, but the loan or deposit or specified sum hasn't been paid back, in such case, if the unpaid loan or deposit or specified sum is 20,000 or more. So again, let's understand it through the example. For example, Aman had accepted a loan from Nitesh on 1st June 2020 by cross check of rupees 19,000. So he has already, the opening balance, let's say it is 19,000. He already has taken a loan of 19,000. On 15th April, Rahul wants to take, this should be Aman. On 15th April, Aman wants to take another loan from Nitesh. There's some error in copy pasting. Okay. So Aman, on 15th April, Aman wants to take another loan from Nitesh of rupees 2,000. The earlier loan remaining unpaid on the date. So earlier he had taken 19,000, but now it is only 2,000 amount. So can this 2,000 be taken in cash? The answer is no. It says since the total loan outstanding is now 21,000, 19 plus 2,000, it is more than the specified limit. So then Rahul cannot accept, not Rahul, rather Aman. Aman cannot accept the new loan on 15th April 2000 made by cash. Are you able to understand the examples? Do you understand section 269 SS? So in simple words, okay, 269 SS is with respect to accepting what? Three things, either in the form of loan or deposit, or there is one more word, guys, specified sum, other specified sum. Other specified sum is basically an amount with respect to what? It refers to an advance or otherwise in relation to transfer of any immovable property. So if you have given me any amount with respect to, let's say, any immovable property, I cannot accept the same if it exceeds rupees 20,000. I cannot accept the same in cash if it exceeds rupees 20,000. Is this clear? I mean, I just gave you the example so that you have clarity about section 269 SS. Is this clear? Yeah, but then what if okay, I'll just have to make, let's say, what if, let's say, 269 SS is violated? I mean, it is not it is not basically adhered to. What is the penalty amount? So please understand, penalty in this case, it is covered in section 271D. So penalty in this case is basically amount of loan or deposit. So whatever amount you have taken in cash, I mean, if you have violated section 269 SS, whatever amount you have taken, basically or accepted, this will be the penalty amount. Amount taken or accepted is the penalty amount. Okay, so this is 269 SS. Okay, so this was just a brief idea about the section, but then now let us go through the clause. Okay, 269 SS, I just wrote it here, I guess. Yeah, 269 SS, basically we have to report about these transactions under two clauses, 31A and B. Now it is going to be very simple. See, now I told you, you don't have to go through all the points here. Why? Because all the points are same, but now you're going to understand the parts. 31, I'm reading part A and also part B. It says particulars of each loan or deposit. We have to give here the details of loans or deposits in an amount exceeding the limit specified in section 269 SS. What is the limit specified in 269 SS? 20,000 or more. Okay, so it is 20,000 or more. Don't get confused. It says amount exceeding the limit specified. We are going to take it as 20,000 or more. Okay, so 20,000 is also basically a part, 20,000 or more. Okay, so particulars of each loan or deposit in an amount exceeding the limit specified in section 269 SS taken or accepted during the previous year. Okay, so we have to furnish the details with respect to loan or deposit accepted by the SSC during the previous year. And on the similar grounds, we also have this point, particulars of each specified sum. So in section 269 SS, we have got three terms, right? If you accept loan or deposit or specified sum. So if my SSC, I am the tax auditor, if my SSC, they have accepted any loan or deposit, then reporting has to be done here. If they have accepted any, specified sum, then the reporting has to be done under part B. Very simple. Okay, so what reportings are? Very simple. Again, let us go through it. Name, address and permanent account number if available with the SSC of the lender or depositor, the one who has basically given the money. Okay, or the depositor who has deposited the money, we have to provide the details of him, of the person. So name, address and PAN number. Second, amount of loan, amount basically, okay, of loan or deposit. Third, whether the loan or deposit was squared up during the previous year. Now please understand, it is not necessary that it has to be outstanding as at the end of the year. Whether loan was taken and then it was squared off, I mean repaid also, then also the details needs to be given, whether the loan or deposit was squared off, and maximum amount outstanding in the account at any time during the previous year. Let's say it might be outstanding at the end of the year. I took 1 lakh rupees in cash, I gave 20,000 back, again the outstanding is 80,000. So what was the maximum amount outstanding? So let's say I took 1 lakh rupees, then I also took 20,000, then I returned 10,000. So outstanding is 1,10,000, but maximum outstanding was 1,20,000 here, right? So I need to give the maximum amount outstanding. Then whether the loan or deposit was taken or accepted by check or bank draft or using ECS through a bank account. So was the amount taken, okay, was the amount taken through account pay check? So all loan details basically, if my SSC has accepted any loans or deposits, so I need to now mention whether the same was accepted through account pay check or through account pay, let's bank draft, or through banking channels. Okay, in case loan or deposit was taken or accepted by check, in case it was taken by check or bank draft, whether the same was taken or accepted by an account pay check or account pay draft. So if you have to write first whether it was used through a check or bank draft, and then again if they give you a bearer check also, no, it has to be what? Account pay check. These are the points that we have to mention with respect to loans or deposits. And similar points, see, with respect to specified sum. I'll be quick here now. Name, address, permanent number of the person from whom specified sum is received. What is specified sum again? Tell me, what is specified sum? No. This says particulars of each specified sum. Specified sum. How you are saying? I am not asking you for the limits. I am not asking you for the limit. What is specified sum? Specified sum is a sum advance received in respect of an immovable property. Didn't I tell you 269 is for three things, Prachi? Loan, deposit and other specified sum. Other specified sum क्या होता है देखो? It refers to an advance or otherwise in relation to transfer of immovable property. आया समझ? Yeah. So these 2 points have been dealt with in part A, and with respect to specified sum, we have 31 part B. Sutir, clear?
Yes, sir.
Yes. Yeah. So part B again. ये specified some limit नहीं है. Limit तो आपको बताया ना 20. Limit is already here mentioned here. Okay. So exceeding the limit is 20,000. Okay. But specified sum, it is with respect to immovable property, advances, etc. Okay. So again, name, address, permanent account number of the person from whom the sum has been received. Okay. Secondly, amount. Then whether the sum has been taken or accepted by check. If through check, whether it was through account pay check or not. Whether the same has been taken through account pay check or not. So more or less the points are same here, guys. Okay. Point clause A and clause B. Okay. So please remember, this is for specified sum. Okay. And these part A is for either loan or deposit. 269 SS, is this clear? It is with respect to what? Accepting the loan or deposit or specified sum. Fine. Now, after 269 SS, now I am going to cover these clauses first. 269T. Please remember 269 SS was with respect to what? It was with respect to acceptance, right? If I am accepting a loan or deposit, and 2692 is with respect to repayment. Okay, so let us first read 269T and then we are going to cover these three clauses, 31C, D and E. Okay, what is 269T? Very small clause, let us go through it. Section. Okay, 269T prohibits any person. It prohibits any person. Okay, so here it was say a person cannot accept. Okay, but here it prohibits any person to repay. The main point to remember here is this is with respect to, I am writing it again, this is with respect to repayment. Repayment of what? Loan, deposit or specified sum. What is specified sum again? Amount received, amount basically with respect to immovable property. So now in 269 SS I mentioned it was with respect to accepting. If the SSC under audit, if he receives such money in the form of loan, deposit or specified sum, but now the SSC is repaying. If he is repaying any loan, deposit or specified sum otherwise than by an account pay check or account pay bank draft or by use of electronic clearing system through a bank account, so we have to report this. Okay, so section 269T prohibits basically any repayment of loan, deposit or specified sum in cash. Basically, if the loan or if the amount of loan or deposit including interest thereon is rupees 20,000 or more, or the aggregate amount of loans or deposits including the interest amount held by such person in his own name or jointly with any other person is rupees 20,000 or more. So if I have to pay more than 20,000 rupees repayment, then of course I cannot pay in cash. It has to be through the banking channels, maybe through account pay check, bank draft, etc. So 269T is with respect to repayment, guys. Okay, now what is the penalty here? Please understand, 100% of the loan or deposit amount will be the penalty leviable by the assessing officer. So I am repaying, I have just taken a loan, if I repay in the cash, 100% will be, you know, penalty upon me, upon the person who is repaying. Okay, now what is the thing, what is, as a tax auditor, now what do we have to report with respect to 269T? So let us go through the clauses. Okay, so in this page, part C, D and E of clause 31 is with respect to section 269T. If you can see, I just highlighted for you. Okay, and in this part also, okay, if you see, yes, 31C, this one, it is with respect to okay, let me just write it here for you. It is with respect to payers tax audit. What do you mean by payers tax audit? I mean, let's say if I took money from Prachi and I am now repaying, so my tax auditor will report in this clause. Okay, and part D and part E is with respect to pay's tax audit. So similarly, if Prachi is also having tax audit, her audit report, her auditor, would have to report in clause D and E. Okay, so for section 269T, the reporting has to be done with respect to both payer and payee also. So let's go through the points. Okay, number one, clause C, part C. Okay, not clause C. Clause is 31. Part C. Particulars of each repayment of loan or deposit or any specified advance in an amount exceeding the limit specified in section 269T made during the previous year. So payment has been made, payers tax audit report. So if my SSC has repaid basically the loan or deposit or any specified advance, then the reporting needs to be done. Okay, what reporting? Very same thing, name, address and PAN number of the payee to whom the payment has been made, amount of repayment, maximum amount outstanding. Again same, whether the repayment was made through check or banking channels. If it was made through check or bank draft, was it an account pay check or an account pay bank draft? Same things, guys. Okay, so this is going to come under whose tax audit report? Let's say I took money from Prachi, now I have repaid it. So my auditor will report it under clause 31C. Okay, but then let's read clause D and E also. Okay, D, particulars of repayment of loan or deposit or any specified advance in an amount exceeding the limit specified in section 269T received. So this is from the receiver's end. Receiver as in the payee. So in Prachi's tax audit report, if Prachi also has tax audit now, her auditor will report under clause D and clause E. Are you able to, I'm again saying clause D, sorry, parts D and part E. Are you getting my point? So what is it that Prachi's auditor is going to report? So same thing, name, address and permanent account number of the lender or depositor or person to whom specified advance from whom the money is received. So she is going to, in her audit report, my details will be given. And secondly, amount, basically second is amount. Okay, and then again, you know, they unnecessarily included part E here. This could have been made in part D itself. Next is basically again name, address, permanent account number of the lender. Okay, this is basically with respect to if the amount has been received by check or bank draft, which is not an account pay check or account pay draft. So if let's say, please understand, part D is basically with respect to the amount received by Prachi through account pay check, let's say through check or bank or use of electronic system of banking, etc., through account pay check, etc. But here, let's say it is received by check or bank draft, which is not an account pay check. So not an account pay check. So again the same thing, if I pay Prachi through cash or through, let's say a check which is bearer check, not an account pay check, so then Prachi's tax auditor is going to report here name, address, my name, address and permanent number, and then the amount of money that I have repaid. Okay, are you able to understand, guys? So 31 part D and part E, it is with respect to payer's tax audit report, and 31 part C is with respect to payer's tax audit report. Any doubts? Is this clear?
Yes, sir.
Okay, any confusion, please feel free to ask. Any confusion? Do you understand the difference between C, D and E? So I am trying to make it very clear for you. D and E is for payer's tax audit. Okay, so let's say I talk about my tax auditor. Okay, there is a transaction between me and Prachi. I am talking about my tax auditor, and I repay the amount to Prachi this year. So my tax auditor will report under which clause? Which part of 31? My tax auditor will report under which part of clause 31? Here, C? Yes or no?
Yeah.
Yeah, okay. And Prachi's auditor. Now let's say I pay Prachi through an account pay check. So then her tax auditor will report under which clause? Which part? D. And let's say if I pay the money this year, but I don't pay through account pay check, then her tax auditor is going to report in part E. Is this clear now?
Yes, sir.
Yes, okay, great. Okay, so 31, we are almost towards the end. I told you, see, if you go by the length of the clause, it is huge, but it is not very difficult. Okay, if you understand these sections. Okay, now we have to cover now 31 BA, BB, BC and BD, which we are going to cover this in section 269 ST. So we have to understand first section 269 ST. We have covered 269 SS, we have covered section 269 T. Now let us understand 269 ST. Okay, so first let us understand the explanation part. 269 ST, very simple, guys. Okay, it says section 269 ST prohibits any person to receive, this is also with respect to receive an amount of rupees 2 lakhs and above in cash. So no person can receive any amount more than let's say 2 lakh and above in cash in aggregate from a person in a day in a single transaction in respect of transactions relating to one event or occasion from one person. Okay, so in simple words, 269 ST prohibits a person to receive an amount of rupees 2 lakhs and above in cash. Okay, guys, please remember, we are covering section 269 ST. Now I just want you to interpret and recall section 40A3. Do you remember what 40A3 is about, guys?
Yes, sir. Receiving more than 10%. Paying more than 10%.
It is with respect to, guys, paying. If you pay more than how much in cash? 10,000 in cash. And there was one more limit with respect to the ones who are in transport business of
Transport is 35,000.
35, absolutely. Okay, now let's try and interpret this, guys. Okay, please understand. Okay, let's say there is a person here. Okay, let me just put it in this way. Yeah. Okay, let me just draw it here. This is the payer. Okay, he pays to my SSC. He pays to my SSC an amount of rupees 2,25,000 in cash. Okay, now what is going to happen? Please understand, for this SSC, because he is receiving more than 2 lakhs in cash, there will be a penalty for him under section what? 269 ST. There will be a penalty for him. How much is the penalty? I'll just tell you. There will be a penalty on him. Okay, but then again, if you try to interpret from his perspective, from his perspective, section 40A3 will be attracted, and the amount which he has paid as, let's say, 2,25,000, it will be basically disallowed. Do you get my point? So 40A3, the reporting is separate. This is on account of, guys, receiving. 269 ST is with respect to receiving of the amount. Do you get this point?
Yes, sir.
Okay, and what is the quantum of penalty? If I tell you the quantum of penalty, okay, it is basically section 271 DA. This is basically whatever amount he has received, amount of such receipt. So imagine for this SSC, if he receives 2,25,000 in cash, 100% penalty. I mean, whatever amount he has received, that is going to be penalty for him. So it is more dangerous for the SSC to receive money than to pay, because when he pays, the amount will be disallowed, let's say. But then here is again a penalty under 269 ST will be attracted. Are you able to understand this? So all these points are actually, all these sections were incorporated to basically, reduce the amount of transactions done in cash. Okay, and more transactions should take place through banking channels. Okay, so 269 ST, again, it is with respect to receiving. Okay, are you clear on both these sections? The applicability, is this clear, guys?
Yes, sir.
Yes. Okay, all right. Now 40A3 also, if I take you guys, 40A3 also we covered. All right. Now, yeah, coming to the clauses. Again, I have already highlighted that BA, BB, BC, and BD are with respect to 269 ST. Okay. Now let us read. Okay. Now, when I talk about BA and BB, again, very simple. These two needs to be reported in PAY's tax audit report. Okay. And BC and BD, it is with respect to payers. Okay, let us read the point. Okay, again 269 ST, is it with respect to the penalties on receiving or on paying? On receiving or on paying?
Receiving.
Yeah, so BA, let us read. It says particulars of each receipt in an amount exceeding the limit specified in section 269 ST, 2 lakhs, okay, in aggregate from a person in a day, or in respect of single transaction, or in respect of transaction relating to one or more event or occasion from a person during the previous year, where such receipt is otherwise than by a check or bank draft or use of electronic clearing system through a bank. So please understand, particulars of each receipt. Okay, so whatever you have received, so this is with respect to pay. So what do you have to mention here? This is basically with respect to otherwise than by a check or bank pay or bank draft or use of electronic clearing system through a bank account. This means it may be through, let's say, cash. So then name, address, PAN number of payer needs to be given, the nature of transaction, amount of receipt, and date of receipt. 4 things: name, address, PAN of the payer, the nature of transaction, amount of receipt, and the date of receipt. And similarly, again, particulars of each receipt which is basically exceeds the limit as specified in section 269 ST, which is received by a check or bank draft, not being an account pay check or account pay bank draft during the previous year. Check might have been received, but it is not an account pay check. So same things we have to mention: name, address, PAN number, and amount of receipt. Okay. All right. Now BC and BD, this is with respect to, if you, I just highlight the keyword here, particulars of each payment made. So this is with respect to, again, 40A3 reporting will be done, but again it says particulars of each payment made in an amount exceeding the limit specified in section 269 ST. Okay, in aggregate. So again, same thing, this is with respect to the payers, otherwise than by a check or bank draft or use of electronic clearing system through a banking channel, etc. Same thing, name, address and permanent account of the payee to whom the payment was made, nature of transaction, amount and date. Okay, and if it was made through a check, but let's say made by a check or bank draft, not being an account payee, check or bank draft, then again name and address, PAN number of the payee and amount of payment. So BC and BD, it is going to come in payers tax audit report, and BA and BB is with respect to payers tax audit report. Okay, so
in BC and
yeah,
in BC and BD even 48 will come to.
48 the clause is different, no?
It's actually related to payment, right?
Sorry,
48.3
this is
related to payment.
Yeah, this is with respect to an amount exceeding 2 lakhs, but there 48.3 is for 10,000 also and 35,000, right?
Yeah.
Yes. So here particulars of each payment made in an amount exceeding the limit specified in section 269 ST. So 2 lakhs, above 2 lakhs, everything is going to come here. Okay, but please remember the penalty. I think I made the this thing also. The penalty, in this case, the one who is receiving the amount, because 269T prohibits any person to receive an amount, so the penalty is going to be on whom? The recipient. And of course the payer, he is going to be, now the amount is going to be disqualified, disallowed under section 40A3. Is this clear now?
Yes, sir.
Yes. Okay. So yeah, done. We are done with clause number 31 also. It is huge, but if you remember it in this way, with respect to the sections also, I think it is going to be very easy. And most of the students, and in fact professionals also, have seen that they are always confused, because in most of the cases in tax audit, when we do it practically, these clauses applicable, this clause is applicable in most of the cases. Okay, but then there is a always an element of confusion and all, but I think I have made it very clear. Okay, now in the next session, guys, now 31 clauses we have covered. The remaining clauses are very simple. If you see the size also, let me just show it to you. 32 is about depreciation, about brought forward loss and all, but see the size of the other clauses: 33, 34, 35, 36, 36A, see 37, 38, 39, 40, all in one page. So we are going to cover them in the next session, and it is not going to take much time now. Okay, we have to complete 44 clauses in total, and then after the clauses are over, I'll take you down through some of the questions, okay, that we are going to cover up, and for your better understanding, I have also mentioned the clause number to which the particular question pertains to, okay, so that when you revise it, you are able to do it quickly. Okay. Alright, so in the last session we covered from clause 28, which was basically, again, if SSC receives shares either at no consideration or inadequate consideration. Then clause 29 was with respect to issue of shares. Okay, if the shares are issued at a price which is more than fair market value, this is again in case of closely held companies. Okay, then 29A and 29B, two new clauses, which is with respect to again income from other sources, in case any advance money is received and you forfeit it. Okay, 29B again was with respect to all those sources of income which is referred to in section 56 subsection 2 clause 10. Okay, clause 30 was with respect to hundi form of borrowing money. Okay, 30A, 30B and 30C. 30A, 30B are with respect to transfer pricing, and 30C was with respect to GAAR, general anti-avoidance rules. Okay, and then we covered clause 31, which was based on 3 sections. It has got 9 parts. Section 269 SS, then we covered 269T also, and then 269ST. Okay, so these are the clauses that we have covered up until now. So in today's session, this is going to be the last session for tax audit. We are going to cover the remaining clauses, that is from clause number 32 till clause number 42. Now the clauses are not that exhaustive, and we shall be able to cover them up quickly. Okay, so let us now start with clause number 32. Okay, in 32, clause number 32 is more about the carry forward and set off of losses. Okay, carry forward and set off of losses. So if if we are the tax auditors, under clause 32 part A, details of brought forward loss or depreciation allowance in the following manner is to be given. Okay, so details of if there is any brought forward losses or depreciation, then details needs to be given. Okay, what are the details? Serial number, assessment year. Okay, then we have nature of loss or allowance which was given, amount as returned. Okay, then there are 2 points which are added recently. This is all allowance losses not allowed under section 115 BAA, BAC and BAD. Again, these are with respect to, guys, companies who opt for concessional rate of taxation scheme. I told you 22% rate of taxation. For manufacturing companies it is different. Okay, so again, same amount as adjusted by withdrawal of additional depreciation on account of opting for taxation. So again, these 2 points are with respect to concessional scheme of taxation. Okay, amount as assessed and then remarks. So basically 32A is only with respect to brought forward loss or depreciation loss. So as an auditor, we have to report if there is any brought forward loss in case of our client SSE. Okay, now clause B, part B, sorry, not clause B, part B is a good one. It says whether a change in shareholding of a company has taken place in the previous year, due to which the losses incurred prior to the previous year cannot be allowed to be carried forward in terms of section 79. Now this is something that we have to understand. Now what is section 79? Okay, now let's say I have mentioned it here in very simple words. Section 79, in case of a closely held company, so this is for closely held company where a substantial change in shareholding has taken place in the current financial year. What do you mean by substantial change in shareholding? Where the shareholding has changed more than 49%. Okay, no loss incurred in any prior year prior to the current financial year shall be carried forward and set off against the income of the current financial year. Okay, so what is the case? Let me just try and explain it to you. It says, let's say there is a company. Okay, there is a private company XYZ Private Limited. Okay, now they incurred a loss of let's say in 2019-20 they incurred a loss of rupees, let's say 5 lakhs. Okay, and in 2019 and 20 let's say the shareholders was A1 and A2. Right, now what happens is let's say in 2021-22, okay, in 2021-22 they have earned certain profits. Now the profits can obviously be set off, but there is a condition. If the shareholding in this financial year has changed substantially, I mean if there is a change in shareholding of the company, earlier the shareholders were A1 and A2, now the shareholders are different. Let's say there is a change in shareholding and change is more than 49%, then the set off will not be allowed. Why? What is the reason? Let me just tell you very practically. Okay, so let's say what happens is there was a practice going on that, let's say if let's say I have a company and I have earned good profits, okay, but I don't want to pay the taxes. So what I'll do, I'll buy a loss making company. I mean, when I say I'll buy a loss making company, this simply means what? In case of private company, how do I buy a company? I'll just buy, I mean I'll pay the shareholders. I mean there are only 2 shareholders. I'll buy the shares from those shareholders, right? So now the company is mine. The company becomes generally, you know, if I'm the owner of the shares, the company is mine, right? So if I was making profit in one company, please understand, okay, so what is going to happen? Let's say if I have income from other sources and all, okay, income from other businesses, okay, not sources, income from other businesses, I'll buy this company, okay, and then, you know, generally what happens, the profits of one will be set off from the profit. Now because the company is ours, we'll try to set it off. Okay, so maybe the company itself might become a shareholder. So generally this, to avoid this thing, the provision was introduced, section 79, that, you know, in case of a closely held company, that means in wherein the public is not substantially interested, where a substantial change in shareholding has taken place in the current year, no loss incurred in any prior year to the current financial year shall be carried forward and set off against the income of the current year. So against the income of the current year, no prior year losses would be now allowed to be set off. Why? Because there is substantial change in shareholding. So this is section 79. So in our case, it says whether we have to report whether a change in shareholding of the company has taken place in the previous year, due to which losses incurred prior to previous year cannot be allowed to be carried forward in terms of section 79. So if there is a substantial change in shareholding of the company that we are auditing, then we have to report here. Again, this is a point with respect to carry forward and set off. So please remember, clause 32 we are mostly going to deal with what? Carry forward and set off. Okay. Now part C and E, let us do it together. Part C is again C and E are with respect to speculation business. Okay, so whether the SEC has incurred any speculation loss referred to in section 73 during the previous year. So if SEC has incurred any speculation loss, we have to give the details thereof. Okay, so please furnish the details of the same. Very simple. Okay, under section 73. Now again, there is one more point with respect to speculation. This is in case of a company. Please state whether the company is deemed to be carrying on specific speculation business as referred to in explanation to section 73. If yes, please furnish the details of speculation loss, if any, incurred during the previous year. Now please understand what happens generally in case of companies. If let's say they are into some business, they are doing some trading business, and they also do some purchase and sale of securities, let's say. And now if upon purchase and selling of securities, they have incurred certain losses. Now that loss would be deemed as speculation loss. Okay. Now section 73, again it is only this clause is to be reported only in case of company assesses. In case of a company, please state whether the company is deemed to be carrying on speculation business as referred to in explanation to section 73. So in case of companies, even if they buy and purchase sales, and let's say if there is a loss, okay, it will be deemed to be speculation loss in case of company if it is, let's say, engaged in some other business also. Okay, so part C and part E are both with respect to speculation loss. This can be for any SSC, and this is specifically for companies. Okay. And then we have another part D, which is again very simple. Whether the SSC has incurred any loss referred to in section 73A in respect of any specified business during the previous year. If yes, please furnish the details of the same. So if the SSC has incurred any loss with respect to section, businesses, that specified business as referred to in section 73A. Now what is 73A? Let us understand this. Now 73A, basically guys, it is with respect to loss of specified business, and loss of specified business can be adjusted against income of specified business. Now what is specified business? Now when I talk about 73A, it is generally it talks about the businesses which are mentioned in section 35 AD. Now 35 AD of the income tax provides for investment linked scheme to SSC carrying on specified business, and 100% deduction. 35 AD provides deduction to the extent of 100% to the SSC for carrying on specified business as given under the act. So what is the specified business? Let's say if I invest in cold chain facilities, I make a warehouse for agriculture produce, laying of pipelines, etc. Okay, so these are some of the businesses, specified business under section 35 AD, wherein if I invest the entire amount, 100% is given as a deduction also. Okay, but the thing is, if we incur any loss out of this specified business, it can be set off. Okay, it can be adjusted against income of specified business only. Okay, so it's in simple words, it says loss of specified business can be carried forward indefinitely till it is set off, and it will be set off against income of specified business only. Okay, so please understand, it says the loss of a specified business referred to in section 35 AD of any assessment year is allowed to be set off only against profits and gains, if any, of any other specified business. But yes, it can be carried forward indefinitely till it is set off. Okay, so please understand section 35 AD. In section 73A, we are actually referring to any loss that you have incurred if you are carrying on specified business as per section 35 AD. So let me read the part again. Part D, whether the SSE has incurred any loss referred to in section 73A in respect of any specified business. What specified business? As per section 35 AD. Okay, during the previous year. If yes, please furnish the details of the same. So in simple words, what is specified business under section 35 AD? You get 100% deduction. Okay, there are certain businesses mentioned there like cold chain facility, warehouse, laying of some pipes, gas, etc. Okay, and if you incur any loss out of those business, it could only be set off with the income from the specified business. The carry forwarding of this loss can go indefinitely till it is fully set off. Okay, so this is basically 73A. Now with this clause, our clause number 32 is over. Okay, so 32 again, we have covered. As such, we covered 5 parts here, but what are the 5 parts, guys? If I again if I wish to summarize, okay, the number 1 part A was with respect to what? We have to just give details of brought forward losses, okay, and the depreciation allowance. Okay, part B is with respect to what? Part B is basically section 79. You have to report as per section 79, wherein you have to see if there is change in shareholding. Okay, if there is change in shareholding. So if I have told you if there is substantial change in shareholding, then the losses of prior years will not be allowed to be now set off. Okay, again, C and part E. C and part E are basically with respect to sections. Okay, let me just write it in this way. Yeah, C is with respect to C and E. Okay, it is with respect to speculation losses. Speculation loss, and this is only applicable to who? Section this will be as per section 73, speculation loss, and part E is only applicable to company SSE. Okay, C and E, this is with respect to section 73, speculation loss. And D part, again, in D part, what have we covered? In D part, this is again with respect to section 73A, which is with respect to specified business. Okay, so this is a summary. So there are 5 parts. 32A deals with brought forward losses, depreciation allowance. B is with respect to if there is substantial change in shareholding, section 79. Then C and E is with respect to section 73, speculation loss, and part D is with respect to 73A, which is basically about specified business, that loss from a specified business can be set off against profits of specified business only. Okay, what is specified business? Again, as per section 35 AD. Incentive, it is basically investment linked incentives. If you invest in cold chain facility, warehouse for agriculture produce, etc. Okay, so clause 32 is done. All right, now coming to the next part. Next clause is clause 33. Again, very simple. Now the clauses are going to be very simple. It says clause 33 is basically with respect to deductions. Okay, section wise details of deductions. If our SSE is claiming any deduction, we just have to give section wise details of the deduction as admissible under chapter 6A or chapter 3A. So section under which deduction is claimed, okay, it can be investment related deductions, it can be tax holidays. So section wise details needs to be given. Okay, and amounts admissible as per the provision. So section, you need to give the section number under which the deduction is claimed and the amount of deduction. That's it. Okay, so section clause 33, it is with respect to what, guys? Deductions. Okay, I told you deductions can be investment related deductions. Okay, and also with respect to the tax all the deductions like ATI, ATB, ATIB, tax holidays, etc. Okay, all right. Then we have section 10A, 10AA, etc. So all deductions and the amount which are admissible. Fine. Then clause 34, again very simple. Clause 34 is with respect to TDS or let's say TCS. Okay, and I'm very sure in offices also you fill up this particular clause. Okay, so there are three parts. Okay, number one, whether the SS is required to deduct tax, deduct or collect tax as per the provisions of chapter this and this, which is basically on TDS and TCS. Okay, so if yes, we have to furnish. Okay, so you need to give the TAN number. Okay, section, what was the nature of expenditure made for which you deducted the tax or let's say collected the tax, total amount of payment or receipt. Okay, total amount on which tax was required to be deducted, total amount on which tax was deducted, required to be deducted, and then we have total amount on which tax was actually deducted, amount of tax deducted or collected out of let's say 6, total amount on which tax was deducted or collected less than specified rate, if it is collected at a rate which is less than the specified rate. Okay, amount of tax deducted or collected on this lesser rate, etc. All these things we have to give the details of. You don't have to remember the table, but yes, so this part is with respect to the details of TDS and TCS details. Okay, let's say about the expenditure on which TDS had to be deducted, whether it has been deducted, okay, and whether it has been collected, whether it has been deducted at a specified rate, all these things. Okay, then in part B, whether the SSC is required to furnish the statement of TDS or TCS. So this is, guys, with respect to furnishing of the TDS returns, let's say TDS statements of TDS and TCS. Okay, so again, whether the SSC is required to furnish the statement of tax deducted or collected, if yes, the details. Okay, what details? Again, the TAN number, which form has been filled, on which date, due date for furnishing, date of furnishing, then all the transactions which are required to be reported, whether the statement of TDS or collection contains all information, whether all information, the auditor can check this on test check basis, whether all transactions, expenditure, or all information has been incorporated in the statements or not. If not, please furnish the list of transactions which are not reported. Okay, so part B is with respect to what? The statement of TDS and TCS. Okay, and third part, of course, see, when you collect TDS, you have to deposit the same, right? And if there is a delay, then there is interest. Okay, so this is basically with respect to interest on, let's say, delayed payments. Okay, so part C is with respect to, again, TDS, TCS. It says whether the SSC is liable to pay interest under 2011, this is for TDS, this is for TCS. So if there is liable to pay interest, then the details need to be given. TAN number, amount of interest, and then amount paid, amount which has been paid, interest which is actually due and which is paid, basically. Okay, so very simple point, nothing much to explain here, guys. And what are the things that we have to remember under clause 34? Three things. Okay, first part we have to give the TDS and TCS details, or it will also include the nature of expenditure section, the nature of payment made, total amount of payment, etc. Okay, then we need the statement of TDS and TCS. Okay, and then finally, if TDS TCS collected is not deposited, if there is any interest liability, basically liable, if the SSC is liable to pay interest, then we have to mention the amounts. Okay, so amount of interest and then amount which is paid. Okay, so again, see, this is something very simple, and nothing much explanation is not required in this case. Okay, so this is basically 34 number clause with respect to TDS and TCS. 33 was with respect to deductions, and we started today with 32, which is basically focuses on carry forwarding of the losses. Okay, so 32, 33 and 34 done. Okay, moving ahead, we have clause 35 again, which is very, very simple. So we just have to give, in case of trading concern and in case of manufacturing concern, we need to give quantitative details of principal items of goods traded. I mean, the principal items of goods traded we need to give. If it is a trading concern, the opening stock needs to be mentioned, purchases during the year, sales, closing stock, and if there is any shortage or excess. Okay, similarly, if my SSC is, let's say, it is manufacturing concern, then quantitative details of principal items of raw materials, finished goods and byproducts needs to be given. So this is with respect to raw material, and then we have finished products and byproducts also. So with respect to raw material, again opening stock, purchases, consumption, sales during the previous year, closing stock, yield of finished products, okay, input output ratio, basically percentage of yield, shortage, excess if any. And then for finished goods, okay, again opening stock, purchases, what was the quantity manufactured, sales, closing stock, shortage, excess if any. So this is basically, you know, clause 25 is with respect to the quantitative details, guys. Okay, and if it is a trading concern, we just need to give principal items which are of goods traded, and if it is a manufacturing concern, we need to give details about raw material, also finished goods, finished products, and the byproducts if any. Okay, so again very simple, nothing to explain, and again this is something that you must be doing it in your offices also. Okay, now 36 and 36A. If I talk about 36 is basically on dividend, you know, the initially, if you remember, on dividends, if a company is paying dividends, they need to pay the corporate dividend taxation, right? But now please understand this, clause number 36 and clause number 36A is I mean omitted only because corporate dividend tax was abolished in the budget of 2020. Okay, so 36, under 36 it says, in case of domestic company, details of tax on distributed profits under section 115-0. So this was basically with respect to the CDT, corporate dividend tax. Okay, but now this is, you just have to omit it. This clause is no longer applicable. This has been omitted by income tax rules with effect from 1/4/2021. Why? Because CDT is now abolished, corporate dividend taxation. Now taxation on dividends is again brought in the hands of the shareholders. Okay, so this is no longer required. Okay, this is omitted, this clause is omitted. Now 36A is also omitted, but again just let us understand the difference. 36 was with respect to, guys, dividends. Okay, and 36A, it is with respect to, if I talk about 36A, it is with respect to deemed dividends. Okay, now what is 36A? Let us go through it. Yeah, it says whether the SSE has received any amounts in the nature of dividend as referred to in section 2 clause 22 subclause E. If you remember this very important section, you must have covered at the intermediate level also. This is with respect to deemed dividends. Okay, so if my SSE has received any deemed dividends as per 2 subsection 2 clause this clause 22 and subclause E. Okay, 2 is mostly with respect to the definition, so 2 subclause 22 and 2 clause 22 and subclause E. Okay, if yes, please furnish the details. So amount received and date of receipt. So what is deemed dividend as per section 2 clause 22 subclause E? Let us understand this. When a company in which the public are not substantially interested, so it is basically what? It is for closely held companies. If a closely held company extends any loan or advance, if a closely held company extends any loan or advance to any of its shareholders who has more than 10% of voting power in the company. So if a company has extended any loan or advance to a shareholder, and this shareholder has got more than 10% of voting powers, or let's say they extend any loan or advance to any concern in which shareholder is substantially interested. So it can be any other concern in which such shareholder is substantially interested. Such means the one who is having 10% or more voting rights, or for the individual benefit of such shareholder, or on behalf of such shareholder. Okay, so if there is any loan or advance given by this company in favor of this on or on behalf of this shareholder who has more than 10% of voting power, then such payments would be deemed as dividend under section 2 subsection 22. Okay, it will be deemed as dividend. Now please understand, if it is deemed as dividend, okay, so of course let's say the SSE has not the SSE, if the company, okay, this is the company and this is the shareholder, let's say, okay, so it would be deemed dividend as in the hands of shareholders, but because it is deemed as dividend in the hands of the shareholders, the company would be liable to pay what? Corporate dividend tax. Okay, so again, if our SSE is the company and there is a case of deemed dividend as per this section, need to report, okay, we need to report whether the assessee has received any amount in nature of dividend. Okay, so in my case, this is the company. Okay, whether the assessee has received any amount in the nature of dividend as referred to in clause this, and if yes, we need to give the amount and date of receipt. Okay, but then please understand what happens is now that since dividend distribution tax, DDT, dividend distribution tax is not applicable with effect from assessment year 21-22, hence reporting under this is not relevant. So again, DDT is not applicable from assessment year 21-22, so hence no reporting now needs to be done in this case also, dividend distribution tax. Okay, so 36 and 36A is, 36 is omitted only, and you just have to go through it, okay, and it has been omitted, so you can ignore them also. All right, okay. Now coming to the next part, again, if you see the clauses, the clauses are very simple now. 37, 38 and 39 are with respect to audits. Okay, what audits are? Let us understand whether any cost audit was carried out. If our SSC, in case of our SSC, whether any cost audit was carried out. If yes, give the details, if any, of disqualification or disagreement. So if the cost auditor has disqualified the report or opinion, okay, so we have to give the details of disqualification for any matter, item, value, quantities, etc. Okay, so this is with respect to cost audit. Clause 37 is with respect to what? Cost audit. Clause 38 is with respect to audit conducted under Central Excise Act 1944 in case of manufacturing companies. Okay, if yes, give details of same thing, disqualification or disagreement. If there is any disqualification, then as a tax auditor we need to give details of the same. Again, clause 39, whether any audit was conducted under section 72A of the Finance Act in relation to valuation of taxable services. Okay, this was with respect to service tax and all taxable services. Same thing again, if there is any disqualification, it needs to be reported. Okay, so 37, 38 and 39 are with respect to audits, cost audit, Central Excise audit under Central Excise Act 1944 and audit under section 72 of the Finance Act 1994 with respect to valuation of taxable services. Okay, now, all right, clause 40, again very simple. Clause 40, of course all of you do this, most cases it is applicable to the entity under audit, so you must have done it in your offices. Details regarding the gross, we have to give details about turnover, gross profit for the previous year and the preceding year. Okay, so what was the total turnover, what is the gross profit, what is net profit, stock in trade and material consumed, or let's say finished goods produced for manufacturing entities. These are certain details that needs to be given under clause number 40. Okay, so very simple: turnover, gross profit, net profit, stock details in trade or let's say, and then if material consumed or finished goods produced in case of manufacturing. Okay, then 41 is also a very simple clause. 41 is with respect to demand raised or refund issued. Please furnish the details of if there is any demand against my SSA or if there is any refund issued to my SSA during previous year under any laws other than the Income Tax Act and the Wealth Tax Act. So for any other let's say if it is with respect to the service tax, it is with respect to GST, then this clause will be applicable. If there is any demand under any of the other acts other than, let's say, Income Tax or the Wealth Tax Act, then the details of the demand, or let's say if it is a refund order, that needs to be given. Okay, so demand order or refund order for tax laws, but tax laws other than income tax or wealth tax. Okay, it can be for any previous year. We have to furnish the details. Okay, now, so this is if I'll write, this is basically with respect to demand order or if there is any refund order. Okay, for any tax laws. Okay, for this is for tax laws, but the tax laws must be other than, the tax laws are other than, let's say, the Income Tax Act, or let's say other than the wealth tax. Okay, very simple. So two things if we have to give details of: demand and if there is any refund. Okay, now clause 42. Okay, I told you, see now 41 till 41 it was so simple. Okay, what all things that we covered from 32. 32 was with respect to carry forward of brought forward losses, depreciation. Okay, 30 we started today with 32. Then 33 if you remember guys, it was with respect to the deductions. Okay, under the various chapters, deductions. Okay, 34 was with respect to TDS and TCS. 35 is with respect to the quantitative details of principal items of goods either traded or let's say manufactured. Okay, 36 and 36A omitted because it is with respect to the dividend distribution tax. Okay, 37, 8 and 9 very simple with respect to audits. 37 cost audit, 38 with respect to central audit under Central Excise Act, 39 it is with respect to section 72 of the Finance Act, 40 details about turnover, gross profit, etc. 41 is with respect to demand and refund issued. Okay, now 42, 43 and 44 are a bit technical. Let us go through it. Okay, 42 is basically whether the SSC is required. Okay, we just have to now mention whether the SSC is required to furnish statement in form 61, 61A and form 61B. Now what is form 61A, 61B? Let us now first understand this. Okay, let me just write it for you in simple words. What is form 61? Form 61, form 61A and form 61B. Okay, so form 61 is basically it is basically details of form 60 submitted by transacting parties not having PAN. So if some party wherein we are transacting, they do not have PAN and requirement of to quote PAN is mandatory, so form 60 needs to be filled by them, and form 61 basically gives the details of form 60 submitted by transacting parties not having PAN. Okay, so this is form 61. I'll give you examples wherein these can be used. Okay, what is form 61A? This is basically SFT. SFT is basically what? Statement of financial transactions. So now what happens is, let's say the banks and all, they if in a bank you go to the bank and you want to make a demand draft of 12 lakh rupees and you pay them 12 lakh rupees in cash to make the demand draft, they'll give you the demand draft, but then the bank is now going to report it to the income tax in this form 61A that cash was this, this particular person, he bought so much amount of cash. So basically 61, 61A and 61B, these are for basically high value transactions. And when I say high value transactions, more specifically these are for reporting of high value transactions, and 3 reports basically reporting needs to be done: form 61, form 61A, and then we also have form 61B. Okay, this is with respect to some reportable accounts. Okay, statement, let me just write it for you. This is statement of reportable accounts. And when I say statement of reportable accounts, guys, this is more with respect to this arises. Let me just write it for you. As such, you don't need to know, but yeah, this arises basically the need to file form 61B arises for implementation of, we call it as FATCA, FATCA, FATCA. It is basically Foreign Account Tax Compliance Act. Okay, you are going to cover them later, not as such required, but yeah, these are the 3 forms. Now in simple words, guys, if I say what does the form simply mean, so let's talk about, let's say, form number 61A. Okay, so if I say Form 61A, this is a statement of specified financial transaction. Okay, now this is required to be furnished by who is going to furnish? Let's say it is a banking company, cooperative bank, non-banking financial company, any institution, let's say, which issues credit card. Okay, post offices, Nidhi company, they are the ones who are going to come up with this Form 61A, wherein they are going to mention, this is basically statement of financial transactions. Okay, what kind of transactions do they need to mention in Form 61? Let's say for banking company, okay, if there is a cash payment made, I told you, just I gave you an example, if there is a cash payment made, let's say Prachi comes to the bank and she gives let's say 12 lakh rupees to the bank to make a demand draft. So again, the demand draft will be given, but the reporting will be done by the bank in Form 61A, which directly goes to the income tax department. Okay, let's say again, if there is a cash payment exceeding 10 lakh rupees for purchasing any prepaid let's say RBI instruments, like if you buy any RBI bonds issued by RBI, you pay cash and you buy it, then again reporting will be done. Okay, so these are certain examples which I'm giving you. Okay, let's say again, in case of credit cards, so cash payment aggregating of rupees 1 lakh or more in a year, or 10 lakh or more in any other mode of payment against credit card bill. So if there are payments, if I have made payment of more than 10 lakhs, okay, for my credit card, okay, then the reporting will be done. Okay, or let's say if I do cash payment of even more than 1 lakh, okay, in a year for my credit card, then the reporting will be done. So there are various conditions. So banks and all, they report to the income tax, so that the income tax department gets all the information from the banking also, and then they could send you letters, okay, asking for justification of the said transactions. Okay, earlier this concept, the SFT, now we call it as statement of financial transactions. Earlier this was called as annual information return. You must have heard about it also, that for keeping the income tax department, for keeping a watch on high value transaction done by the taxpayers, the income tax department has framed up this new concept of statement of transactions, okay, or let's say reportable accounts, just to keep a watch on high value transactions. Okay, so if my SSC is a bank or a cooperative society or a cooperative bank or NBFC, or let's say an institution who issues credit card and all, so then I'll need to furnish all this. Okay, so if my SSC, let's say it is a bank, so I need to basically mention whether they are required to furnish statement in Form 61 or 61A or 61B. If yes, then the details thereof needs to be furnished. Okay, income tax department reporting, identification number, type of form, due date for furnishing, date on which it was furnished, whether the form contains information, etc. All the details. If not, the details has to be given. Okay, so this is basically clause 42 is with respect to three forms, 61, 61A and 61B. All of them are basically to keep a watch on high value transactions. Okay, you cannot, if you do, now let's say sometimes earlier there was a point that if there is a cash deposit in your savings account of more than, let's say for 10 lakhs or something like this, okay, then again the information will be given to the department by the bank. So this is basically SFT. Okay, we call it as statement of financial transactions. Okay, done. Now next clause number 43, it says whether the SSC or its parent entity or alternate reporting entity is liable to furnish the report as referred to in subsection 2 of section 286. Now what is 286? First let us read this. Very simple. Provisions of 286 subsection 2 require every resident parent entity or alternate reporting entity. So every resident entity to furnish a report in respect of international group of which it is a constituent. So basically they have to give details of the international group which they are a part of. Let's say we talk about company Nestle in India. So Nestle will have to now furnish a statement. Basically they need to furnish a report giving details about the international group of which it is a constituent. Okay, so it says the resident parent company or alternate reporting entity. Let's say the parent entity, the head office, headquarters of Nestle is let's say somewhere in Europe, but Nestle, it is a company, let's say in India. So they will now have to furnish a report in respect of international group of which it is a constituent. Okay, and it should be noted that report is to be submitted for every reporting accounting year. The report is to be submitted in form 3CEAD within period of 12 months from the end of the respecting accounting year. So this needs to be done. So if our SSC, whether they are liable to report, this is what we have to check. If the answer to this is yes, then whether the report has been furnished by the SSC, name of the parent entity, alternate reporting entity, and date of furnishing the report. So not very important clause, but yes, this is with respect to giving information about the international group of which it is a constituent. Please remember, this is done in form 3CEAD. Now these are things I know can be a part of MCQ also, so please be very careful. The details needs to be submitted in form 3CEAD. What is the timeline? Within a period of 12 months from the end of the respective accounting year. Okay, so this is clause 43. Now coming to 44. Okay, now 44 is a very, very, extremely dangerous clause, basically, clause 44. But let me tell you that clause 44, it is basically with respect to breakup of total expenditure. Breakup of total expenditure of entities registered or not registered under GST. So now we generally give this, these are the expenses. We generally in the PL also the heads of the expenses are given now, but here now, total amount of expenditure incurred during the year we have to mention, and then we have to give a breakup also as to, let's say if this is a total amount of expenditure done under this head, then we have to give breakup also as to expenditure relating to goods or services exempt from GST, relating to entities falling under composition scheme, relating to other registered entities, total payment to registered entities. So out of we have to give details, so much of detail with respect to one expenditure, whether the expenditure, whatever expenditure has been made, so we need to give the breakup of the total expenditure of entities registered or not registered under GST. Okay, so expenditure in respect of entities registered under GST, this is with respect to the ones who are registered under GST. So I make a payment, let's say to Prachi is registered under GST, and I make a payment to Suthir also, let's say Suthir is not registered under GST. So expenditure in respect of entities not registered under GST. Now if Prachi is registered, so much details I need to give. See, relating to goods and services which is exempt, issue under composition scheme, relating to other registered entities, and total payment which was made. And if let's say I make a payment to Suthir, let's say who is not registered under GST, so expenditure in respect of entities not registered under GST. So the report, the level of reporting here will be huge. Okay, but then thankfully it has now, it has clause 44 has been kept in abeyance till 31st March 22. I mean, this has been deferred. Okay, so reporting under clause 44 has been kept in abeyance till 31st March 22. So there was a circular in somewhere in March 2021. Okay, so they have deferred it. I mean, it has been kept in abeyance. As such, reporting needs not be done at the moment. Okay, so clause 44 again, clause 30C and clause 44, the reporting need not be done at the moment. Okay, all right. And 36 and 36A, I told you more or less no reporting needs to be done because 36 is omitted. The dividend distribution tax is omitted now. 36A also as such, because consequently the reporting under 36A also will not arise. Okay, so now guys, we are done with all the clauses of tax audits, and I told you, see, after clause 31, I mean from 32 until clause 44, we hardly took any time, right? So with this, the clauses of tax audit is over, and now in the next session, if you wish, we are going to discuss all the questions relevant to tax audit. You can watch them. Okay, so any doubts, guys?